Hi everybody, it's Chris and welcome to the Investing Masterclass. Welcome to class 1 of module 1 of this course. If you watch this video, it's because you want to learn how to invest in the stock market and you want to learn step by step the process of investing in stocks, building a strong portfolio, and I will teach you how to do it. Here is what we're going to cover in this first class. First, we will see the power of compounding and how investing early can generate a lot of wealth. And we will also see why invest and why invest in stocks. I will also show you the entire course curriculum. We will see the goals and rewards that you can have in this cool community. We will see some important things to remember and how to get help and support so that you can have the best experience in this cool community. And if you want some exclusive content, I will put a lot more content on my YouTube channel, which is called Christophe Noor, but also on my Instagram account and TikTok account. So I encourage you to follow me on these accounts. And if you think what you will learn in this course is valuable, please don't hesitate to share the course so that the more people that are in this community, the better it will be for you and the better experience it will be, because more people can interact, more people can generate ideas, clone ideas from each other, and you will get even more advice if we are a community with hundreds of members, thousands of members. So I highly encourage you to share this course. It's completely free. Here is the pro tip. Watch the video at 2 times speed. You will understand everything and it will be faster for you. Okay, before we start, I'd like to share some background. My name is Christophe Noor. I'm a financial analyst with a double degree from EDHEC Business School with a major in finance and accounting. I have worked in several investment funds, value investing firms like Voltava Fund, but also Amiral Gestion and Sycomore Asset Management in Paris that manage billions of dollars, so big investment funds. I have attended Warren Buffett annual meeting and many other investing events. I'm a big believer in the value investing mindset, and I think it's very valuable to attend these events in person, that you can meet people. And that's how I met the best Indian investor, which is in the second photo, Monish Pabrai. And I also met Li Lu, the best Chinese investor, in the third picture at the Berkshire Hathaway annual meeting, the Warren Buffett meeting. The fourth picture is a picture with Rob Vinal, which is one of the best fund manager in Europe that has averaged double-digit returns for more than a decade now. And at the right, you can see a picture with Daniel Grealish, one of the best value investor in the world. I worked for him at Voltava Fund for more than a year, and he taught me a lot of good lessons that I will teach you now. With all this knowledge from all these gurus, all these investment legends, I have built a successful 6-figure portfolio that has averaged 26% return annually for the past 7 years. That means that $1,000 invested at the beginning have turned into a bit more than $5,000. In comparison, if you compare to some global index, the major index is the S&P 500. In comparison, if you had invested in the S&P 500 at the beginning, you would have less than a double. So that's a big outperformance thanks to the strategies of these investment legends. I also manage a successful public portfolio on eToro for more than 100 investors. So this strategy that I'm about to teach you has worked, and I think it will continue to work in future years. In this 5-week course, you will learn how to take advantage of the stock market and make money. You will learn how to build a resilient portfolio in an uncertain world. You want to hedge your position, you want to assure that you are aware of these risks, and we will have a complete guide on risk management. I think it will be very important, and that's how you will make the biggest gains, and that's how you will sleep well at night. You will also learn what differentiates a good stock from a bad stock, because you want to fill your portfolio with good investments, good stocks, and we will see the psychological aspects of investing. It's very important. After all, after you've done all your math about investing and accounting and everything, you have to hold these positions for the long term. You have to hold these stocks. Even though sometimes there will be a panic, you have to hold. And that's a mental game. That's a different kind of game. And I will teach you some tips. I will show you some tips on how to handle the risk of managing a portfolio. We will also see how to avoid the traps, especially with accounting and financial ratios, everything like this. And we will see which brokers to use, like which platform do you want to buy and sell stocks. Because this will be a very complete guide, I think this community is for everyone, whether you are a beginner, but also at an intermediate level or an advanced level. You will learn a lot of things. And even if you are at an advanced level, I think it's very valuable to be part of a community where everyone will share ideas, investment ideas, so you can take all this information from this community and use it for your strategy, even if you are at an advanced level. For this school community, I will guide you through the whole process, step by step, and you will be part of a community of like-minded people that want to grow together. That's the best thing you can have when you learn something, is that you are part of a community, you can exchange ideas, etc., etc. So with that in mind, let's become the biggest stock market school community. That's my goal with this account, and I think it's doable. Okay, so let's start with the power of compounding. If you invest in the stock market, you want to invest in the stock market for the long term. That means you don't want to invest for 1 month, 2 months. I'm talking about investing, not trading. That means that time is your ally. Investing in stock, on average, has generated 7% interest per year. And I think if you consider average over the past 200 years, I think in the future it will generate 7% interest per year. So if you have $1 at the beginning, you have $1.07 at the first year, and then $1.14 at the second year. And then over time, the accumulated interest will create more interest. So you will get 7% of a bigger pie. The longer you wait, the bigger your interest will be. The compounding interest is the increasing value of asset due to the interest earned on both the principal, so what you have at the beginning, and accumulated interest. That means that the longer you invest, the bigger the accumulated interest. So as a first lesson, it's important that you invest as early as possible. It will have a profound impact on your long-term wealth and your financial freedom. The magic of compounding is like a snowball. And I have this image to show you that even if you start small, over time, your little snowball will accumulate snow and it will be bigger and bigger and bigger. And your little 7% per year, after 10 years, 20 years, 30 years, it will be a huge snowball, and that's when you will reach the biggest gains. So in this game, you have to be patient, and time is your ally. And if you don't believe me, well, Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And think about it, if you are lucky enough to have more returns than 7%, and if you take an extreme scenario of generating 20%, 25%, let's take an example, 26% per year. That means a double of your investment in 3 years. So your investment is a double in 3 years, but also a quadruple in 6 years. Then it gets multiplied by 8, 16, 32, 64, 128, 256, 512, and then 1024. So every 3 years it doubles, and after 30 years you get 1000x on your investment. That's huge. That's not easy to do it, but now you get the idea of compounding and how the magic can happen over time. Now, so that you understand that you have to invest as early as possible, let's take an example of two investors. One investor starts investing at 25, sets aside $5,000 a year for 10 years in a row, and then doesn't put money in the markets at 34. Okay, and now you have a second investor that starts investing at 35, invest the same amount of money, $5,000 each year, but for 30 years in a row until reaching age 65. Well, if you compare the performance of these two investors, the first investor that started earlier will have more money, even if at the beginning, like the initial amount that he or she investing in the stock market was lower. It's just that time is so powerful. The compounding effect is so powerful that it's stupidly easy that you have to invest as early as possible. As I said, time is your ally. So if you're 25, please invest now. And if you're even younger, it's wonderful because you have this huge advantage of a long runway, a very, very long runway. And the best investors of the world have understood this. Take, for example, Warren Buffett. And you see in this graph his net worth over time that keeps compounding and compounding and getting bigger and bigger. And most of his wealth was generated in late years. He just stayed in the game, and over time the magic of compounding happened. And there is a reason why the biography of Warren Buffett is called The Snowball. He understood it at the beginning at the age of 11 and started investing in the stock market at 11. So yeah, he understood at a very early age the magic of compounding, took advantage of it, and now he's one of the richest men on earth. If you don't know who Warren Buffett is, he generated a 20% return per year for 50 years. He started investing with a concentrated stock portfolio, and he made all his fortune investing in businesses, investing in companies. And with all of this, now he's over 90 years old, he built the Berkshire Hathaway empire, which is now in the top 10 biggest companies in the world. So that's some very impressive results, and I believe that if you clone his strategy, you can make very high returns over many, many years. Now, some people ask, why invest and not save your money in a saving account? Well, there is a difference between just saving money and investing your money. Is that when you save money, you have low risk. You can sleep very well at night, and you have the liquidity in the short term. If you want to buy a house, if you want to buy a new car, you have the cash available. But your saving loses its value with inflation. For example, if inflation is 10% and your saving account generates 5%, well, net of this, you lose 5% of your real money each year. In comparison, investing has more risk. You can lose money, but you can get a lot more money. You can earn much more investing in the stock market. Generally, it beats inflation over time, and that's a great tool to increase your wealth for the long term. Now you can invest in everything. You can invest in real estate, you can invest in bonds, treasury bills, stocks. So why choose stocks? Well, let's start with the beginning. Let's start with the difference between bonds and stocks. For bonds, you lend to corporations or governments. It's all about debt. A company wants new debt and you take care of it. You make money on a fixed interest payment and you have potential returns that are limited to interest. It's like a fixed contract and they say, okay, we will pay you 4% per year, and that's it. This is fixed in advance. You will get 4% every year. And it's very hard to lose money. The only reason you lose money and your bond becomes worthless is that the issuer defaults, the company you take care of the debt just goes bankrupt, And the second risk is that if you have a 4% interest and inflation is 10%, then on a net value, you lose 6% per year net. In comparison, for stocks, stocks are partial ownership of businesses. For example, if you own stocks of Starbucks, you own 0.0001% of Starbucks, the company. That's as simple as this. But you don't have a fixed 4%. You don't know what you will get. With stocks, you can make money with returns and dividends. Returns is that if the stock price of a company you invest in goes up by 20%, you have a 20% gain. As simple as that. And dividends is when companies have profits at the end of the year, they have cash and they don't know what to do with it. They can reward shareholders and pay them. Companies choose whatever dividend they want to give to shareholders. But that's how you can make money with stocks. But you can also lose money. For example, if you have a negative return and your stock, instead of going up 20%, it goes down 20%, well, you have lost 20% of what you invested, of your principal. And a stock can become worthless and the stock price can go to zero if the company you invest in goes bankrupt. And over 200 years, the returns have been quite different. For example, I have a chart here since 1802, and for more than 200 years, stocks have generated a 6.7% return. That's the white line. And in comparison, bonds have generated 3.5% returns. That's the purple line. So that's why I said in the beginning that on average, stocks go up by 7%. It's because over 200 years, stocks have been generated 6-7% per year in comparison with bonds generated 3 or 4% annually. Okay, so we've talked about stocks in general, and I have to introduce the S&P 500 index, which is the main index of the American businesses. It's a basket of the 500 leading publicly trading companies in the US. So if you want to invest in American stocks and not lose your time with stock picking, you just want to invest in America, invest in businesses, American businesses, well, you can invest in the S&P 500 and have your 7% interest per year. That's the most simple way of generating wealth over time. If you don't have time to pick your own stock, pick your own portfolio, well, just invest in the stock market. Every month, just put money in the S&P 500, and on average, you will have 7% per year. Okay, now I have a list of the 500 companies in the S&P 500. You have big companies like Apple, Google, Costco, Nvidia. Every big business that you are aware are in this index. Okay, so I come back to this chart where stocks have generated better returns than bonds that have generated better returns than the dollar. And if you look at the blue line below, you can see that the dollar has lost value over time. And that's because of inflation. People know inflation, they say prices go up. But the real cost of inflation is very subtle. And $20 of groceries in the past is not worth the same as $20 of groceries now. You can buy less and less with $20, and that's the price of inflation. That's a main argument why you should invest with high returns instead of letting your money slip in your bank account, because time is not your ally if you don't invest your money, because $20 in the future will not be the same as $20 right now. What's crazy is that over time, this loss of purchasing power compounds negatively. That means that in the past, $1 in 1913 had the same buying power as $26 in 2020. That's a big change, and if you don't want to lose your purchasing power over time, you have to invest. And let's look at this graph. Now, what has generated the best returns here, you can also see this in this graph, is the S&P 500, is American stocks. So the takeaways here is that you have to invest to preserve your wealth. And stocks have been the best way to increase your wealth over time. Better returns than real estate, better returns than bonds. That's why this course will be about stocks. This is your best chance of generating long-term wealth. Now let's go through the course curriculum to see what you will learn in the 5-week course that you started. In the first week, and we just started now, we'll have the introduction to investing, the basics of how the stock market works, the definition of some terms, and how to define your path to be on track and generate wealth over the long term. For the second week, we will do deep dives, in-depth stock analysis, how to do the work precisely and not be mistaken, not fall into traps. For the third week, we will see investing in special situations. In the stock market, sometimes there are anomalies, and you can take advantage of these anomalies and generate very high returns. The fourth week will be portfolio optimization, how you can manage your risk and how you can improve the returns for the same amount of risk of your portfolio. That will be everything you need to know for portfolio optimization. I think it will be very important, and that's how you will become confident to invest for the long term. You have to believe in your portfolio. You have to create a portfolio that fits your style, and that's in line with the final module at week 5. Find your investment style. After everything that you will learn, you will know what you like, what you don't like, and you will have defined your own strategy. Okay, I like dividend stocks. Okay, I like value stocks, growth stocks. We'll go through everything so that I can help you build the portfolio of your dream that will generate a lot of money for you, a lot of wealth, and that's very important to find your style. If you have a portfolio that doesn't fit your style and your mindset, well, you will not sleep well at night. You want to have a portfolio that fits your personality, and that will be part of the courses we will have week 5. Okay, so let's start with week 1, introduction to investing. First, we'll have a welcome video. Well, this is this video. I have shown you my results and told you why invest and why invest in stocks, and we will see how to get support in the community, etc. We'll also go through the basics of the stock market and how you can master the basics, like understand market cycles, setting smart financial goals, understanding financial freedom and how the stock market can help you reach financial freedom. We'll also go through stock selection. How can you generate ideas, understand stock screeners, basically how to select the best investment ideas, even if you have no previous expertise. We will also have a class on portfolio building, how to build a resilient portfolio that will generate high returns. This will be both easy and fun, so that you can create, if you're a beginner, for example, your first portfolio, be at ease with investing and start your investment journey. We will also have a class on risk management, how to invest in an uncertain world. With the current macroeconomic situation, with geopolitical conflicts, issues, you have to be aware that the stock market can become risky. You can get more money, but you can lose your money. This risk management class will improve your portfolio in that sense. You want to be prepared for this because everything can happen in the stock market, especially in the short term. We will also have a class on stock analysis. So how to analyze key financial ratios and fundamental accounting. All the key metrics that you have to look at to see if this is a good stock or a bad stock. If the company is profitable, if the debt of a company is really high and this is a burden for the investment, all the key metrics that you have to be aware of to build your portfolio. And finally, we will see different investment strategies, how to refine your investment style. This will not be as deep as the week 5, but you will have some views on how to adjust your portfolio, see the different styles of investing that exist. It will be very important for the week 5, for the future. So maybe this is the most important class. Now let's see some important things to remember. You don't know what you don't know. How much is that costing you? Maybe this is your first time investing in the stock market, and all the time that you didn't invest, this is a real cost. This is a real opportunity cost, because as I said, in the beginning, you have to invest as early as possible. So you don't know what you don't know, and you will learn a lot of things in this course. You have to seek constant improvement and follow the steps to have more knowledge about the stock market and take advantage of it. Don't forget that it's all up to you. You're responsible for your results. I will give you everything I know how to invest in the stock market, but you must act on it. That's your responsibility. And if you don't work on it, you will not reach the financial freedom you deserve. Also, these strategies are simple. The whole process is simple. Investing is simple, but it's not easy. You must embrace the resistance. Remember that the plane takes off against the wind. Sometimes you will have a lot of information. You have to digest it, work with it, and once you combined everything from the 5 weeks, of course, you have to do the work. Speed is perfection, and nothing happens without action. You can just binge on these videos, watch everything, learn everything. That's even more important. You have to take action and invest for yourself. Try with a couple of $100s, a couple of thousands, small amount of money, and that you allow yourself to lose it all. Say for a couple of weeks, months, see how you understand the stock market. They say that you have to try it to understand it. Real investing is very different from a paper trading portfolio where you can only see gains over the screen and not feel the loss of your dollars that went away. You have to try it with real money and see if the strategy fits you. Also, it's important to inspire others. That's why in the school community, I have created the hashtag wins, where you can share your wins with other people inside the community. This inspiration will change lives, so do it. It costs nothing. You will get points. You will get bonuses if you share your wins. So if you have some gains, some elements that you want to share with the community, you will get feedback on it, you will get points on it, and this will be a great opportunity to share with each other. About the community, it's important to post quality posts. Make sure to only post quality, well-written posts inside the community. Low quality gets deleted. I want to build a community that will inspire others. So if the posts are bad quality, they will get deleted and the best comments will stay here. I want the best comments to have the best kind of people to join the community so that we can be the best investing community. That's part of a whole process. What's the goal? The goal with this school community is to help millions of people around the world with zero previous investing experience to start investing and grow their wealth using the stock market. I want to make it easy and a fun experience. I'm building this course for the people closest to me, like family and friends. I want to help them start making an additional income with the stock market. The vision with this school community is that I want to see massive amounts of people joining the stock market and getting better at investing. Not trading, not short-term trading, just focusing on the long term and using the principles of Warren Buffett to generate wealth. Seeing people who have changed their lives by investing in stocks, that's great. And that's very exciting for me. But I need your help. I want you in this vision. You're part of this community after all. We need an abundance mindset. There is enough for everyone, enough stocks for everyone, enough ideas for everyone. We can change millions of people's life with this information. But I can't do it alone. I need your help and I need you to share this course. It's very important. And I believe that with this course and this community, you will have access to financial freedom. So you can do what you want, when you want, where you want. You can build a portfolio that you believe in. Support yourself, your family, and loved one. You can become a provider. All of this thanks to the stock market. And it's possible. You can consume the information, but most importantly, implement and take action. That's maybe the most important. Nothing happens without action in this world. You have to join the Q&A calls that I organize weekly, and you have to be eager to learn and just do it. Start your investment portfolio, be present in the Q&A calls, ask questions. I'm here for that. It's completely free. You can come to these calls, ask your questions, and if you don't have questions, just come to this call and listen to the whole conversation. Maybe it will inspire you. Maybe you will get an investment ideas that can benefit you. That's very important, and that's what I like about being part of a community. Now the rewards. There will be rewards for you if you take this community seriously, especially with the hashtag wins. Share your wins inside the school community to inspire others. You can write a post with the hashtag wins tab, and you can get the chance to win 1 year free membership and personal investing coaching calls with me to make it to the next level. That's personal one-on-one calls. You can ask whatever question you want. You can show me your portfolio and I will improve it so that it can fit your style, your investment style. You tell me exactly what you need. I will give you exactly what you need. The only thing you have to do is to post a screenshot or record a Loom video of your investing success. Show other people how much your portfolio has grown. You will inspire others and show other people that it's possible to make money in the stock market. You will be very proud of it. You will get feedback. You will get some advice on how to improve. And that's how you will get a reward. Now let's talk about the school course and the community. The community is here to get help and inspiration. In this community, the Investing Masterclass, the goal is to be the best stock market community, the best investing community. But to have the best ecosystem so that you can improve a lot, we need some community rules. For example, no promotions or job postings are allowed. Don't advertise products or services, not in public or in direct messages. Even indirect ways are forbidden. This will get you permanently banned without warning. We deeply value this community. I have full-time staff policing the community daily. Only create quality, well-written posts. I think if all the posts are of quality, that's how you will benefit the most out of this community, and the feed will be much better, just as simply as it is. It's very high quality posts, very high quality content, and that's how you will get the most inspiration from this group. Also, I encourage you to post your wins, share your success with others, because this is a community for winners. You have to inspire others with your wins and work hard to get yourself on the Hall of Fame list so that you can win 1 year free access to the Investing Masterclass. The goal also with this community is to help each other. If you have an answer to a question, somebody is asking a question, you know the answer, just comment on it. Add a comment and answer to his or her question. You will be rewarded handsomely, because if you like a content, if you comment on a post, you will get points. And if you reach a high rank, you will get exclusive content and a lot of good surprises, a lot of good rewards. So I encourage you to comment each other's posts and to help each other, as simple as it is. Now let's talk about the Q&A calls that will be organized on a weekly basis. So every week I encourage you to prepare a list of questions to ask and share them with the community. That will be a great tool to show your commitment and you will learn a lot. So with everything in mind for this class 1, the big summary is that you have understood the power of investing in the stock market and how the compounding magic can happen in the long term, and you have understood that you have to take massive action. This opportunity is now hotter than ever. Investing will change your future, so you have to capitalize on it. Invest as early as possible so that you can generate wealth over the long term and reach financial freedom. Finally, I encourage you to leave a quick testimonial. It's very easy to do it and it's free so that you can win special prizes. It's in this link that will be below this video. You just have to click on it and it will show you this page with very simple questions. You just have to click on one button and answer these simple questions like who are you, why did you join, what did you learn. It's very easy and quick to do, and that's how you will get special prizes. And that's it for the first class. Now let's get to work. I see you in the next lesson. Hi everybody and welcome back to the second class of the Investing Masterclass. Today we're going to talk about the fundamentals of the stock market and everything you need to know to be prepared, to have a plan before you invest. Let's start right now. Here is what we're going to cover in this video. We will see the foundational investing terms, so the basic words in investing, so that we will have a foundation and everything will be built on this word. So in order to not get lost, I will explain these terms. We will also see the stock market cycles, and I will teach you how everything in the stock market is a cycle, a bull cycle, a bear cycle, and history rhymes in this industry. So you have to understand how everything works. I will also teach you the differences between long-term investing and short-term investing. This is really important. And I will teach you how you can set smart financial goals, because you have to understand yourself to understand what your portfolio will look like. Your style of investing depends on your risk tolerance, and that's also why we will cover the risk and reward of investing. It's really important. And finally, we will see the emotional part of investing that you have to be aware of before you invest. Okay, just before we start, I encourage you to follow my YouTube channel, to subscribe, to have some exclusive content. I'm sure you will love it, to have some real-time portfolio decisions, investing decisions. I also encourage you to follow my Instagram account and TikTok account for some investing knowledge from the great investors, Warren Buffett, Charlie Munger. Also, please share the course. It's very important that you share the course to your friends if they want to learn how to invest, so you can create a better community with more people, more interaction, more knowledge, and this will be very beneficial for you too. A bit of warning, this is the most important video of the entire course. So watch the entire video, don't skip and don't fast forward. And if you want to go faster, the pro tip is to watch the video at 2x speed. Okay, so let's start with the most common investment terms. It's really important that you know them because we will use them more and more as the time passes, as the classes advance. So it's really important that you are familiar with these terms. Let's start with what a stock is. It's a partial ownership of a public business. For example, if you own a share of McDonald's, you have 0.0001% of McDonald's. That's the main thing you have to understand about what a stock is. The portfolio is a basket, of assets. So it can be a stock portfolio, so a basket of stocks. If you have 10 stocks, it's a collection of 10 stocks. You have a stock portfolio. A stock market index is a list of stocks that represent a whole market, a whole sector, an industry. For example, it can be the S&P 500 for the leading 500 American businesses, or another example is the CAC 40 for the leading 40 French businesses. Okay, now a dividend is a reward paid to the shareholders for their investments in the company's stock. That's at the end of the year, a company has some cash and doesn't see reinvestment opportunities, so they reward shareholders, they give them cash. Generally, the dividends are paid every 3 months, but it can be also every 6 months or every year. It depends on the company, but generally every 3 months. Also, I will add that not all companies pay dividends. If they think that they have more reinvestment opportunities and all the cash that they have at the end of the year, they want to reinvest it, well, they will reinvest it. Take, for example, Google. The company is called Alphabet, and they don't pay dividends. They just reinvest in the business again and again and again. On the contrary, you see businesses that don't see reinvestment opportunities, and they say, okay, at the end of the year, we have some cash and we will pay a big dividend to shareholders. So you can have a dividend yield of 7%, 8%. That's a strategy that companies make at the end of the year. What do they do with the cash? Now let's talk about return on investment. The ROI is a measure of how much money an investor has earned or lost on an investment relative to the amount of money that was initially invested. If the stock that you bought went up 20%, your return on investment is 20%. If a stock goes down by 20%, the return on investment is negative and it's minus 20%. Okay, let's continue with what a risk is. It's the uncertainty with respect to your investments that can negatively impact your financial welfare. Basically, what can go wrong? Your investment value might rise or fall because of market conditions. The big risk that you have to be aware of is the permanent loss of capital. So losing everything you have, losing 50% of what you have, because a lot of problems in the stock market are temporary. We've seen it with the pandemic, where we had a big crash and then everything rebounded really fast. So that was temporary, but for the people that sold their positions at the bottom of the crash in 2020, well, for them, it was a permanent loss of capital. That's the biggest risk. Finally, commodities are goods that include agricultural products like metals, oil, natural gas, coffee, etc., etc. Not because I want to teach you how to trade commodities, it's just that some companies deal with commodities, for example, natural gas companies, oil companies. So now we have the big picture. Now the stock market has two types of markets, a bear market and a bull market. It's a cycle and things go up and down, basically. You have a bear market with a lot of pessimism where markets go down. The official loss that you need to be an official bear market is a 20% loss. For example, if the S&P 500 loses 20% of its value, then you can officially say it's a bear market. Well, the bull market is the opposite. It's optimism. It's if an index or a stock rises 20%. So you have two types of markets, but they operate very differently. For example, in these slides, you can see that bull markets are much longer than bear markets. The blue lines are bull markets. The orange lines are bear markets. What they say is that in bull markets, you take the stairs. In bear markets, you take the elevator. It's really brutal most of the time. And this phenomenon of cycles has happened for centuries. It's not recent because it's part of the human mind of being euphoric or very pessimistic, and the stock market participants are humans. Even though you have algorithms now, well, people that operate the algorithms, they are humans, so they have emotions, and the future will look like this also. You will have cycles, really strong bull markets, really strong bear markets is part of the life, and you have to be aware of this. And this phenomenon of cycles in bull market, bear market, well, every time you have a cycle of emotions, and that's why you have these cycles. It's because the human brain goes from optimism to euphoria, where everybody gets into a stock, into a sector. We've seen this phenomenon in 2000 for the dot-com bubble, and then the bubble pops and everybody panics, and there is some capitulation, some depression, and then optimism again. That's part of the journey, and you will go through every emotions you see here, and you will most likely say these sentences of feeling great about an investment, of saying markets are just for me. You have to understand that it's part of the process, and even if you're aware of this risk, I'm sure you will say these sentences. Okay, but these cycles are not smooth. In these slides, you can see that the ride up, the bull market, can be very strong, and you can double or triple your money very fast if you're in a good stock or in a good industry, a good sector. It is also truth that in this situation, this bubble situation, you can lose your money very fast also. And investors in the stock market tend to panic very fast. So the sentiment can shift very quickly. Now that you are aware of these risks, you have an edge if you invest for the long term. All this phenomenon of bubble and irrationality and emotions, that's things for the short term, for days of investing, weeks, months. If you think about years, things get smooth, and all the small change, up down, bull market, bear market, if you think of years and decades, well, you will only see the prices go up. You will not worry about short-term fluctuations. That's very important because if you see the media, the news, they will talk 99% of the time about the short-term fluctuations, short-term moves. What did the S&P 500 do today? What did the Dow Jones do today? These news and these drama are part of the stock market. But again, if you think investing for the long term, in years, decades, you will be much more emotionally stable, and that's better for you. Benjamin Graham, the father of value investing and Warren Buffett's teacher, said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. What this means is that in the long term, the intrinsic value of an investment emerges. In the short term, everything can happen. But if you do your fundamental analysis right, and if you say Starbucks stock is worth $200, if you do the work, well, the price of the stock will reach its intrinsic value. But you will see that after years, not after weeks or months. You will have to be patient. You have to be patient, and you have to set smart financial goals, because every investor is different and you have to know yourself. So before investing, have a plan. You need to have a specific goal. What do you want out of the stock market? You have to state what you will do to reach your financial freedom. Your goal must be measurable. So provide a way to evaluate with numbers what you will reach. Do you want a portfolio that will reach 5% annually, 10% annually? what is the return that you want so that you will sleep well at night, knowing that your portfolio works for you. But you also need to be aware that you will not reach 30% annually for 30 years. That's very, very hard to do. So your goals must be achievable within your scope. If you're a complete beginner, don't expect 20% per year. If you're at an advanced level, you can be more optimistic and reach more than 10%. But you need to have specific goals that are reasonable to your level. At the beginning, start small, and you can increase your risk appetite over the years to have more returns. Your goals must be relevant, so make sense with your job function. If you don't have the time to study stocks and study market, maybe it would be better for you to just invest in the S&P 500 index, because these analysis of stocks and markets, this is very time consuming. So be aware of this. And finally, your goal must be time bound. State when you will get it done. Do you want to build a portfolio in 1 week, or do you want to study first and after 3 months you will create your first portfolio? Some people want to create their portfolio and learn along the way. They just start with some stocks, and as they started investing, they continue learning and learning and learning. But for other people, they wait some weeks, some months before taking action. That's part of your strategy. And you have to know yourself what kind of person you are before you invest in the stock market. And these smart letters are important to have clear goals to guide your investment strategy. For example, some people, they want 25% per year. Some people want 5% per year, but they don't want to lose money. The big question that you have to ask yourself is, what is your risk tolerance? Are you a type of person that is risk averse, or do you want big returns? You have to know yourself, because if you're risk averse and you start to invest in risky situations, well, you will not sleep well at night. And I want you to sleep well at night. If you're risk averse, for example, the solution would be diversification. For example, instead of having 10 stocks in your portfolio, just have 50. So when a company goes bankrupt and the stock goes to zero, well, you have 49 other stocks in your portfolio, and the risk allocation is minimal. Another tool to have a risk averse portfolio is to only invest in safe companies that don't have debt. And if you don't have debt, well, you can't go bankrupt. That's part of being a safe company. You want to invest in strong, profitable companies that generate a lot of money, that won't go bankrupt. That's part of being a safe company. If you're risk averse, that could be a strategy. But also, if you're not risk averse, but you don't like very, very high risk, well, you can have a 50% safe, 50% risky portfolio. That's average, and you see how it goes. What is really important that you understand is that volatility is not risk. Risk is the permanent loss of capital. And volatility is just when stock goes down and up and way down and way up. And it's okay if you don't buy and don't sell, you just hold the stock. Well, it can go up and down. But at the end of many years, it will be at the same position. It doesn't matter. If it's a risk, if you think you can panic, and if it goes down by 40%, you think, okay, I'm out, and that's a permanent loss of capital. Volatility is not risk. Volatility is part of the investing game. And if you think a stock is worth 200 and it has high volatility, the stock goes down by 40%, well, you have a discount. You can buy more of this stock because it's cheap. So volatility is not risk, it's an opportunity to buy at lower price. If you're confident in your strategy and you think the intrinsic value of a stock is $200. Also, in general, big returns often come from risky stocks, but not always. You can make a lot of money and have some great returns investing in okay company, in fair companies. If, for example, if you're lucky and you invest in a normal company and somebody buys out your company, the stock goes up, you have a strong return, you've just been lucky, you have done nothing, but that can work in the stock market. Luck happens in the stock market. The best scenario you can have is to invest in a wonderful company that generates wonderful returns. In the next modules, I will show you companies, wonderful companies that have generated 20% returns annually for 10 years, 15 years, 20 years. It happens. And in the next modules, I will tell you how to identify these companies so that you can also invest in these companies, wonderful companies. And if you're in the lucky situation of being an owner, a stock owner of these companies, well, you don't need to diversify. You just need 5 stocks. You just invest in 5 wonderful companies and sleep well for 20 years. That's part of some investors, some big investors have done this. Finally, if you want to have more returns and you are ready for more risk, psychology is very important. The most important organ is not the brain, it's the stomach. Once you have done all the accounting, you have done the valuation, the intrinsic value, you say, okay, this stock is worth 200. I buy it at 100. It's an easy double, and the stock goes down by 50% day one of your stock holding. Well, it makes you think about, okay, what did I do wrong? What does everyone know and I don't know? The news on TV are terrible. That's part of the game. So I would say that the stock market is 20% brain and 80% stomach. For example, I've taken the performance of 2 stocks over 20 years. Netflix, with the performance since 2023 of 67,000%. That means a 36% return every year on average. CAGR is compounded annual growth return. So on average, it's as if you had 36% per year, 36 for 20 years. That's huge. And also, let's see the returns of Coca-Cola since 2003 that did plus 159%. That's a shy, almost 5% CAGR over 20 years. If you look at this chart, you can see a strong outperformance from Netflix compared to the S&P 500 for a decade, I would say. So it's easy to say, okay, that's a wonderful investment. I should have bought at the beginning. What you don't see is that these can happen. These crash can happen. And this happened for Netflix in 2022, where the stock lost 70% of its value. That means that you can be holding the stock for 5 years, 6 years, and then lose everything because there is some drama, some market news, some events. In 2022, there was a panic for Netflix stock because the growth in subscribers decreased substantially, and that impacts the whole business model of Netflix. That is known to be a growth stock with growth in subscribers count. And when people lost 70% of their investment in Netflix, they just said, okay, this stock is dead, I'm out. You have to be aware of this risk of losing 70% of your investment if you want to take more risk. And in this chart, okay, this is not up to date with 2022, but I think you get the idea. This 70% crash didn't happen once. It happened in 2005 with a 70% loss. It happened also a bit before in 2022 with also a 70% loss, and in 2008 a 50% loss, and in 2012 a 80% loss, and now in 2022 a 70% loss. Looking at the rearview mirror, you can say, okay, it was a wonderful investment. I should have bought more Netflix at the beginning. I knew it. But are you willing to suffer for years after the 80% drawdown? It's just brutal, and that's part of investing in risky businesses, growth businesses, sexy businesses. You have to be aware of this risk because this will happen again and again and again. In 2000, Amazon was a great company growing really fast, not the Amazon we know now, but there was a lot of hype around the stock. Everybody wanted to invest in the next new thing. And when the dot-com bubble popped, Amazon stock lost 90% of its value. I think it was 97% of its value. And in the letter to shareholders at the time, Jeff Bezos said that even though the stock lost more than 90% of its value, the business is growing fine. There was no fundamental issue. Revenue is going up, the number of customers is going up, the logistics are getting bigger and bigger. Everything is doing fine at Amazon. It's just that the markets were very euphoric at the time, and Amazon shareholders suffered a 97% loss. Imagine losing 90% of your investment in 1 year. That's almost unbelievable, but it happened in the past and it will happen in the future. And these sell-offs happen for sometimes emotions of the stock market, typical cycle, bull market, bear market, market sentiment, etc. But sometimes it happens because of a fundamental change in the business. For example, in 2011, 2012, Netflix had this problem of a decrease in subscribers growth. Same in 2022. Sometimes there is a little something that grows into an enormous fire, and the whole market sentiment about Netflix changes, and they just say, get me out at any price, get me out, can get me out. And it goes really fast. So the big question is, if you want more returns, more risk, are you prepared for volatility? If you compare Netflix performance, 36% per year, and Coca-Cola's performance, which is 5% per year, well, you have two types of investment. One with high volatility, where you must survive and hold for years, and one with low volatility, with stable returns, generating 4.6% per year, where you can sleep well at night. Some people prefer investing in safe companies, and I completely understand that. They don't want to lose their hair about investing in the stock market. And one of the best investors of all time, Peter Lynch, said that the key organ here is not the brain, is the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it? Because if Netflix, for example, starts to lose subscribers, numbers of subscribers, it will be everywhere in the news. It will be on the Twitter feed. It will be everywhere. And you will see your investment losing 60%, 70% of its value. So maybe you believe in Netflix, you believe in a strong management, you believe in the vision of the company, but everybody around you will say that it's a very bad business. It's a horrible business. Market experts on TV will say very bad things about Netflix. Everybody will get pessimistic, and the stock price continues to go down and down. You have a minus 80%. And again, the people on media start talking about, okay, Netflix is dead. You have some big titles. Netflix is dead. You have to be aware that this will happen to you in the future if you want to invest in risky companies. And you could say, I just buy more when the stock goes down. But remember, nobody can predict the stock market and nobody can time the stock market. It means that you can say, okay, I'm a shareholder of Netflix. The price goes down by 50%. I just buy more at this time. And then It can only go up because it happened many times in the future, etc., etc. Well, for this 2022 crash, for example, the stock got cut in half and then continues its downward pressure down to 75%. So again, it got cut in half again. So even though your starting point is cheap, it can also lose again 50% of its value. You have to be aware of this. Nobody can time the stock market. Nobody can know when the stock will go up again. And nobody knows if the stock will go up again. There are a lot of companies that were growth, sexy businesses that went down 80% and never bounced back because management had some issue, the company had some issue, there were other competitors that ate their meal, and you will see people on TV make forecasts. They will say, okay, Netflix is at the bottom, the stock is at the bottom, now it will go up by 20% in the next year, etc. They will continue to make these forecasts because people like hearing people making forecasts. They like, if you're a shareholder of Netflix and you've lost 80% of your money on the stock, you like hearing an expert say good things about your company. That's reassuring, but that's pointless because nobody knows what will happen in the future in the stock market. The best investor in the world, Warren Buffett, doesn't attempt to forecast the market. He says that his efforts are devoted to finding undervalued securities. He analyzes businesses and tries to find cheap stock. He doesn't try to predict the stock market. He doesn't try to understand how the stock will react 1 week from now, 1 month from now. He says it's pointless. So if the best investor in the world, the god of investing, says that it's pointless to do forecast, well, my advice is don't try to do forecast. It may be fun, okay, but completely pointless. Warren Buffett also says, I have no use whatsoever for projections or forecasts from other people. They create an illusion of apparent precision. The more meticulous they are, the more cornered you should be. We never look at projections, but we care very much about and look very deeply at track records. If a company has a lousy track record but a very bright future, we will miss the opportunity. What he's saying here is that if a management, take for example Netflix, if in the past management has taken good actions when the stock went down 80%, if the management was resilient and responsible and very competent at what they're doing, that's a good track record. It means that management doesn't panic, and despite all the market fluctuations, the business is still strong. Well, you have a good track record. That's what Warren Buffett is interested in. If you have a very bad track record, a change in management every year, some irrational decisions from a company, that's a bad track record. If the revenue in the past are going down and down, the earnings of a company are going down and down, that's a bad track record, and Warren Buffett is not interested in this kind of investments. In this module, we will try to emulate and learn from the best investors in the world. So we'll clone their strategy. If they focus on track record, we will focus on track record. That's part of the game to be a better investor. I believe that if you copy Warren Buffett in everything he does to invest in the stock market, you copy his strategy, you can only improve. And that's why you're here. The important things to remember is that you can't time the market. Everything can happen, but you can take advantage of volatility with a consistent method. Let me introduce the dollar cost average, or DCA. It's amounts of money that you put in the stock market every month, every year, regardless of valuation, regardless of price. If you think Netflix is a good business, just say to yourself, okay, I'm putting $1,000 into Netflix stock every month. And as you see in this chart, if the price goes down and you buy Netflix stock, well, with $1,000, if there is a discount, you will be able to buy more. If the stock price goes up and you buy at this time, well, you will buy less stock with $1,000. Again, if the stock goes down, you will be able to buy at a discount. So with $1,000, you can buy more groceries, more Netflix stock, and again and again and again. So you just separate yourself from the emotional part of investing and you invest consistently. It's easier said than done because a lot of people try this and they wait for the market to go down before investing. So my advice is to do it automatically with your brokerage account, with your bank. You say, okay, every month this will happen. So you don't have to log in the platform and do it yourself. You remove your emotions from the equation. And this DCA method gives you low stress. And that's the key to success for a lot of people. You just stick with the plan, no matter what the market does on a particular day of week. You don't panic. Every first of the month, you just buy something. That's it. Okay, so let's do the summary. You have understood how the market cycles work. The bull market, bear markets, everything happens in the cycle, history rhymes, etc. You have understood that you have to know yourself and you have to know your risk tolerance to see what kind of investment strategy will fit you. Also, it's important to set realistic goals for your future so that you can reach your objective and have a plan for this. And you have to be prepared to hold through volatility. It can happen and it can be very painful, so you have to be prepared for it. And that's it for this class. I see you in the next lesson. Welcome back to the third class of the Investing Masterclass. In this video, I will teach you how to find great stocks. It will be very important because now you have understood why you have to invest for your future and reach financial freedom. And now I will give you the tools, what you have to look to select your investment in order later to build a strong portfolio that will make you rich in the long term. But you need the tools. You need to understand the financial metrics so that you can create a strong portfolio with strong companies and companies that are run with competent management. Here is what we're going to cover in this video. We will see how to generate stock ideas and build a successful watch list. But before we do that, we will see the key criteria for selecting individual stocks. And we will go through everything you need to know, the things that are important, the other metrics that are not important, so that you can build a successful watch list. You will also learn the common mistakes to avoid when picking stocks. That can be mistakes about financial ratios. For example, a company can have strong financial ratios, but the business can be bad. So there is a mismatch between the information you see and the reality, and you have to know this kind of mistake. And you have another kind of mistake, much more psychological, that you have to know, have to be aware of, because as I said in the previous video, investing is 20% brain, 80% temperament. So there will be plenty of traps that you have to avoid along the way. We will also see what makes stocks go up over time. There are key metrics, certain metrics, financial metrics that you can monitor over time. And if these metrics go up over 20 years, your stock is almost certain to go up over 20 years. You have to monitor these key metrics, and I will teach you how to do it, which metrics to look at, etc., etc. We will also go through the basic valuation tools to find deals. When you have understood everything about a business, understood the key financial metrics, you have to put a price on it. You have to do a proper valuation, and I will teach you the tools how to do it in order to understand if a stock is cheap, if it's a deal and it's in buying territory, or if it's expensive and you just have to wait and not buy an expensive stock. I will also teach you the most important competitive advantages. In the stock market, there are thousands of businesses and there are many industries. In each industry, you can have several competitive advantages that will allow your business to thrive. If you buy, if you invest in a stock that has competitive advantages, that has a moat, as we say, well, your business is protected against competitors and your business will have higher margins, higher return on investment, and there is a high probability that this will be a good investment for your stock portfolio. So you must understand competitive advantages so you can maybe build a portfolio full of companies that have strong competitive advantages. That's a strategy that you can have, but you have to understand how it works and how it can evolve over time. And finally, we will see the circle of competence. This is really, really important. You have to know what you know and what you don't know. You want to invest in businesses that you can fully understand, and you want to build a portfolio of companies that you fully understand. If you don't understand an investment, if you don't understand a company, an industry, that's how you can make basic mistakes. That's how you can make mistakes. And you want to avoid these traps. You have to stay inside your circle of competence. This is easier said than done, and I will show you how it works. So, as always, I encourage you to subscribe to my YouTube channel, which is also Christophe Noor, and follow my accounts on Instagram and TikTok for more exclusive content. There will be more and more exclusive content, and I want you to take advantage of it and subscribe to this account. Share the course. This is really important. And if you have some friends or family members that want to build wealth through the stock market, share the course. Share the course, it's really important. A bit of warning, this is the most complete video in the entire course that will add so much value to your expertise of the stock market. I'm sure of it. That's why I'm very happy to do this video. It will be the longest video of the entire module, I'm sure of it. So I highly encourage you to watch the entire video. Don't skip, don't fast forward, and you can watch this segment of the entire course. You can watch it twice because this will be where you will get the most value out of this course. Okay, let's start right now. You have a rule in the stock market, a rule of always looking for the best opportunities in a huge pool of opportunities. Because in the stock market, you have thousands of stocks, thousands of businesses. And if you want to build a portfolio with 20 stocks, well, you have to look for the best 20 opportunities that you can see over thousands of investments. And that's why one of the best investors in the world, Peter Lynch, said, searching for companies is like looking for grubs under rocks. If you turn over 10 rocks, you'll likely find one grub. If you turn over 20 rocks, you will find two. The person that turns over the most rocks wins the game. That's really important that you understand that. You will not find the best stocks in one day. If you look at 10 companies, the 10 companies will not be great investment opportunities. If you look at 1,000 stocks, well, you increase your chance of finding gold. Basically, that's the point. You have to keep looking again and again and again. And if there are more than 50,000 stocks in your investment universe, well, you can look for hours and hours. It's a long process, and in this video, I will teach you how you can do it so that you can have a simple process that you can follow and find the best investment opportunities. But it's important to have patience. And if you look at thousands of companies, you can build a very, very good portfolio because you will have found the best opportunities over thousands and thousands of opportunities. So that's the game of quantity over quality. That's part of the game, and you have to understand this. You will need patience in this stock picking game. The goal with this method is to build a list with great stocks that you know well. You have to understand them, that they are in your circle of competence. you understand the business, okay. The next step is to put a target price to these stocks and you monitor them from a distance. For example, if you have a stock that you like, that you know really well, you understand the company, you understand the competition, you understand the competitive advantages, you put a target price of $100 and the current price in the market is $150, well, it's too expensive. So you don't want to buy at these prices because there is some euphoria and it's too expensive. So you monitor it from a distance. And when the stock falls for some reason, go back to this list. And if your thesis is still valid, if the price is within your price target, you buy. The goal is to build a watch list of dozens of companies. And once you have built the watch list, you put a target price for each of them. And when there is a market crash or for another reason or for a temporary problem, you go back to this list and you see, okay, if the business is still good, still in shape, and this is only a temporary problem, okay, but the price dropped. Is it at my target price, below my target price? If it's below your target price or at your target price, that's the time to buy. The time to buy is not when the stock is flying high and expensive. You want to buy it at a fair value or cheaply. So sometimes you need a lot of patience because stocks can be overvalued for a long time. So that's why the third point is really important. Write down a target price and wait. And you wait for the good moment. It's like in baseball when you wait for the good moment to strike. And that's exactly the same situation here. You have to be patient, and when the price is right, you buy. So the main point with this strategy is that you have to be patient and you need few bets, big bets, infrequent bets. You don't want to buy every week the stocks. You don't need investment opportunities every day. You just build your watch list over time. And when there is a stock crash or for any reason, you strike big. You hit the ball very hard and you pounce on opportunities. As Warren Buffett says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. You want to be patient? Okay. But the best investors in the world, if you look at them, they are patient for years and years, and they wait for the good opportunities. And when there is a recession like in 2008, they invest all their portfolio because there are deals everywhere. So, but the work has been done before. The watch list building has been done for years and years before that. For your situation, if you're just starting in the stock market, you don't need to wait a few years. Just start investing small, but for the big opportunities, if you like a good investment, but it's just too expensive, be patient. You will have your opportunity. The stock market can be irrational for many reasons. So if you're patient, that's how you will have the best gains in the stock market. Now let's see how to pick stocks. To pick stocks, you have to see if this is a good company or not. That's some basic knowledge. You don't want to invest in bad companies. You will get disappointed really fast and you will lose money really fast. In order to have the best gains over the long term, the best way to do that and to reach your financial freedom is to invest in great companies with great management. But you need fundamental analysis to evaluate a business. If you don't understand basic accounting or how to analyze financial metrics, you can't do the proper work. You can't say if a business is good or not. So you have to understand the key metrics. In this free course, we will go through the most important metrics you need to know so that you can make good decisions and build a strong watch list. And if you want to go deeper, I encourage you to join the school community where we will do the complete analysis of every metric. For example, the accounting metrics to see hidden value. Sometimes a stock is cheap and you see the cheapness in plain sight, but sometimes you have to dig deeper and I will teach you how to do it. Okay, so let's start talking about financial metrics. When you analyze a stock, there are many variables, and it's easy to get lost because you have some specific terms, specific numbers, and sometimes the math can be quite complex. We will take it slowly, calmly, and step by step, you will understand everything how to analyze a stock. First, when you analyze a company, you have to analyze three things at the very beginning: the balance sheet, the income statement, and the cash flow statement. These three elements will teach you if a business is profitable or not, if it's healthy or not, if it has cash or a lot of debt, and it's really important to understand how everything works. Let's start with the balance sheet. The balance sheet shows you what a company owns and owes. In a specific time, you can look at a company and see the cash level, the debt level, the assets, the liabilities. It has several parts. It's divided into five elements: the current assets, the long-term assets, the current liabilities, the long-term liabilities, and separately, shareholders' equity. The balance sheet is based on a simple formula: assets equal liabilities plus equity. We will see later how it works, but let's first go through the other statements. The income statements shows you the revenue and expenses of a company. That's where we will find the revenue, the costs, the margins, the tax rate, the net income. So that's all the calculations, all the operations that you have between the revenue at the beginning to the net income at the end. And finally, the cash flow statement shows you the cash that enters and leaves the company. That's the flow of cash. The cash flow statement consists of the following elements: cash flow from operating activities, so how the business usually operates. If it's a business that sells shoes, that will be in this part. You can also have cash flow from investing activities, so outside the core area of a business, and the cash flow from financing activities. What do they do with cash? Do they have more debt or do they pay their debt? You have three segments inside the cash flow statement, three separate segments, and with that you can understand how the cash comes into the business and leaves the business. Okay, that's some basic knowledge about these three segments. Let's dig deeper on how to analyze a balance sheet. As I told you, a balance sheet shows what a company owns and owes. And in the balance sheet, you get an overview of three things: the assets, the liabilities, and the equity, the shareholders' equity. The balance sheet is an overview, is a snapshot of a company at a certain point in time. So now let's see what's inside the balance sheet. You have in one part the assets that show you everything the company owns. You can have short-term assets or long-term assets. Short-term assets are also called most of the time current assets. These are assets that can be converted into cash within 1 year. And non-current assets, long-term assets, are assets that are harder to convert into cash. That's things that you can't sell very easily to get into liquidity. And you have a list of the most liquid assets to the least liquid assets. And at the top of this list, you have cash and cash equivalents, which is logical. That's pure liquidity that you have in the short term when you want, and you can deploy these liquidities into whatever operation you want. And if you go deeper into the least liquid assets, you have marketable securities, financial assets, accounts receivable, inventory, plant, property and equipment, intangible assets, and goodwill. The least liquid asset you have is called goodwill. The goodwill is the gap when a company makes an acquisition, for example, of a company for $1 billion, and when they look at their balance sheet of the target acquisition, they look at their balance sheet and the total assets of their balance sheet is worth $500 million. So between the buying price of 1 billion and what's inside their balance sheet, 500 millions, well, you have a 500 million gap. And where do you put it? It's not cash. It's not brand. It's not intangibles. It's not inventory. It's just the premium you pay when you make an acquisition of another business. And the premium you pay, it goes into the goodwill category. So you can't sell it in the short term to have some cash. That's why it's the least liquid asset you can have. Okay, so now let's see the liabilities. It shows you how much the company owns. There is a distinction between short-term liabilities and long-term liabilities. It's symmetrical to the asset side of the balance sheet. You have short-term liabilities, called also current liabilities, and you have long-term liabilities, so also called non-current liabilities. For the short-term liabilities, that's financial obligations that have to be paid within 1 year. Short-term debt, for example. If you have some debt that you have to pay within 1 year, you put it in the short-term liabilities section. And if you have some debt that has to be paid in 5 years, in 10 years, you don't put it in the short-term section, you put it in the long-term section. So you put it in the non-current liabilities, long-term liabilities section. You will have other things inside liabilities. But for the moment, let's just say that the most important thing is debt. In the other part of liabilities, you have shareholders' equity. The shareholder equity shows you how much money the owners, so the shareholders, have invested in the company. This is a quick reminder that when you invest in a company, you have partial ownership of a company. So if you own a stock, you are an owner of a company. You are a partner to this company. And the formula to get the shareholders' equities is total assets minus total liabilities. What is remaining is the equity. There are some great ratios to analyze a balance sheet. And if you look at these ratios, you can determine if a balance sheet is healthy or not. You have the interest coverage that shows you how easily a company can pay back the interest on its outstanding debt. We'll go through the formula after. And you have the net debt divided by free cash flow. That shows you how many years it would take the company to pay down all its debt when it would use all its available cash flow. We will talk about free cash flow after. Just remember that there are ratios that you can look at to see if a company is healthy. We will go through every metric in more details later. This is an example of a balance sheet from Apple in the latest annual report, so 2023 at the time of this recording. The annual report was finished in September 2023, and you see the distinction between current assets, non-current assets, current liabilities, non-current liabilities, shareholders' equity. This is very clear. This is very clear. And you have a line for the cash at the very top, the line for the market securities, and you can see how it has evolved over 1 year of operations. You have in the second column the 2022 numbers. So you can compare year over year how the amount of cash has evolved. Let's look at the debt. On current liabilities, you have a line term debt. So that's short-term debt. And you see that the short-term debt has decreased from 11,000 to 9.8 thousand. And these numbers are in thousands, I believe, if I refer to what's at the top of the document. All the numbers are in millions. Oh no, they are in millions. So you have 11,000 millions debt in the short term that has decreased to 9,800 millions of debt. And That's short-term debt. If you want to look at long-term debt, you go to the non-current liabilities section. You have also a term debt. And you see in 2022, there was $98,000 million of debt that has decreased year over year, decreased a little bit to 95,000 millions worth of debt. Okay, and the shareholders' equities is, as usual, total assets minus total liabilities. Now, let's understand how the income statement works. An income statement is also called a profit and loss account because it will show you if the company is profitable or not. It shows the company's revenue and expenses over a certain period. It can be over 3 months or every 6 months or every 12 months. The income statement provides you with a lot of insights, how much revenue is translated into net income, the efficiency of management, and much more. That's cost management, basic accounting, and you come and you begin from the revenue. So for a company, it all starts with its sales, its revenue. That is the money a company receives from selling its products or services. So it reminds me of YouTube when they ask them how much they make on YouTube and they only focus on revenue. Well, they don't take into account the costs of operations. Well, that's the bigger number, that's the revenue. But you have to subtract the cost of goods sold, the COGS. It shows you all the costs a company makes to produce its products or services. For example, if I make wood tables, well, I first have to buy the wood, and this is a cost. So if I sell you a table for $100, I don't get $100 in my pockets. I have to subtract the cost of buying the wood beforehand that, I don't know, costed me $20. So the cost of goods sold is here $20. And if you subtract the COGS to the revenue, you get the gross profit. The profit of a business makes after subtracting all the costs that are related to manufacturing and selling its products or services. So you have formula gross profit equal revenue minus COGS. Okay, let's see all the costs now, including the operating expenses or OPEX. That's all the expenses a company makes to run its daily operations. So basically, the wage of your employees, the marketing campaign that you pay so that you can run ads, the R&D, research and development inside the company to make better products. Everything that's not COGS, that's not cost of goods sold because that's not raw materials, but that's cost, operating cost. And if you deduct these operating expenses to the gross profit, you get the operating income, which is also called EBIT, earnings before interest and taxes. The operating income shows you how much money a company earns from its normal business activities. So that's important, and later we will focus on the EBIT, on the EBIT margin. It will be very important, and we will see the evolution of operating income over time. After that, you have non-operating income. So that's income and expenses that aren't related to the normal business activities. So you can have a gain or a loss on financial instruments if a company uses its cash to trade or invest in securities that lost value, well, they have lost. The non-operating expenses can also be the gain or loss on foreign currency. If you have operations of your business in other countries and the payments are in another currency, well, the currency can derate, can fluctuate. So you can have a small gain or small loss on foreign currency. You can also have in these cost category interest expenses. So when you have debt and you have to pay your debt in 5 years, the bank tells you to pay interest expenses. Like if you go to the bank right now and ask for a loan, you have a percentage, 3%, 4%. Businesses have the same issue. So this is called interest expense for businesses, and that goes into the non-operating expenses category. And you can have other costs like this, and after all these other costs, you have your income before taxes, which is the operating income minus non-operating income and expenses. It tells you how much profit the company has made before taxes. That's almost at the end of the equation. The tax rate can move, can change year over year, depending on your jurisdiction, depending if you operate in a specific country. If you operate, for example, in Malta, you can have lower tax rate. Some companies take advantage of this and they put their operation in Ireland or Malta. And if you deduct the taxes, you have your net income. The bottom line or net income of an income statement shows you how much money the company has made after subtracting all costs and taxes. The net income is also known as earnings or profits. The net income is the equation is income before taxes minus taxes. That's the profit. That's how much money you make at the end of the year after subtracting all the costs. Let's take an example. Let's see the income statement of Apple. It shows you the sales over 3 years, 3 columns, because they like it, and I think it's clearer to understand their growth like this. So fair enough. You can see at the top of the table the net sales from products and services. You have the cost of sales for products and services. And if you deduct the cost of sales, the COGS, to the net sales, you have what they call gross margin, which is the equivalent of gross profit. After that, you deduct the operating expenses, which are research and development and selling, general and administrative costs. And that gives you an operating income at 114,000 for 2023. With that, you deduct all the expenses and you reach, after some provisions, a net income of almost 97,000. And at the bottom of the table, you see earnings per share. Basically, you divide your net income by the number of shares that are trading in the stock market, the number of Apple shares available. And the result of it is earnings per share at roughly 6. Okay, so you have some stable returns, slightly increasing earnings per share over 3 years. Now let's talk about how to analyze a cash flow statement. We've talked about the balance sheet and how to have a snapshot and understand the finances of a business. We've talked about the revenue, costs, margins. Now let's talk about cash flow. A cash flow statement shows you how much cash goes in and out of a business over a certain period. The purpose of this statement is to track how much cash is moving through a business. Because you can have very strong net income, but a very weak cash flow at the end of the year. So that's why you have the distinction between income statement and cash flow statement. You want to invest in companies that generate cash and manage their cash positions well. That's the point of investing in great companies. Also, I forgot to mention that these slides are provided by Compounding Quality. I love their work and I think it's very clear, especially for beginners. So go to their website if you want more slides like this, but for the white and red slides, that's from their website and I use them because I like them a lot. Let's go back to the cash flow statement. As I said before, the structure of a cash flow statement is based on 3 parts: the operating activities, investing activities, financing activities. For the cash flow from operating activities, this section shows you all cash the company generated from its normal business activities. That's normal operations. If you have a business that sells tables, most of the cash that the company generates through the sale of tables, it will be in this category, operating activities. It shows you all the cash a company earned from selling its normal products and or services. It shows you all the cash a company earned from selling its normal products and or services. The cash flow from operating activities is comparable to net income, but it filters out a few income and expense posts that didn't cause actual cash to enter or exit a company. The main formula is cash flow from operating activities equals net income plus non-cash charges plus or minus changes in working capital. In fact, you can have some costs in the income statement that are not real costs, that not cash-related costs. For example, if you pay an employee instead of real money, you pay it with shares of your company, stock options. Well, cash has not moved. But inside the income statement, that's a cost. That's a salary, that's a wage. But the cash is not really moving. So you have to adjust some numbers in the cash flow statement to really understand how the cash is really moving. After that, you have the cash flow from investing activities, which gives you an overview about the company's investment-related income and expenditures. So the cash flow from investing activity consists of three major parts. The CapEx, the capital expenditures. If you build a new site, a new building, so that you can have more workers and more operations, that's capital expenditures. That's big projects for your operations most of the time. Another part is mergers and acquisitions. If a company A acquires company B, well, this is in this category, investing activities. And if you buy another company, you pay with some cash. So this will be a minus in this category that will be in the investing activities. The other part in this section is marketable securities. So if you have some cash in your balance sheet and you don't know what to do with it, so you invest in stocks with it. So you manage a portfolio of stocks inside a company's balance sheet. Well, the stocks can fluctuate. You can have gains or losses, and this is not at all related to your main operations, to your core operations. If you have a company that sells tables and that has too much cash and they have a stock portfolio, well, if a stock doubles in value, so they have some quick gains, it's not at all related to their main activities of selling tables. So that's why it's not in the operating activities. The main formula is cash flow from investing activities equals sale of marketable securities plus the investment plus divestments minus capex minus mergers and acquisitions minus purchase of marketable securities. Finally, let's talk about the cash flow from financing activities, which measures the cash movements between a company and its owners, so the shareholders, and its debtors, the bondholders. This section gives you an insight about how the company is financing its business activities. And the main formula is cash flow from financing activities equals debt issuance plus issuance of new stocks minus dividends minus debt repayments minus share buybacks. So in this category, you will know if a company has some debt and repays it, or you will know if a company pays dividend or buys back its shares. For the share buybacks, let's go back to the income statement from Apple. At the bottom of the table, you see over 3 years that the number of shares decreased. That's because Apple bought back their shares. Because you can invest in Apple if you think this is a good deal, but also Apple can invest in Apple. They can buy their stock. If this is a good deal for you, this is a good deal for them. If they think the stock is undervalued, they can buy it back. And that's what they do right now. With all these changes in cash levels, cash flows, you have changes in cash balance. You can calculate the total changes in the cash balance. The formula is cash at the end of the year equals cash at the beginning of the year plus cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities. You take the cash at the beginning of the year, you add the three sections, and you have your cash at the end of the year. You have to know that these sections can have negative numbers. For example, if in a specific year Apple pays a huge amount of their debt, they repay their debt, so they pay it with their cash and there is a cash outflow and a big cash outflow. For example, the cash flow from financing activities will be negative in a huge way. So it's not all positive and it's easy to do it. There can be negative numbers, and at the end of the year, you can have less cash than you had at the beginning of the year. And now, again, let's see an example of cash flow statement for Apple. You see at the very top some operating activities. You start with your net income and you do some adjustments. For example, the depreciation and amortization, the share-based compensation expense. To explain, the share-based compensation expense is the stock options. Instead of paying their employees with real cash for their salary, they can pay it with stocks, with Apple stocks. So they take shares, they give them to employees. So that's an expense, yes, but that's non-cash. So you do all these adjustments, short-term adjustments, to reveal the real amount of cash that is moving through Apple. And there are some proceeds from maturities of marketable securities, some sales of marketable securities, payments for acquisition, property, plant, and equipment. And with everything, you have the cash generated by investing activities. And you can see if you compare it with other previous years, there is a big change. It's positive now, about 4,000 millions, but in 2022, it's negative, minus 22,000 millions, and in 2021, minus 15,000 millions. So there is a change in capital allocation, and if you dig deeper, you can understand why in this category. Now let's go through the third section, the financing activities section. You have some payments of dividends to shareholders. You have the repurchases of common stock. That's what we talked about when you can buy back your own stock to decrease your share count. And they bought back a lot of stocks, about 80,000 millions worth of stocks. And after that, they have proceeds from insurance of debt, a small amount. You have a repayment of debt, and you have all the proceeds or repayments of commercial paper. Okay, and at the end, you have cash used in financing activities, which is quite negative, minus 108,000 millions. If you look at the top of the table, you have cash, cash equivalents, and restricted cash beginning balances. So at the beginning of the year, about 25,000 millions. And after everything, all the operations, all the adjustments, all the buybacks, all the dividends, you have 31,000 million, so $31 billion worth of cash. So now you have understood the key information that you can have when you look at a balance sheet or when you look at an income statement or a cash flow statement, and you can understand how the operations of a business can evolve over time. Now we will go through the main balance sheet ratios. So in a few seconds, you can look at these ratios and see if a balance sheet is healthy or not. There are a lot of ratios, but we will focus on the main ones. And I think the most important ones are these ones. Let's start with the working capital. The working capital is a measure of a company's liquidity and short-term financial health. So in the short term, do you have more assets, more liabilities? So you compare the two short-term metrics in the balance sheet, the current assets and the current liabilities, and you see which one is bigger. So the formula is current assets minus current liabilities. And if your current assets are higher than your current liabilities, you are in a safer position. You have more cash than short-term debt, so you can pay your short-term debt with your cash. The current ratio is very similar. Is the relationship between the current assets and current liabilities with a division. So you divide current assets by current liabilities. If you have a ratio over 1, it means that you have higher current assets than current liabilities, and you can weather any short-term negative events. If you have some negative event like a pandemic that will shut down your operation, you can use your short-term cash to pay your short-term debt. You are not in a hurry. Some businesses have very high current ratios. Instead of having 1, they have 5 or 6. They have a lot of cash and very low short-term debt. So this is a very comfortable situation. On the contrary, you have businesses that have current ratios lower than 1. It means that they have low amount of cash and a fair amount of short-term debt. So that could be a problem. And in a few seconds, you can see if the current ratio is below 1 or above 1. Another ratio is the interest coverage that shows you how well a company can pay the interest due on outstanding debt. So you divide your operating income, your EBIT, by your interest expense. And the higher the ratio, the more comfortable the company is. It's much more likely to pay its debt and much more likely to be healthy if this ratio is high. Another ratio that you have is debt to equity. It's a famous ratio. It's used to calculate a company's financial leverage. So you divide your debt by your equity. Because some companies use a lot of debt to finance their operations. And other companies don't use debt at all to finance their operations. But when there is a big problem, the companies that have a lot of debt suffer the most. So you have to know if a company has a lot of debt or not. And you compare the debt level to the equity level to see if this ratio is really high and there is a lot of debt and this could be risky in the future, or if it's low and the company is in a safer situation. Finally, you have the asset turnover. It shows you how effectively companies are using their assets to generate sales. You divide your sales by your total assets. For example, if you have $100 worth of assets and you generate $1,000 worth of sales, you are very efficient because you have very low assets, you don't own anything, and you make a lot of money for your sales, your revenue, your top line. So that's very good news. And you have a return on investment for your assets that is really high. I think with these balance sheet ratios, you can have a very good amount of information to see if the balance sheet is healthy or not, if they have a lot of cash, if they have a lot of debt, are they able to pay their debt, and it will be very useful later. Now let's talk about profitability ratios. And let's first talk about margins. If you remember correctly, in the income statement, the first line of the income statement is revenue, sales. The second line is COGS, cost of goods sold. And if you subtract the COGS to the revenue, you have a gross profit. Well, the gross margin ratio that you see here is the company's gross profit compared to its revenue. So you get your gross profit and you divide it by your revenue and you have your gross margin. Linked to this, you also have an EBIT margin, an operating income margin, what percentage of sales remains as profit before tax and interest. So you divide your EBIT by your sales, by your revenue. And at the end of your income statement, you have your net income. You can also have a margin, a profit margin, a net profit margin, a net income margin. You divide your net profit by your sales and you have a percentage. This is your margin. When you analyze and you compare two businesses, you can compare their margin profiles. If, for example, you have some luxury goods, Louis Vuitton, LVMH, they will have higher margins than, say, a Costco that have much more cost, and the business model is different. Another margin that is important is the free cash flow margin. It shows you what percentage of sales is translated in pure cash for the company. You have the free cash flow divided by sales. And you may ask, what's a free cash flow? Well, let's go back to the statement of cash flows, the cash flow statement. Free cash flow is cash flow from operating activities minus capital expenditures or CapEx. The CapEx is in the cash flow from investing activities. So you take your operating cash flow and you subtract the CapEx. So you have your free cash flow, cash available at the end of the year. The free cash flow is quite important and used a lot to analyze businesses. So the free cash flow margin is free cash flow divided by your sales. Some business generate a lot of cash flow, and some business have huge sales, huge revenue, but generate very little cash flow. So that's different business models. And again, it's very useful if you compare two companies. Now you have the return on assets, which is very simple. You divide your net income by your total assets to understand how profitable you are with your assets that you use. It indicates how profitable a business is in relation to its total asset. Some businesses have very little profit, but they have a lot of assets, so it's not very profitable. And some business, on the contrary, are very profitable with very little assets. These asset-light businesses have huge return on investment, huge return on assets, and usually they are good investment because they have lower cost, etc. This is all linked, and this return on assets ratio can be important, especially for capital intensive businesses. In the same category, you have the return on equity. You divide your net income by the shareholders' equity. And another return is the return on invested capital, which is quite important. It shows you how efficiently a company is allocating capital. So you divide your NOPAT by your total invested capital. What's a NOPAT? It's EBIT, so operating income, and you multiply it by 1 minus tax rate. So you have your NOPAT and you divide it by the total invested capital. We will see that later, but generally it's the assets and the debt that are used to have your business operations. A slight difference from the return on invested capital is the return on capital employed. The main difference is the formula. Instead of taking the NOPAT, you take the EBIT, and instead of having the total invested capital, you take long-term debt plus equity. You remove the short-term debt or other categories of liabilities. Also, let's talk about earnings per share. It's how much money a company makes for each share outstanding. I like it a lot when company talk in per share measures. At the end of the year, you have your net income, and as we saw previously, you can divide your net income by the total number of shares outstanding, and you have your net income per share, your earnings per share. If you do something and if you change the number of share outstanding, it will change your earnings per share metric. So you have a relationship between earnings, but also your share count, and you can manipulate each of them. So you have the earnings per share. It will be very, very important in the future that you understand how it works. And finally, the last profitability ratio is the free cash flow generation. You compare free cash flow and net income. You take free cash flow, you divide it by net income. If you have a ratio of 1, that means that 100% of net income is translated into free cash flow. Some businesses with adjustment in the cash flow statement, when they have $100 of net income, they can generate more free cash flow, $110 of free cash flow. Some businesses, on the contrary, can do less, and with this amount of net income, they generate less cash flow. Well, you have to understand this because businesses are different, and when we will do the idea generation part later, we will see how free cash flow can evolve over businesses, evolve over time. This will be very important, and that's it for the profitability ratios. And if you think that there are a lot of ratios, well, there are more. And that's important if you want to do the complete analysis of a stock. You need many ratios to understand the complete story of an investment thesis. You need a lot of ratios to understand the company's financials, and we will combine all these ratios later to have a clear direction if this business is a good business or a bad business. But we need many ratios to understand and have a full, clear picture of a business. We have more ratios for you. Let's continue with the cash flow ratios and let's talk about the most important ones. Let's first talk about the free cash flow per share. It's similar to the earnings per share that we've seen before. It's just that instead of talking about earnings, we talk about free cash flow. So you have your free cash flow and you divide it by the shares outstanding. That's your free cash flow per share. And as you can see, the evolution of your earnings per share, EPS, over time, over 10 years, 20 years, you can see the evolution of the free cash flow per share over time. That's very similar. Also, another ratio is the interest coverage ratio. It measures how well a firm can pay the interest due on outstanding debt, and you take the cash from operations and you divide it by interest paid. So how comfortable are you paying the interest on your debt? If you generate a lot of cash, well, you will be much more likely to pay your debt. And if you don't generate a lot of cash, well, you have a problem. And this ratio shows you if you have a problem or not. Another ratio is the free cash flow margin that we've seen before. You take free cash flow divided by sales. Another ratio that is also important, especially for dividend investors, is the payout ratio. It's the percentage of free cash flow that a firm pays to its shareholders in dividends. So at the end of the year, a company generates free cash flow. What is the amount of this free cash flow that you pay to dividend? So you take the dividend per share and you divide it by free cash flow per share. Or you can also take the whole dividend payment, the dividend that you pay to shareholders, and you divide it by the free cash flow. They added it uh, a per share metric, but you can do it without the per share metric. So for example, if you have free cash flow at the end of the year, if you have a payout ratio of 30%, it means that 30% of all the cash you generated during the year, 30% goes to dividend. So your shareholders will have 30% of the cash you generated. It doesn't mean that as a shareholder of the company, you will have a 30% yield. That's different. It's just that 30% of the cash that the company generates goes to dividends, and 70% of the cash that the company generates goes into other activities. Now, an important metric, especially for valuation later, is the free cash flow yield. It's a metric that shows you how cheap or expensive a company is valued in terms of free cash flow. You take the free cash flow per share and you divide it by the stock price. It's how much the free cash flow is compared to the whole company. If the free cash flow yield is 10%, it means that the free cash flow of the company is about 10% of the whole company. And the higher, the better. Finally, you have the free cash flow per share growth, which is only the evolution of free cash flow per share over time. Let's do a quick break to make sure that you have understood everything from the previous slides. We've seen the balance sheet, which is a snapshot of a company at a certain time with assets, liabilities, equity, and it answers the question, is the company healthy? What is the cash level? What is the debt level, etc., etc.? what is inside the company at a certain point in time. We also have the income statement. So in a period of, say, 1 year, is the company making money? Is it profitable? What are the margins? What are the costs? What are the expenses? And what is the evolution of these margins over time? Because you can see an income statement for this year and you can compare it with the previous year and then the previous year. And over 3 years, 5 years, 10 years, you have the evolution of the margins over time. Is the business getting more profitable with higher margins over time? Or is it the opposite and it's getting worse and worse over time? It also happens, but now we understand how it works. Margins, cost, revenue, sales, net income, all the key metrics. And finally, we've seen the cash flow statement. Does the company generate cash? What is the flow of cash? The actual cash that the company uses to finance operations, to have more debt, to reward shareholders with dividends. What do they do with the cash? That's the big takeaways from the balance sheet, the income statement, and the cash flow statement. Now, if you look at the biggest investors in the world, they look at specific ratios. For example, Warren Buffett selects companies according to certain criteria. He doesn't have a strict plan. It's just that most of the investment that he made over his lifetime, they had similar metrics, similar ratios. So you can take the average of these ratios and have a plan that is similar to Warren Buffett's plan. Here are the ratios. For the income statement, he likes to have gross margins of a business above 40%. For the SG&A margin, you have less than 30%. So SG&A are marketing, wages, R&D costs, all this stuff. For the R&D margin, talking about R&D, you have less than 30%. You have other metrics, and I would say that the most important ones are the net income margin that has to be more than 20%. In other words, the business has to be profitable with high margins, and the net income margin has to be high and growing over time. That's the best case you can have. The EPS growth, the earnings per share growth over time, must be positive, so the company must be making earnings, not losses, and growing. You need EPS growth. You need earnings that are growing over time. And as we've seen before with Apple in their income statement, the earnings can be stable, but the share count can decrease. That means, in the quick formula, that your earnings per share will increase over time. So that could be a way to boost your earnings per share. If your net income is stable over 3 years, a company can buy back its own shares to boost their EPS growth. That's also a way to manipulate the stock market price of your company, but we will see that later. Ratios about the balance sheet are quite important also. Something that Warren Buffett likes is when a company has a lot of cash and little debt. So cash is above debt. The company is in the comfortable situation of having more cash than debt and is able to pay its debt quite easily. And Warren Buffett likes this situation a lot. Also, he takes the ratio debt to equity and does some adjustment. You take the total liability, you divide it by the shareholder equity plus treasury stocks, and he likes this ratio to be below 0.8. That's the kind of adjustments that some big investors do, and I would not recommend to do it if you're beginning in the stock market. Don't do adjustment. Just use the pure metrics, pure ratios. It will be much easier. And for the cash flow statement, he looks at the capex margin. So for the capex margin, you take the capex, capital expenditure, and you divide it by net income. He likes to have it below 25%. Now, talking about investment and talking about CapEx, let's talk about capital allocation. Capital allocation is very important. That's the most important task of management. And what is capital allocation? It's the decision about what the company will do with the money it earned. Management should put cash back to work at the most attractive rate of return. It's their moral duty towards shareholders. It's at the end of the year, you have some cash generated by your operations. What do you do with the cash? Do you pay dividends? Do you reinvest all the cash into the business? Do you use your cash to buy a competitor to be bigger? How do you compare all these alternatives? How do you see that? Well, you can do some calculation. You can say, okay, my stock is very expensive, so my stock is not a deal. I will not buy it at the moment. I can see that one of my competitors' stock is cheap. That means I can buy them very cheaply, so that can be an opportunity. But also there are some investment in AI that my company will benefit a lot from. What should I do? Should I buy the competitor or put all my cash to work to have some AI opportunities? Well, that's the job of management. That's capital allocation. You can have several capital allocation options. The first one is organic growth. It's reinvestment into the business. Organic growth is the most preferred capital allocation choice. You want to invest in companies which can reinvest a lot of their earnings in future growth opportunities at attractive rates of return. For example, let's look at Amazon that for 20 years reinvested all their cash into the business again and again and again. So you have a snowball effect over 20 years that is insane. And they were able to do that because there were huge growth opportunities for them. At the beginning, they were selling books, then some hardware, then everything. And if you look at the panel of opportunities that Jeff Bezos had at the beginning, you can have return investment at 30% for this, 30% for this, 20% for this, 40% for this. And he looked at opportunities that could generate 30% return on investment. And he said, okay, let's invest back in the business. We can grow 30% per year. And that's what he has done over 20 years, and that has worked wonderfully. So you want a management that can recognize the opportunities inside the business. And if the management is competent, he will see the opportunities and will be able to grow 30% per year for 20 years. That's the most beautiful destination you can have for a business. But not all businesses have reinvestment opportunities of 30%. For example, big major businesses that have consolidated and don't have much competition, they don't have growth opportunities, they don't have opportunities to reinvest their money, they can't do that because first, they are too big to grow 30% per year, and two, they don't know what to do. They don't have opportunities. Maybe they have some opportunities that will not generate 30%, that will not generate 20%, not generate 10%, but only 4%. Is it worth it to go and put all your cash into an opportunity for your business that will make you grow 4%? I don't know. Maybe you have other alternatives. And that's the most important way of growing your business. And that's where most of companies use their cash. It's essential that the company has a high and stable ROIC, which is return on invested capital, when it reinvests a lot in organic growth. Why? Because growth only creates value when ROIC is superior to the WACC, the weighted average cost of capital. So that's a typical cost of capital when you put money into a business. What is your capital costing you? For example, if you have some debt in your business and your interest rate of your debt is 5%, that means that you have to pay to the bank every year. Your capital that you have is costing you 5% every year. Will you go and chase opportunities that will generate 3%? I don't think so. That's not worth it. You have a 5% cost of your money every year, 5%, 5%. You will try to go higher. And if you have opportunities that generate 20% return on invested capital of 20%, well, that's much superior to your 5% interest rate on your debt. So you always have to compare your cost of capital and the return on investment that you can get through different opportunities. So that's a very complex situation that management is when they have too much cash and they don't see many opportunities. If there is a mistake and over 10 years all the capital allocation decisions are bad, well, as a shareholder, you will not be happy. So you want to make sure they are good at capital allocation. And I will teach you how you can see if a management is good at capital allocation or not. The second capital allocation option that the management has is to improve the balance sheet. A company can also use the cash it generates to pay down its debt. This is especially an attractive option when the company is in bad financial shape. A healthy balance sheet gives companies flexibility. Consider Bill Gates at Microsoft, who advocated for maintaining sufficient cash reserves to sustain companies for a full year with zero revenue. You want to play it safe, and if there is a pandemic and the world shuts down, you want to survive. You want to survive, and you want to have enough reserves, enough cash to survive. If you have a lot of debt and you don't generate a lot of cash, if there is a crisis for any reason, if there is a crisis 2008, you don't want a heavy burden. You don't want a lot of debt. So you can use your cash at the end of the year to pay your debt. The third option of capital allocation is M&A, mergers and acquisitions. This is risky, but sometimes it works. Research has proven that between 60 and 90% of all acquisitions destroy value. That's why you should always be cautious when a company announces a big acquisition. Large M&A activities only make sense when two criteria are met. Management has skin in the game, and the company has proven to be a successful serial acquirer in the past. M&A is very difficult. You can pitch a beautiful deal and they can have beautiful slides. There will be synergies in 3 years. We will pay all our debt and we will have some margin accretion, some improvement of the margins in 3 years that will be beautiful. Time over time, these synergies never happened. These improvements of margins never happened because there are some temporary issues, because there are differences in culture. The mindset is different between the two companies. The culture is different. You have some mismatch. And sometimes a big merger creates a big, huge company. And most of the time, these big and huge companies are not much more profitable. It's a burden to be big because you're quite slow. It's much better to be in shape and so you can move fast and cut costs very easily. When you're too big, you are not agile and it's a burden of operations. You have too many people, too many employees, you don't know what to do. That's why most of the M&A activities are very hard to do. And if a management has skin in the game, so that means they are meaningful owners of the business. So, for example, if they have all their family fortune in their stock, well, they are incentivized to do well. And if if a management has done beautiful mergers over 20 years, beautiful acquisitions over 20 years, then you can say, okay, I trust them. They will do more acquisitions. But apart from these two scenarios of skin in the game and a huge, beautiful track record, then it's very risky to do M&A and as an investor to believe management if they are going to do an M&A and then going to say it will be beautiful with beautiful synergies, beautiful margins, improvements. That's risky. The last option that the management has at the end of the year, what do they do with the cash? They can return capital to shareholders. They can do it with dividends or share buybacks. A company usually returns capital back to shareholders when they don't have any other attractive growth opportunities. Dividends. Always look at the dividend yield and the payout ratio for the company. Key metrics to look at when you invest in a dividend stock. And for share buybacks, it only creates value when the stock is undervalued. I will try to make it clear. We've seen before in Apple's income statement that they bought back a lot of shares, and they did that because they thought that the business was undervalued. Management thought that it was a good deal, that the stock price was attractively priced, and they invested in themselves with the stock buyback. If your stock is not undervalued, if it's fairly valued or overvalued, it can be expensive. Instead of doing the stock buyback, you can pay dividends. If you want to reward shareholders and say, okay, 50% of my capital at the end of the year, I will reward shareholders. Well, instead of going for stock buybacks, you go to dividends. And you can be very flexible. One year you go to buybacks, the other year dividends. That's in theory. In theory, you can be very flexible. In reality, all the companies that have a lot of dividends, this is not flexible at all. And once a company pay dividends for 5 years to their shareholders, well, for the 6th years, shareholders want their meal. They want their dividend. And if a company say, okay, we will decrease the dividends, we will go to buybacks because our share is so attractive, well, shareholders will not like this at all. And you will have some derating, everybody will sell the stock, so you have some emotional bias around this. But in theory, you have two options when you want to return capital to shareholders: dividends and buybacks. And the job of management is to look at capital allocation options and to compare them as alternatives. Which of these different capital allocation options will generate the most return on invested capital? If you do it through organic growth and you choose to invest in your own business, for example, it can generate 10% return per year. If you do this, if you reinvest in your business, you will have 10% return on investment. But if you buy your competitor and you do M&A, maybe it will give you 12% return on investment. Or if your stock is cheap at the moment and it is so cheap that your price earnings ratio, this is a measure for valuation that we will see later, it is so cheap, the ratios are so good that you think if you do that and you invest your cash into stock buybacks, it will generate 15% return on investment. Well, you have all these opportunities with all these alternatives, and you have to be right and make good decisions time over time, year after year, decade after decade. That's the most important task of a management. And that's why capital allocation is so important when you pick stocks. This is a very difficult job, and everything that you will do, every decision that you will make, will be discussed and analyzed by some analysts, by your shareholders, and you will be hated if you choose the wrong option. If you do an acquisition that turns out 3 years from now, it turns out to be really bad and it destroyed value. You thought it would increase margins, but it turns out to be a really, really bad option. All your shareholders will hate you for this because they will say, don't do stupid acquisitions. Instead, give us some dividends. We are very good for that. Or instead, they could say, okay, just reinvest in your business. You were very good doing that in the past. Why did you change direction? That's a very complex job, and that's why you have very few good capital allocators over 20 years, 30 years, 50 years. The good thing is that with all this difficulty, if you have found one good capital allocator over 10, 20, 30 years, just stick with him. Because if he or she is a good capital allocator, you will be handsomely rewarded as a shareholder, and you want to invest for the long term with him or her. That's crazy, the amount of return that you can have if you just follow good management. And over time, if you think decades instead of thinking months of years, if you think decades, the most important factor that will increase your share price over time, the biggest element is management. If your management has a good vision and the management says, okay, we will reinvest everything in the business, trust us, we will compound at 15% per year with organic growth, we will don't do any dividends, any buybacks, any M&A, we'll just reinvest in the business and we'll have a snowball that will be so huge in 20 years. You just have to trust us. If you follow management that has a good track record at capital allocation, it will generate a lot of very, very good returns. And there are some capital allocation metrics that you can monitor over time to see if a management is a good capital allocator or not. If the cash used is generating a lot of return on investment or not. There are a lot of key metrics to measure the capital allocation decisions of management over time, but some of the most important ones are the return on asset, the return on equity, the return on invested capital, and the return on capital employed. If you compare two companies, one with a return on capital employed of 4% and another company with a return on capital employed of 26%, well, you have a big difference between how the company is managed. Sometimes it's because of a management, because the management is great and can generate 26% return, doing great things. And sometimes I must say that the industry can be a huge burden to investments. If a company wants to invest in logistics, for example, and they are operating in a capital intensive industry, it will cost them a lot of money with very poor returns. So everything in mind, capital allocation plays a huge role in your evolution of stock price. But even with a very good capital allocator, if the management and the company is in a bad industry, it will be much harder for them to reach good metrics, good return on assets, good return on equity, etc., etc. The differences between these metrics, I would say that if you compare the return on equity and the return on invested capital, the key difference here is debt. When you look at return on equity, you compare net income and you divide it by equity. When you see return on invested capital, you look at NOPAT and you divide it by total invested capital. Inside total invested capital, it takes into account debt, whereas equity doesn't take into account debt. So a company with a lot of debt can have a huge return on equity and a fair return on invested capital. That's why I'm showing you all these different ratios, because one ratio, one metric can be biased because of debt, for example, but it can be biased for another thing. And if I'm showing you 8 metrics and they all point to the same direction of an amazing business, they all have 20%, 30%, you can have a fair amount of information of, okay, this business is generating 20% return on investment. If you only look at one metric, you can be biased. If you only look at return on equity, you have 30% return on equity. Well, this is all faked because of debt. So that could lead you to a wrong decision, and you don't want that in your business. That's why I'm showing you all these metrics, all these ratios. I know there are a lot, and you will see more ratios like this. And when all these ratios, all these metrics point to the same conclusion, you can be reassured that it is overall a good business. That's the point of having a lot of ratios and not relying on only one or two ratios. So let's do a quick break also and do some takeaways about capital allocation. The important aspect of capital allocation is to understand how management thinks. Look at the track record. If a management loves dividend and over 20 years he just at the end of the year the management just pays dividend and doesn't reinvest in the business, okay, you have a fair amount of information, you have the vision of management. They don't see other opportunities in their business. They don't see M&A opportunities or reinvestment opportunities. Maybe they like to be comfortable. Maybe there is just no opportunities and dividends are the best use of their capital. Maybe they are lazy. Maybe they are afraid of competition. Maybe the family of the management members depend on these dividends and they like having a big bonus at the end of the year to pay a yacht. You don't know. You don't know, and having a good track record takes care of this. If you look at the track record, you will have all the information you need to evaluate a business. So the big question you can ask is, do they reinvest in the business to have like a snowball effect? Because if you compound inside a business your reinvestment opportunities at 20% for 20 years, 30 years, I guarantee you that as a shareholder, you will be very happy. Another question is, do they go into M&A and diversify away from their business? That's also a mistake that management can make. They can do an acquisition of a business that is not at all in their area, in their expertise. If you have a business selling ice cream and they do some M&A and they buy a software company, well, the ice cream management may be not capable of developing and scaling a software business. That's not in their expertise. So that's quite risky, and I've seen that many, many times where management can be seduced by an opportunity of an acquisition because the price is too cheap to ignore. You don't know. But once it happens and once you have the acquisition, you get disappointed really fast because you think you will get margin accretion, a lot of synergies between the ice cream business and the software business, but in reality, not at all. So that's a risk of diversifying away from your business. You can do M&A inside your core area of your business, and that's risky, I would say, because synergies almost never happen. And that's almost even more risky if you do it outside your core operations. Finally, big dividends or buybacks. That's a good question. At the end of the year, when you have some cash on your balance sheet, you don't know what to do with it, and you don't see many big reinvestment opportunities, you don't see big acquisition opportunities, you don't see reinvestment opportunities, you don't have debt to repay. What do you do with your cash? Well, you can return capital to shareholders, but it all depends on valuation. If your stock is trading cheap, it's much more likely that the buybacks will create value. Buybacks are better because, as if you were a shareholder, you want to buy when the stock is cheap. Well, these companies can buy back their own shares if they think it's cheap. If the stock is overvalued, you don't want to buy a stock that is overvalued. You don't want to do buybacks when it is overvalued. It may be better to pay big dividends. If a management does the mistake of buying back its own shares when the stock is overvalued, it will destroy value. And we will talk about valuation later in this course, so you will understand why I'm saying this. But valuation plays a huge role when you talk about buybacks. If you want to understand capital allocation and how management has performed in this field, you can look at the past 10 to 15 years of financials and look at key metrics. For example, has the share count increased or decreased over 10 years? When did large changes happen and why? You can do some research, and if you do that, you will understand if management did big buybacks when the stock was trading cheaply or expensively, and if management did buybacks only when the stock was trading cheap. Well, that's good news. That's what you want. Also, you can look at the cash flow statement for evidence of M&A. As I told you previously, you can see the big acquisitions in the cash flow statement, and you can see how much was paid and what was the result. You can see that if you do some research after 3 years, 3 years after an acquisition, 5 years after an acquisition. Management will tell if the synergies that were pitched at the beginning, if they happened 5 years after the acquisition. Did the synergy happen? Did the margins go up? Well, you can see that with the 10 years of track record. You can also compare the return on invested capital, ROIC, over time, over 10 years, 15 years, to see if this metric has increased over time or decreased over time. If your return on invested capital increase over time, that's a very good sign of good capital allocation. And if it has been in a decline, it shows poor capital allocation or difficult business model. Either way, that's not a good sign. And another question that you can ask yourself is, does M&A serve strategic goals or does it paper over strategic failures? You want to understand the philosophy, the mindset of management regarding M&A, and if management wants to do M&A because they want to get bigger and bigger, or do they want to try another market, or do they want to try another business line? You can know everything you want because that's public resource, and if you do some research, you can have these information. In future modules in the school community, we will talk about capital allocation and how we can create value over time, like in details. And also we will see the situations where bad capital allocation can destroy value over time. That also happens. And this is an example of the slides we will discuss. And if you have an analyst that asks some question to a management, they can ask some good questions to understand the philosophy, the mindset of management. For example, you can ask a management, what is your process? Who is responsible for capital allocation? What is the hurdle rate? Or what has been your biggest error? And management has to be transparent in this field to really reassure shareholders so that they really understand the business. Also, management can use several metrics to measure capital allocation decisions. They can use return on capital employed, return on invested capital, and in your formula of, for example, the return on invested capital, what is included in the denominator? You have total invested capital, but what's inside? Do you remove things from the denominator so that your ratio, your metric is improved? You can cheat, and you have to go deep into this analysis to really understand how capital allocation is done. What was the return on investment on past deployments of capital? That's important to see if management is aware of its mistake in the past and how it can improve and improve and improve over time. Also, some good questions to better understand capital allocation is to ask if management has learned things over time. If you do some research and you can have some good information about a bad scenario that happened to the company, if you can have the information, what did you think would happen? What did happen? What did you learn? Should the process change? That's really good news so that you have a complete view of how the management team thinks about capital allocation. But I will not go in details about capital allocation right now. I will do a deep dive on it later in future modules. So let's continue with our class and let's talk about insider ownership. Sometimes it can drive the stock price really high. A CEO that owns a meaningful share of its company will most likely do everything to grow its share price. They are incentivized to boost the stock price in the long term. And that is the case because if most of your wealth depends on the stock price of your company, you want it to go up. That's as simple as this. Sometimes you want it to go up very fast so you can buy a new house. And sometimes you're not in a hurry and you want to grow your share price over the long term. But every time you analyze a company, you want to see if, for example, the CEO owns 10% of the company. You want to know these kind of things. You want to understand insider ownership, how it works. Is the complete family in the board of the company? Do they have a lot of power and a lot of voting rights? and they own a significant share in the company. You want to know how insider ownership is in your investment. For example, Mark Zuckerberg, CEO of Meta, owns about 14% of the company, of a company called Meta Platforms. And if the stock price of Meta Platforms drops 50%, Mark Zuckerberg's net worth will be down 50%. So over the long term, I think Mark Zuckerberg wants the stock to go up. Another example is Warren Buffett, CEO of Berkshire Hathaway, that owns about 16% of his company. Well, again, that's a big deal. And I can show you plenty of other examples of smaller companies when management, the CEO owns 30%, even 20% is a big deal. If a CEO owns 20% of his or her baby business, well, that's a big deal, and that will be very meaningful in terms of how you think about the company. Well, that's a proper incentive, and I would suggest to only invest in companies where you have a meaningful insider ownership. If the CEO of a company only owns less than 1% of the shares, well, that could be a bad sign, a lack of incentives. You want their interests to be aligned with yours as a shareholder. And if the CEO of a company or the entire management team of a company doesn't own a meaningful share of your company you own, well, that could be a bad sign. And they can do whatever they want. They are not incentivized. And if the stock price drops 50%, well, they can get fired, but they will not lose 50% of their net worth. And that's even a bigger incentive to do good capital allocation, because if they do some buybacks, for example, well, indirectly they increase their ownership of their business. So buybacks at a good price are very good for insiders. And we talked about capital allocation, and I want to show you how important buybacks are. And if you do them right, it can really create value. Buybacks make you think about per share metrics. So we have seen before the earnings per share, the free cash flow per share, but you also have the revenue per share. You take the revenue and you divide it by the share count. Because if you don't think about per share metrics, you can fall into a trap. Some companies issue shares to raise money in the stock market. When a company issues shares, so when the company creates more shares in the stock market, they increase the share count. So the earnings per share, when you had like net income divided by share count, well, the denominator increases and you have lower earnings per share. It dilutes the current shareholders. You get a smaller slice of the pie. And if a company is growing revenue fast, but also issuing a lot of shares, it means every dollar of revenue is much less meaningful to existing investors because their shares are diluted. And Palantir, which is a software business, is an example. Since 2021, revenue has grown at a 22% CAGR, so compounded annual growth rate, but diluted shares outstanding have grown at a 9% CAGR. So revenue per share has only grown at a 13% CAGR. So increasing the share count will decrease your per share metric. If you have your division, you have your formula, you just increase the denominator. So all the metric, all the revenue per share, earnings per share, free cash flow per share are decreased if you issue more shares. The best situation is improving fundamentals, so revenue up, earnings up, free cash flow up, and you add with that buybacks. And even better than this, you have buybacks at a cheap price. That's better because you have your fundamentals, revenue, earnings, cash flow that goes up, which in your formula is your nominator. And at the same time, you have some buybacks. So share count is decreasing. If you do that, it's as if you kill two birds with one stone and you improve the per share metrics, the per share performance by a lot. And that's a wonderful phenomenon if this happens for 10 years, 20 years, 30 years. Some companies have done this and improved their fundamentals while doing buybacks, and the results have been phenomenal. Okay, so we've talked about capital allocation, management, buybacks, incentives to the price to go up. The question you may ask is why stocks go up over time? Well, there are many reasons and many different reasons in the short term and in the long term. In the short term, the factors that cause the markets to go up and down can be quite diverse. You can have the simple supply and demand. If a lot of people like these stock, well, there is a lot of demand, so the price can go up in a short amount of time, but it can fluctuate. You have some market indicators like the GDP numbers of the US that are, I don't know, disappointing for these quarters. So there is a sell-off in the stock market. You can have also the confidence index if people, households are confident right now regarding the state of the economy, their employment, etc. These public indicators can influence the mood of the stock market. You can have some war and other conflicts, geopolitical issues will bring more fear to the market, so people are more risk averse, and then they can sell some companies that are more risky. You can have some concerns over inflation, government fiscal policies, technological change in weather that will impact the business, some other regulation, deregulation, level of trust in the financial sector, level of trust in the legal system. There are a lot of things that can influence prices in the short term. Basically, anything can happen in the stock market. In the short term, what will make stocks go up and down is not fundamental analysis. It's not the earnings per share metrics or a return on invested capital. In the short term, if you think about weeks or months, these things are much more likely to influence stock price and the global market in general because it's market sentiment and we are all human with emotions. So anything can happen in the short term. What is really interesting and what I want to talk about is why stocks go up in the long term. Studies have shown that there is a strong correlation between earnings per share and stock price. I'm talking about the long term. So 5 years, 10 years, 20 years, 30 years, basically what you do your fundamental analysis for. So if you have a long time horizon and if you think, okay, I want to invest for the next 20 years, the main metric that you have to focus on is earnings per share, I would say. Over time, if a company grows its earnings per share, its stock price will follow. So as an example, Home Depot has had earnings per share compounded annual growth rate, so EPS CAGR, since 2003. This growth has been 12% per year. And the stock price CAGR since 2003 was 12% also. Another example is Berkshire Hathaway, the company of Warren Buffett, that has grown its earnings per share 12% per year for the past 20 years, and the stock price has done 11% growth per year since this period. Another example is Microsoft, that has grown its earnings per share by 15% per year since 2003, and the stock price has done 14% per year, so very similar. And finally, Walmart, you have 5% EPS, 5% stock price. The correlation is huge, and for a lot of companies, over a long period of time, you have a lot of similarities between earnings per share growth and stock price growth. But I'm talking not about 3 years, 4 years, I'm talking about 10 years, 15 years, 20 years. That's why it's very important to think about per share metrics because you would not have the same results in the past table if we talked about earnings and compared earnings with stock price. No, you have to think about earnings per share. A commonly tool to do the valuation of a stock is based on earnings per share, is based on EPS. This is called the PE ratio. You take the share price and you divide it by the earnings per share. This is maybe the most common valuation tool that you will find in the stock market. This is called the PE ratio, and it's quite important if you start investing in the stock market. Over the last 150 years, the average P/E ratio of the S&P 500 has been 15. As a reminder, the S&P 500 is the basket of the leading 500 best American public companies. So that's a basket of America, basically. And the valuation over the past 150 years has been 15 PE ratio on average. In this chart, you see the evolution of the PE ratio over time, the PE ratio of the S&P 500, and you see in the past century that it has fluctuated between 5 and 25. And since 2000, with interest rates being lower than usual, with these different economic policy, globalization, you have to pay a higher price to invest in the S&P 500. It means that the PE ratio of the S&P 500 has increased since 2000. You can see some bubbles in 2000. That's the dot-com bubble when everybody did a bet on technological advanced and they invested in technological companies, dot-com companies. And instead of having an average P ratio of 15, some companies, including the best companies in the world like Microsoft, they had a PE ratio of 50, 60, sometimes 70. And these led to the average to move up for the whole S&P 500. And then the bubble popped and it decreased substantially. And you have these big crises. You see a big spike in 2008 where the earnings were so bad and the valuation were so high that this metric is completely false and to the moon, as we say. And then you have a comeback to reality with the P at 15, and then it goes up 20, 25, and you are on average at 27 at the moment. So yeah, quite expensive at the moment, I would say. And if you compare different indices in the world, well, some markets are cheaper than the S&P 500 because market sentiment, economic data, take for example China, which has its own index and it represents the best, the leading Chinese companies. And instead of having a PE ratio of 27, you have a PE ratio of 10, I would say, in this market. And you have some Indian markets also really expensive. You have some markets in Europe that are very expensive, other that are cheap. But the thing that you have to remember is that on average, over 150 years, the PE ratio of the S&P 500 has been 15. What you can do as a shortcut to valuation, and if you don't want to lose much time evaluating a business, you can say that on average, if a P ratio is below 15 compared to average, it is most likely cheap. On average, if a stock has a PE ratio at 15, it is most likely fairly valued. On average, if a stock has a P ratio over 15, it is most likely expensive. But it depends on the situation. Sometimes a bad business can have extraordinary earnings for 1 year, so its P ratio can go to 3. So you may think, oh, that's extremely cheap. I have a deal. And after this extremely good year, the business will come back to its poor earnings. So it was not a deal, and don't fall into this trap. Most of the time, it's an extraordinary situation, or it's because the business is so bad that nobody wants it. You can have these situations where businesses are so bad and there is no growth and only bad capital allocation decisions, and you have a PE ratio of 6 and nobody wants to touch the stock. It happens a lot, and if the PE ratio is very low like this, like 3, it's sometimes for a reason or temporary reason. It's tricky, and most of the time it's a trap. So don't fall into this trap. You don't be fooled by an extremely low PE ratio that indicates cheapness, yes, but be sure that you invest in a stock for the good reasons and not be lured by cheap valuation. The P/E ratio is seen as a comparative tool when considering companies in the same sector. If you look at two companies, you like them, you compared their financials, and you like them a lot, and you don't know what can differentiate them, well, valuation can be a tool to make your choice. You can compare the current PE ratio of a company with its historical average or compare it with competitors. So you can compare two stocks in the same industry and buy the cheaper one. That could be a strategy. And you can also say that a stock is cheap compared to its own history. For example, if a company has been trading at an expensive price with a PE ratio at 60 for 10 years, and then for some reason the stock price drops and the PE ratio is 15, you may say, oh, it's 4 times cheaper, have a deal here. But on an absolute basis, the PE ratio is 15. So it's about the average of the S&P 500 over the last 150 years. So on a relative basis, this is cheap. But on an absolute basis, it's 15. So you can say it's fairly valued. It's about the average of the S&P 500 over the last 150 years. So it's not a crazy deal. And some people do this in a extreme measure. They only invest in companies that were extremely expensive in the past. For example, you take a stock with a PE ratio over the past 10 years. The PE ratio has been 100. And then for some reason, the PE ratio dropped to 20. So you may say it's 5 times cheaper than average. I have a deal here. But on an absolute basis, the PE ratio is 20. It's not a crazy deal. It's above the historical average of the S&P 500. It's above the average of 15. So it's not a crazy good deal. But the PE ratio is a great tool to compare this. And you can argue that PE ratio is linked a lot to sentiment of a company. If there is some drama, there is some crisis in a company, everybody will sell out of the stock and the stock price will drop and you have a PE ratio that will drop also. And if the crisis turns out to be temporary and may only last 1 year, well, 1 year from this crash, the stock price will recover and the PE ratio will recover and go back to historical average. So the PE ratio is a great tool to analyze the valuation of a businesses, but it's not the only metric you can look at. There are many other valuation methods, and I will show you some of them, the most important ones. Instead of having the price to earnings ratio, the PE ratio, you have the price to sales ratio, the PS ratio. You take the stock price and you divide it by sales. Another ratio is the EV on EBIT. It is a ratio that is calculated by dividing enterprise value by EBIT. You know EBIT, it's operating income, and the enterprise value is market capitalization, so the size of the company in the stock market. You add back the debt and you subtract the cash. So the enterprise value is similar to the market capitalization, but there is a small change. It's the cash situation, debt situation. If you have a company with a lot of debt, well, you have a bigger enterprise value compared to the market cap. On the contrary, you have a company with a lot of cash and no debt, well, the enterprise value will be lower than the market capitalization. So having the enterprise value instead of the market cap makes a stock a better deal if it is very healthy with a lot of cash. You have a lower denominator and a cheaper ratio. And if the company has a lot of debt burden and it's in bad shape with a lot of debt, well, the enterprise value is bigger and your valuation ratio will be higher. So it is more expensive. So you know the price earnings ratio, stock price divided by earnings per share. The opposite of this is the earnings yield. Just take the formula and turn it upside down. You have earnings per share divided by stock price. And instead of having a number like a PE ratio of 20, you have a percentage. You have, instead of 20, you make 1 divided by 20, you have 5%. If you have a PE of 25, you take 1 divided by 25, earnings yield of 4%. So some people, instead of talking about price earnings ratios and numbers, they only talk about earnings yield. That's a way of assuming if you have a 5% earnings yield, well, you can earn 5% on your investment. And the cheaper the price earnings ratio, the better the earnings yield and the better the yield of your investment. If you have a PE ratio of 5, that means you have an earnings yield of 20%. And some people may argue you can have 20% return on your stock. But again, don't fall into the traps of only investing when earnings yield are above 20%, 30%, because it's most likely that you will invest in bad companies, and that's a trap. Also, there is the price forward earnings ratio. It's a metric that shows you the stock price compared to the company's EPS for the next 12 months. For example, if you take a company with a PE ratio of 15 and the company says, guys, we will have a tremendous year next year. This will be enormous and we will double our earnings. So you can anticipate the PE ratio for next year. And if you have a PE ratio of 20, they say they will double earnings. So your denominator in your formula will double. So instead of having a PE ratio of 20, you have a PE ratio of 10 for next year. So you can say, okay, it was quite expensive this year, but if you take into account the future, it's cheap. It's a deal. So I will buy it for this reason. The formula is stock price divided by expected earnings per share for next year. Some people can have forward earnings for next year, but also for the year after and the year after. And it goes into forecasts like this. You can have a PE ratio for 5 years in a row. Just stay with the normal PE ratio. And if you're curious and want to anticipate some earnings, want to think about how management thinks about the future, you see the price forward earnings ratio. If you go too far into the future and look into 3-year earnings, that's irrelevant. That's too far in the future. Another measure for valuation is price to cash flow. Instead of having a price to sales, a price to earnings, you have a price to cash flow. So you have a stock price and you divide it by operating cash flow. Another metric which is very similar and maybe more useful is to price to free cash flow. So you take the stock price and divide it by the free cash flow. As a reminder, the free cash flow is operating cash flow from your cash flow statement minus capital expenditures. And the opposite of the price to free cash flow is the free cash flow yield. The same way we had a similarity between PE ratio and earnings yield, you have it with price to free cash flow and free cash flow yield. So you just take the free cash flow per share and divide it by stock price. And the final valuation tool that we will see today is the PEG ratio, the price of a company relative to its earnings while taking into account growth. You take the PE ratio, you divide it by earnings growth, and you have a specific ratio that can be 1, 2, or minus than 1. If you have a PEG ratio which is less than 1, it means that it's cheap. And if you have something above 1, well, that can be expensive, but that's not the main ones. The main ones I would say is P ratio, price to free cash flow, and EV EBIT. That's the 3 metrics I use a lot to determine if you have some valuation problems and to see if a stock is a deal or not. That's the main ones, I would say. The other valuation tool that you have to know is the discounted cash flow, the DCF. It's a valuation method that estimates the value of an investment using its expected future cash flows. You anticipate and you do a forecast of the cash flow that a company will produce next year, but the year after this, and the year after this, and for 5 years in a row, 10 years in a row. So you say, okay, you anticipate that Microsoft is going to grow its cash flow for 10% for 10 years. Okay, so there is a formula for that. And then you discount the numbers and you have a formula. You don't have to do it yourself on Excel. You can just download some templates or use the method I will show you It's automatic, and you just put the numbers, like you think Microsoft is going to grow 5%, 10%, and they show you the valuation and the expected stock price, like the fair valuation. I will show you how it works later. The pros of this method of discounted cash flow model is that it's very easy to do. In a few seconds, less than 1 minute, you can estimate the fair value of a stock, which is really useful. Unlike comparable valuation tools, it's not influenced by non-economic or temporary factors. For example, for some events, the stock price can drop. We've seen this in the pandemic in 2020, and stock prices dropped 30%, 50%, which influence the PE ratios of these stock. So if a stock drops 50%, you have a PE ratio that drops 50%. Instead, the discounted cash flow models doesn't take into account the stock price. So if there is a crisis or a temporary problem, discounted cash flow model will not be impacted by this. So that's an advantage of using it. The cons of this method is mostly that it's based on projections of future cash flows, which is very difficult. It's very difficult to estimate the growth rate of Microsoft over the next 3 years. So it's even more difficult to anticipate the growth rate over 5 years or 10 years. It's almost impossible, and nobody knows what the growth rate will be over 5 years or 10 years. Maybe you can anticipate over 1, 2, 3 years, but after that, it's just you flip a coin and you see what you have. So that's why the discounted cash flow model can work, okay. But after 3 years of forecasts, that's just guessing what the growth rate will look like. And the trap, if you are a beginner, is to say, okay, the business has grown 15% in the past 2 years. I expect it to grow 15% for the next 2 years and for the next 5 years after this. So in your DCF model, you put a growth rate of 15%, and it's very likely that this will not be reality. You will have competitors that will eat their lunch. You will have some problems about margins, of problem about cash flows. Having achieved 15% of growth in the past 2 years doesn't indicate that you will grow 15% for 5 years, 10 years. So my advice is to be very conservative with the numbers when you use a DCF, and don't anticipate something very shiny because you will get disappointed really fast. And to understand how the discounted cash flow model works, you have several steps to do the model. You first have to understand the business. Okay, what will be the margins next year, in 2 years? What will be the cash flow? Have management said that they will invest a lot of their cash flow to a big plant in Texas, so there will not be any cash flow for next year or 2 years because they will reinvest everything. What did they do? Do they have big plans, or do they want to gather cash to pay down debt? You have to understand the key metrics of business and how the business works. Once you have your assumptions, you can gather historical cash flows and the growth of these cash flows in the past. After that, you can project future cash flows. That's where the hard part is, because as I told you before, it's very difficult. You don't know if it will grow 3%, 5%, 6%, 10%. It's very hard, and you have to be conservative with these numbers. Also, with this model, it will calculate the terminal value and it will discount the cash flows. And at the end of this DCF model, you will have a fair price of, okay, at this price, it's good to buy the stock. At this price, the stock is cheap. That's very easy to do, and that's why a lot of people like having a DCF model. This is an example of discounted cash flow model. I've taken this screenshot from a website called Stock Unlock, which I like a lot and I use regularly. And I like their DCF model because it's really simple. And for example, now I have Google. At the right part of the screenshot, you have the metric that you want to project over 5 years, 3 years, 10 years. I've chosen free cash flow, which I think is the most important thing for Google. You can choose the number of years to project. They can be 3 years, 5 years, 10 years. I've chosen 5 years, and you have a metric growth rate that you can choose. For just this example, I've put 15% here. You can also indicate the shares outstanding growth rate. So if you have a buyback, you have a -1%, -2%. This is the share count decreasing over time. Or if the company issues more share, you will have a positive number. If they increase their share count 1% per year, you put 1%. For Google, I said 0%, zero buyback, zero share issuance. And at the end of the 5-year period, you can say, okay, at the end of this 5-year period, what's the PE ratio? And I said, okay, this will be 25, higher than average because it's a very good business and it deserves a premium. You can have plenty of arguments to say it's worth a PE of 25. After that, you indicate the discount rate. The most basic one is 10%. It's what Warren Buffett uses, and that's your minimal rate of return that you would accept. It does the formula, it does everything, and it estimates the fair value of the business. You have a chart, you have a red line, which is the DCF fair value price. And at the bottom of this screenshot, you have the stock price, which is currently $140. The estimated fair value, thanks to this DCF model, which is $174. The model thinks that the stock is cheap, undervalued, and it has potential. Also, the model estimates the future stock price over the next 5 years. And they think if Google continues to grow at 15%, in 5 years, the stock will be worth $281, which is a CAGR, a compounded annual growth rate of about 15%. So that's the kind of model you have on Stock Unlock, a DCF calculator, which is really useful if you want to do some projections and estimate the future cash flow. Let's do a quick break to see some takeaways from what we've seen. We've studied capital allocation, which is the most important task of management. What is their focus? M&A, debt repayment, or a return to capital to shareholders? That's really important, and you have to know how capital allocation works, and you have to be critical of capital allocation decisions. You want to invest in companies that are good at capital allocation, and this is really important. Another thing that we've studied is that stocks go up if earnings per share go up in the long term. If the company increases EPS, earnings per share, the stock will eventually follow. In the short term, anything can happen. The company can increase EPS and the stock price can stay flat or decrease the stock price. But in the long term, I'm talking about 10 years, 15 years, eventually the stock price will follow. It's very important. That's why you have to think about the long term, about your long-term mindset, and that's why you're here. You want to plan to retire early and have some financial freedom. And if you do these things right, you can get rich and build wealth over time. The next thing that we've seen is valuation that can be calculated with many metrics. The goal is to have a rough idea of whether a stock is cheap or expensive, whether you are using comparative valuation tools like the P ratio or price to free cash flow, or if you're using a DCF model of projections of future cash flow. The goal is to have a rough idea. It is in overall cheap or in overall expensive or in overall fairly valued. You don't need precise numbers to do this. Just have a rough idea of, okay, is this a deal or not? Now let's talk about circle of competence, which is really, really important. And Warren Buffett highlighted this a lot. The goal of the circle of competence is to understand that you don't want to invest in companies you don't understand. The circle of competence has 3 parts: what you know, what you think you know, and what you don't know, and you accept that you don't know. For the first part, the circle of competence, what you know, is where you have your core expertise. where you are 100% sure that you are an expert and you know your stuff. If you've been working with tables, wood tables for 20 years, you're an expert in wood tables. And the best situation for you is to invest in companies in the stock market that build and sell wood tables because you have an edge. You know everything about them. You know what to monitor, what type of wood do they need, what's the best margin for this table. That's where you will be an expert. That's where you are an expert. And that's where you can make a lot of money if you stay inside your circle of competence and only invest in companies that you know really well, in an industry you know really well. Another part of this circle of competence is what you think you know, which is the most dangerous one. If you have seen some documentaries, maybe 10 documentaries on the rockets, and you want to invest in a rocket company because you think it's cool and it's the future, well, don't forget that you've sold wood tables all your life and you don't know enough to be an investor, shareholder of a rocket company. It's really, really hard to see the distinction between, okay, you're capable in this domain and you're not capable in this domain. It's very hard, but you have to be aware of what you know and what you don't know. And this distinction is really dangerous because sometimes you think you know enough and there is a trap and some things that you have not seen happen and you lose all your money in a rocket bet that you thought was good, but you're not an expert and you missed completely an event. So you can lose your money if you don't invest in companies you know really well. The last part of this slide is what you don't know and accept that you don't know. I'm not a rocket expert, so I will never invest in a rocket company. As simple as that. I don't know enough. I'm not smart enough. That's it. That's it. That's done. I don't want to compete with Elon Musk in this subject. I will not spend any minute analyzing a rocket company, even if it's crazily cheap. No, I'm just staying inside my circle of competence and I will spend my time otherwise. And it doesn't matter how big or small your circle of competence is. What matters is that you don't cross the boundary. If you're an expert in a particular industry, in a particular sector, just invest in this sector. That's even better for you to stay inside the industry you know well because you have an edge. You are better than most people in this industry. If you've been playing video games for the past 15 years and you've spent hours and hours playing games, you know gaming really well and you know how a game will work or not. You have the user experience, you know how the bugs are fixed, you know where customers will complain, you know the products really well, and you have a really good edge in investing in video game companies. That's crazily good. And people underestimate this circle of competence. They think that you only have to invest in global trends, in artificial intelligence, in rockets. Well, if you are an expert in video games, you can make a lot of money investing in gaming companies. You can a lot of money. You just have to know yourself and you have to know your boundary so that you stay inside your circle of competence. Now let's talk about economic moat. Let's talk about competitive advantages. The economic moat is the company's ability to maintain its competitive edge over its competitors' rivals, enabling it to charge a premium without the risk of losing business, generate superior profits, and fend off competition. Well, that's the example of the Louis Vuitton bag. They can raise prices and people will still buy it. This is an example of an advantage that Louis Vuitton has over some competitors that are less luxury and typical bags. If they raise prices by 50%, customers will never buy again this bag. That's end of story. You can have different kind of moats, different kind of competitive advantages. You can have a brand moat, so companies differentiate themselves and build customer loyalty through strong brand power. For example, Coca-Cola has a strong brand that everybody knows. If you hesitate between a Coke at a restaurant and another drink that you don't know well, you will take the Coke from Coca-Cola. But you have other moats, other competitive advantages like the secret moat, toll bridge moat, switching moat, price moat, and I will explain to you in simple terms how everything works. If you go from the beginning, you start from the beginning. Capitalism works. How it works? High profits attract competition. So if you have a business that generates 20% profits, 30% profits, well, other small companies will look at these profits and say, I want my share. So they come into the industry and compete with the big profitable business. So there is a competition in prices, in products, and over time, all these good margins, all these good return on capital, it all averages out. On overall, I would say that the margins will decrease, the profits, overall profits will decrease, return on capital will decrease. A small minority of companies enjoy many years of high returns of capital. How? By creating structural competitive advantages or economic moats. Some companies are so good that they remain very profitable and they shine because they have a competitive advantage. They have a business model which is differentiated from other companies and it allows them to shine. And it's important to understand why moats matter, especially in investing. An extended period of excess return on invested capital increases business value by lengthening the period during which capital can be reinvested at high NPV. NPV is net present value. The thing that you have to understand is if you have a wide moat, a strong competitive advantage, you will benefit from high return on invested capital for a long period of time. And at the right of this chart, you see that if you have no moat, competition will come and you will not enjoy your high return on invested capital for a long time. So having a moat ensures that you benefit from high returns for a long time. And I'm talking about economic moats right now because it will be important later in the valuation. Because if you think about valuation, if you think the average is a PE ratio of 15, well, every business is not worth a PE of 15. If the business is superior to overall businesses, if they have a tremendous return on invested capital, tremendous margins, extremely good management, maybe they deserve a premium. And if you don't pay a PE of 15, maybe you will pay a premium of a PE of 20. Maybe if this is a great business and with the great management, you will pay a PE of 25 and it can go up and up. And for some businesses, investors can say, I'm buying this business at a PE of 35, 40, because I think with the quality of management and the competitive advantages that this company has and the long runway, I think I'm going to be rich with the stock. I think it's not expensive with a PE of 35. So yeah, if a business has a strong moat, maybe you can pay a premium. And if you look at the other side of the coin, if a business has no moat, no competitive advantage, and even is at a disadvantage in this industry, you certainly don't want to pay a premium. You certainly don't want to pay a fair price. You want a discount. So that's why I'm talking about economic moat right now, and I will go through some examples of how competitive advantages work. So you can identify them and see if it's worth paying a premium for this business and a P of 20, 25 instead of the average of 15. You have different types of competitive advantages. For example, you have intangible assets with brands, patents, licenses, but also switching costs, network effects, and cost advantages. Let's go through the intangible assets. You can have a brand, for example, a lower search costs. You are known to be lower cost than competition, so people will go to you and you have developed a recognition of cheapness for your project. That works for building a brand. You are the cheapest of your competitor, so people will buy you. You can create positional value like Rolex or Cartier or LVMH, the Louis Vuitton bags. You are so different than competition that they don't compete with you, or the companies will not compete with you. You just can raise your price and people you will buy your product because people like Rolex. People like buying Louis Vuitton bag and having a Louis Vuitton bag. The feeling of wearing a Rolex is different from the feeling of wearing another watch. That's a positional value which is really specific to a certain kind of companies. Also, some brands confer legitimacy, like Moody's, the rating agency, which is really, really famous. But you have also other companies that over the years have created a reputation with a lot of good track record and everybody knows them, so it's easier to use their products. That's how brands work. You can also use patents to have a moat. You can have legal monopolies, for example, ARM Holdings or the pharma industry. For example, if you're a pharmaceutical company and you develop a drug which is really good against, I don't know, obesity, and you have a patent for this, well, nobody can touch your product. And for, I don't know, the patent is maybe 8 years, nobody can harm you for 8 years. Your product will not have competition over 8 years. The thing is that after 8 years, well, you have a war with competition for these products. But it can give you a temporary edge over competition if you have legal monopoly with a patent. And you can also have intangible assets with licenses and approvals that will give you an advantage over competition. Another moat is the high switching cost. It costs more for a user to switch to competitors than it does to remain with incumbent. And the cost of customers leaving you for a competitor can have many forms. It can be money, like the subscription of the business, but also time, because, for example, if you change a business and if you're a customer of a business, you want to change the company because another company provides better value, well, you have to take all your data from the first company, analyze it, and then use all your data, condense it, and give them to the second company. It takes a lot of time to collect your data, analyze them. It's much more simple to stay with the first company. If you have your data in the first company, it's just not worth it to change your mind and change everything, change all your data. It's just too complex. So the high switching cost can be money, time, and also risk. For example, if you want to change your provider of something, you have to collect all your data and give your data to a competitor, which may provide more value, but there is a risk of losing your data along the way of this long process. And maybe you don't know the second company really well, you don't know how it works. People are very worried of changing their minds. It's much more comfortable to stay with your first service provider. Even if it costs more money, a lot of people will say it's not worth it to change and I will just stay with the provider I have. So these costs can be explicit, like the price, for example, or implicit, time and risk. So the high switching cost is a very powerful economic moat. There are some examples like products that are tightly integrated with customer business processes for Oracle, SimCorp, or Autodesk, but also products with high benefit cost ratios like Amazon or Moody's, for example. For Amazon, it's just very, very easy to order a product from Amazon with a very good price, and in 1 or 2 days it will be here at your house, versus going to another website that may provide more value but it's just less comfortable. You don't know the website really well, you don't trust it. It will cost you some time to register into this new website. You don't know how it works. No, it's just easier to order everything you want through Amazon, which is a wonderful switching cost example. Another competitive advantage, which is really powerful, is network effects. The companies with network effects, they provide a product or service that increases in value as the number of users expands, like Visa, Rightmove, but can also work with Facebook, like Meta platforms. Because, for example, if for Facebook you only had 10 customers, well, the website would be quite useless. But now that we are billions of users in Facebook, well, the amount of interaction between users, the amount of content provides a lot more value to each other. So that's a beautiful network effect. These network effects are maintained by subsidizing one side of the network, like Adobe or Uber, but also driving engagement, like Facebook. You want to keep your customer satisfied, you want to keep them happy, so you want to have high engagement so that your customer will use your product again and again and again, and they all contribute to the network effect. Network effects are at risk if the pricing power is abused, like for Bloomberg, or if the user experience degrades. Nobody uses MySpace anymore. They want it to be more profitable with more ads in the feed, and the user experience was really, really bad and getting poorer and poorer. So everybody left MySpace to go to Facebook and Instagram and other social media companies. So yeah, these network effects are really strong. They work really well, but you have to do things well. You have to monitor your customer experience really well and provide a lot of value with your network. And then we have cost advantages. The process is that you create a cheaper way to deliver a product that can't be replicated easily. So you have some Geico, for example, providing insurance cheaper than anyone else, and it's very hard to compete in this industry, and the barrier to entry are really high. So small companies won't have the courage to go in the industry to compete with extremely low prices. That's also a method used in airlines, with airlines, that you have low prices, low ticket prices. So it's really, really hard for a small company to come in this industry because it's just too hard to compete. And scale is important here because you can spread fixed cost over a large base. Relative size matters more than absolute size. For example, Costco or Amazon. They are so big that fixed costs are spread over all their operations. And if a small company wants to compete with Amazon, their fixed cost will be so large that they will be put out of business really fast. But Amazon is so large that it can take this cost, this fixed cost, and continue to grow again and again. Efficiency, operational aspect of Amazon, this is great. And that's why Amazon has a beautiful competitive advantage. And some companies have a niche. They dominate industry with high minimum efficient scale relative to TAM, total addressable market, like Constellation Software. It's a Canadian business that sells software, does a lot of M&A, and they acquire small businesses that do software extremely well. So it's a niche market and they are extremely good at what they're doing. So that constitutes a cost advantage and a very strong moat around their business. But you have to understand what's not a moat. For example, a dominant market share is not a moat. It's not because you have a high market share, a 40% market share, that you have a moat. It's just that you are bigger. But competition can eat you years after years, and your big market share can collapse in a few years. Also, technology is not a moat. Things can go really fast. Commoditization and disruption are inevitable absent customer lock-in. So GoPro at the time, what they did with cameras, this was amazing. And then we've seen a lot of competitors with the same cameras, and you will have the same results. And some cameras are cheaper than GoPro, So I would say that GoPro has no moat at all. We just have some brand recognition, but that will not force me to buy a GoPro camera if I have seen a competitor selling a similar product 20% cheaper. Having hot products is not having a competitive advantage. If you have hot products with some hype, they can generate high returns for a short period of time, but sustainable returns make a moat. If this is only short term, this is not a moat. You don't have moats for 2 or 3 years. You just have a temporary advantage. When you talk about a moat, you talk about a 10-year track record of high return on invested capital, high advantage over competition. If it's just some good products over 2 or 3 years, this is not a moat. Moats are always moving. They are never stable. Either the moat widens over time or it shrinks over time. But management always have to keep improving their products, improving their performance, improving the company overall, because competition is always here. And if you are lazy and comfortable as a big profitable company, competition will come for you. So the big question is, what will widen the company's moat? And this answer should drive management strategy. You can do like Amazon and improve the customer experience year after year. This was their drive, their focus to each year have a customer who is very happy. You want to improve the customer experience year over year for Amazon and for years and years and decades. And it has worked beautifully for Amazon. Another example is Costco with scale economies shared. It's a virtuous cycle of having cheap prices, which leads to more clients, which means that you have to buy more products from your supplier. And because it's all fixed cost, well, you can reduce your buying cost from your supplier, and the client will be happy, get cheaper price, client happy, cheaper price. And that's a virtuous cycle that works really well. You also have Uber with the increased vehicle liquidity, or Howden Joinery that solve a builder's problems, and Facebook that drive user engagement. You have several tactics that management use to widen the moat so that competitors are away from them and they can thrive from high margins, high return on invested capital. If they have an edge, you have to feed this edge. You have to increase the gap between you and your competitor. So that's a big question. And if you don't put efforts, if a management doesn't put efforts into this, into widening the moat, well, the moat will shrink and competitors will come for you. So capital allocation is the link between business value and shareholder value, as we've seen. If capital is deployed in ways that destroy value, shareholders do not fully benefit from increased business value. If you do stupid things, value is vaporized. So it's really important for management. If capital is deployed in ways that amplify value, shareholders will benefit from both increased business value and from value accretive actions. So value compounds. If you do good capital allocation, it compounds and it creates value. If you do bad capital allocation that destroys your competitive advantage, you destroy value. And that's not what you want for your business. So that's again some examples of different competitive advantages. You can have no moat, no competitive advantage. You can have a narrow moat, so a small competitive advantage that is sufficient, that is enough to be differentiated from competition, but it's not that big. And you have wide moats where it's just enormous when the moat is enormous. For example, Coca-Cola, it's very hard to disrupt this industry because Coca-Cola has been here for centuries and everybody knows the name of Coca-Cola. They want a Coke, they know it's just sugar water, but consumers pay a premium. They don't care if the price is a bit more expensive, they want the Coke. And there are a lot of other businesses that have wide moats and take advantage of this. Every business wants a wide moat, and you have to put the efforts to get to this situation. So to sum up about moats, that was just some simple terms and simple analysis of the different competitive advantages that exist, but there are more. And in future modules inside the school community, we will go through every competitive advantage and analyze them with specific examples. I think you will learn a lot, and we will see how a company can lose its competitive advantage by doing stupid things, with real examples that happen in real life, and that happens. Everybody is a human. You can do mistakes, and if you do 2 or 3 or 4 mistakes in a row, you can lose your competitive advantage. And if you own this stock of this company that does stupid things, if you own this stock in your portfolio, you have to monitor these changes before your investment goes bad, because it can go bad really quick. And if you don't monitor specific metrics, specific ratios to understand bad capital allocation, it can go bad really fast. So you have some things that you have to monitor. So I encourage you to join the school community now. There is a link in the description. So let's use everything we learned to find great stocks. That's why you are here. You want to build a strong portfolio with strong companies. And with key metrics, you can filter out bad companies to only stay with the great companies. For example, you can only filter revenue growth superior to 7%. You don't want revenue growth which is negative. You don't want a business that is shrinking. You want a business that is growing and growing at a decent rate. You want earnings growth at more than 9%, for example. It is more than revenue, and it means that the business is getting more and more efficient. You want some return on investment superior to 15%, which is very good. Some good profit margins, about 10%, and you want the net debt on free cash flow to be under 3. So basically a business that generates a lot of cash and is growing consistently at a decent rate. There are several steps to find great stocks, and Compounding Quality provide 6 steps. For example, you can start with studying the competitive advantage of a business. You don't want to invest in the next big thing. You want to invest in companies that have already won, and they will keep winning. And they do that by having a moat, a good competitive advantage that will deter competition from coming and compete with them. So to determine a good competitive advantage, you have several metrics, including having a high gross margins above 40%, which means that you have pricing power and you can increase your price without losing customers. Think about the Louis Vuitton bag, that you can increase the price of the bag and people will still buy it. And another metric to see if a business has a moat is a high return on invested capital, above 15%, above 20-25%. You can also look for companies with skin in the game. So management with high ownership. If the CEO has 10% of the shares, he or she has skin in the game. The business must also have low capital intensity. It depends on the situation, but asset-light businesses can provide more value with better return on invested capital. So that's an easier way to invest. Companies that require very little capital to operate are very attractive for investors. So you compare capex to sales below 5%. That's a metric, but we will see other metrics. The next step to find great stocks is to define what a good capital allocator is and to only look for great capital allocation. So with, again, high return on invested capital, high return on capital employed, and some other qualitative aspect of managing a business for the long term. You need a business with high profitability. You want to invest in companies that translate most revenue into earnings. So we've seen high gross margins at the beginning, but also high profit margins and high free cash flow margins. And you want a secular trend. In the long term, stock prices tend to follow earnings growth. So earnings growth above 5% and EPS growth above 7%. That's a bit conservative. You can reach for more than 7%. You can reach for 10%, 20%. But Let's stay conservative and say 7% at the beginning. You can put whatever number you want, but it's much more likely that a growth at 7% is sustainable compared to a growth at 30% per year for a decade. It's almost impossible to grow 30% for a decade, but 7% per year of earnings, it is sustainable. You want a secular trend which is positive, and you don't want at all a bad secular trend. If this is a bad industry that is dying with very low growth and negative growth, the revenue is negatively impacted by the secular trend. So less revenue, less earnings. You don't want to invest in these companies. And you have different reasons to buy a stock. You can first see the price and invest when the stock is undervalued. The cheaper you can buy a stock, the higher your margin of safety. Margin of safety is, for example, you define that the fair value of a stock is $100 and you don't want to buy it at $100. You want a margin of safety and you want to buy it at an even cheaper price. So if you think that this business, this stock is worth $100, you will buy it at $70. So you have a margin of safety. Compare a company's DCF yield with its average free cash flow yield over the past 5 years to get the first indication about valuation. Yes, as I said previously, you want to get a rough idea of valuation if it's roughly cheap or roughly expensive. Also, you can buy a stock because fundamentals are improving. Stock prices follow intrinsic value over time. When a company's profit margin doubles, its earnings also double. So you can watch for strengthening balance sheet, reduced capital intensity, improved capital allocation, enhanced profitability. If you have a change in management, after bad years of capital allocation, the CEO quits, you have another CEO, and the company starts again to be more profitable with good capital allocation, then this could be an indication of you have to buy the stock. If the stock is reasonably priced and you understand the business and the CEO is very competent and fundamentals are improving, this could be a reason to buy the stock. Another reason is that the moat is strengthening. Determining the existence and durability of a competitive advantage is key to make good investment decisions. So how to identify a moat? As I told you, high and consistent gross margin to have pricing power, and high and consistent return on invested capital. If the moat widens over time, it means that this is a better business, and this could be a reason to buy the stock. Also, the future could look bright for the stock. In the long term, earnings growth is the main driver for stock prices, and the longer your companies can grow their earnings at attractive rates, the better. If management guarantees you at 100% that they are going to grow their earnings at 20% per year for the next 10 years, they guarantee you 100%. First, be hesitant. Okay, that's almost impossible, but just imagine this scenario. The guarantee at 100%, it's for sure. Well, even if the price is still high, a bit expensive, growing 20% per year with a huge moat, huge competitive advantage, this is amazing. And this is a buying opportunity. Even if you have a P of 40, say 40, the business will grow 20% per year. And in 10 years, the expensive price that you would have paid in the first year would not have mattered much, would not have mattered at all, I mean, because you will have a tremendous return. And finally, a reason to buy the stock is when insiders are heavily buying. Insiders know the business really well. For example, if you have a CEO that owns 10% of the stock and the stock price, for some reason, the stock get cut in half, losing 50% of its value, the CEO is buying more of the stock. He knows everything about the business and he's buying the stock. He's investing in the business. This is also a good reason for common shareholders to buy the stock. There are many reasons for management to sell their shares. They can buy a new house, pay tuition for a child, but there is only one reason why an insider buys his own stock. He thinks the stock is undervalued. Companies in which insiders are heavily buying
outperform with 3 or 6% per year on average. And that's true. And there are some specific elements that work better than average. And that's what we will see now. Some elements in the long term work better. So if you identify these elements, you increase the odds of you making a lot of money in the stock market and picking great stocks. For example, size matters. In general, small companies outperform the big companies because it's easier for them to get more efficient, to get more lean, and the stock performance of small and medium-sized businesses in the stock market, in general, they perform better than big, large businesses. Also, you can increase the odds of having a good return in the stock market if you buy when it's cheap. It's logical. The cheaper you buy, the better. Also, high dividend stocks do not outperform in general. The companies that pay a lot of dividends generally are large and not growing fast. And if you think about 10 years horizon, 20 years, well, you want companies that grow their earnings, and companies with high dividend yields, they don't grow much. Free cash flow is king. That's very true. It's even better than to compare earnings. You want to compare free cash flow and you want to see if free cash flow is growing over time. So companies that generate a lot of free cash flow generally perform better in the stock market. And the healthier balance sheet, the better. Companies that have a lot of debt, well, they have a burden, and compared to a company that don't have debt at all and they have a lot of cash, well, I would 100% go and invest with companies that have a lot of cash. Don't look at profit margins alone. Investing in companies with high profit margins does not work if the company doesn't have a competitive advantage. When a company has a high profit margin but no moat, rivals will enter the market and reversion to the mean takes place. You can't have a moat, a competitive advantage, for only 2 to 3 years. You need sustainable 10 years in a row, very high margins, very high return on invested capital, and you want to widen the moat over time. So if you look at a specific year with high margins, you can't say if this is a good business or not. You can't say if this is a company with a competitive advantage or not. Also, return on equity is important. It's a good metric. When you would have bought the stocks with the highest ROE, you would have slightly outperformed the market. However, in general, it is a very good idea to combine good capital allocation metrics with a high profitability. If you combine a great manager, a great capital allocator, great management, with a very strong business model, with a very strong profitable business model, well, you have a secret sauce to generate very high returns in stocks. Also, momentum works great. In the short term, you can take advantage of this phenomenon. In the short term, things that go down continue to go down, and things that go up continue to go up. You can take advantage of this to buy at a cheaper price. If the stock goes down and will continue to go down in the short term, you can just wait for the good opportunity if you want to buy the stock. And with that, you can combine momentum and value. Combining momentum and value achieved an annual return of 21% per year between 1964 and 2009. This is an annual outperformance of 10% per year compared to global indices. So you can combine some elements here to outperform the market. And consistency is key. By definition, every active strategy will underperform the market from time to time. Discipline and consistency are key. Keep faith to your strategy and you will end up fine. Investing is a marathon, not a sprint. It's very important. Don't be in a hurry. You have time to invest. And if you're patient and if you have discipline, you will reach your financial freedom. You will grow your wealth. If you do things right and you build a strong portfolio, you will do very well. And now let's see the complete idea generation process. With everything you've learned, all the metrics you've learned, capital allocation decisions, how to identify a moat, etc., you can generate ideas now. And I have this chart here that will sum up what we will do next. So You have your investable universe. You have all the stocks that you can invest in. Tens of thousands of stocks. You will never have the time to analyze them all. You have to select some criteria and analyze some of them. And to do that, you can only look at companies that you understand so that you stay within your circle of competence. Do you understand how the company makes money? Only invest in what you understand. So, out of the tens of thousands of companies, you can remove a lot of them to keep only the companies you understand. It doesn't matter if you only understand 50 companies or 100 companies or 1,000 companies. The thing is to only invest in what you know. So even if you understand 15 companies really well, well, that can be 15 potential investment ideas. So it doesn't matter how many companies you understand. Just the important part is to stay outside of companies that you don't understand. And now with the remaining list, buy wonderful companies. You just look for companies with a sustainable competitive advantage, a healthy balance sheet, low capital intensity, great capital allocation skills, high profitability, and plenty of reinvestment opportunities. You can have several metrics to identify how wonderful a company is, like revenue growth, earnings growth, high return on invested capital, high margins, having low debt, generating a lot of cash. And after the ratios, the metrics are good, you want to do the qualitative stuff. Invest in companies where your interests are aligned with the one of management, insider ownership. Companies with skin in the game outperform the market by a wide margin. So you can ask some questions like, is the company still led by its founder, or is insider ownership superior to 10%? How long has the CEO been working for the company? Does the company use a lot of stock-based compensation, so stock options? Does management have a great track record? So you have to look at past years, in the past 10 years, 15 years, 20 years, to see if managers have a good track record or not. And this is much more qualitative than quantitative. After that, you reduce your list over time. You will find bad management or bad business model. You reduce your list and you only invest in companies that are trading at a good valuation. Try to buy wonderful companies at a fair price and always use a margin of safety. You don't want to pay full price for a stock. You want to pay the best price and the cheapest price as possible. Even the best company in the world can be a bad investment if you pay too much. For example, if you had bought Microsoft in 2000, well, the valuation of Microsoft was very expensive, like very, very expensive, with a PE ratio of over 60, 70. So you can buy a wonderful business model, wonderful Microsoft. It's just that the price is too high. The people who had bought Microsoft in 2000 during the dot-com bubble, they waited 16 years before getting a profit on their investment. So no returns whatsoever for 16 years. So you want to pay attention to valuation. That's very important. And finally, with the remaining stocks of your list, you build your portfolio. 15, 20 stocks which match all criteria above. But you can only have 10 stocks if you want. Only 8 stocks if you want. Invest in the best companies in the world, compounding machines at fair valuation levels. That's part of the game. That's the big picture of investing in the stock market with stocks. You want to build a strong portfolio filled with strong companies. And these are all the criteria you need to identify great companies. So the big summary is to understand key financial metrics to look at. You have to know yourself and define your circle of competence to only invest in businesses you really understand. You also have to analyze the competitive advantage of a business. It's really important. You have to know if a business has a moat or not, and preferably you want a wide moat for the business so it can have strong margins, strong profitability over a long period of time. And finally, you need a rough idea of valuation. I'm not asking for specific numbers, decimals, just have a rough idea if it's roughly cheap, roughly fairly valued, or roughly expensive. That's important. This part of the entire course is the part that I prefer. I think that's the best part. That's why you click on this video. You wanted to know all the secrets, all the tools. I will show you exactly the process, step by step, how you can pick great stocks, how you can generate ideas to build a successful portfolio. And I've never seen anyone on YouTube talk about it like this. So I will give you a ton of value. So please like the video and join the school community. And if you're already in the school community, thank you. You will not be disappointed. I will give you exactly the different websites that I use, and I will give you all the secret websites that I use where I generate almost all my ideas from. And I'm giving everything away for free so that you can be a great investor. So I'm very happy to do it, very excited, and let's start right now. Now, with everything we've learned, I will show you the best tools I personally use to find great stocks. And I'm talking about the best websites that I'm personally using to do my stock research. There are hundreds of financial websites, so it's easy to get lost. Over the years, I found a simple methodical way of finding great stocks. And the best websites I'm using are FinChat and Stock Unlock. There are links in the description if you want to sign up to these websites, which I recommend a lot. Let's go through the different FinChat tools that you can find. First, FinChat helps you visualize data. It's really easy and convenient. It also has a beautiful stock screener. In fact, the best stock screener I found over years and years of research. It has an equivalent of ChatGPT, but for finance. This is called the AI assistant, and you can ask whatever question you want. If you want to know what Warren Buffett has in his current portfolio, well, you can ask this to the AI assistant and you will get all the portfolio allocation of Warren Buffett. And if you want some specific data on a specific company, you just ask the AI assistant and you will get your response. So it's great, and I will show you how it works. In FinChat, you also have a portfolio and watchlist dashboarding, a discounted cash flow modeling, and you can compare competitors and compare the numbers between similar companies. And the best tools that I use from FinChat are the first three tools: the data visualizations, stock screener, and the AI assistant. That's where I found the best value out of this website, but if you want more, you can use everything. How I use FinChat. With FinChat, I create a watch list with important metrics, and I will show you later in this video how you can create a successful watch list and you can monitor key metrics over time inside your watch list. I also use FinChat to generate ideas with the best screener to find opportunities. The FinChat screener is great, and later I will show you how it works. The screener alone is worth the price of FinChat. It's really great, and you can improve your customer experience if you brainstorm ideas with the best chatbot. So if you combine the chatbot and the stock screener, you can generate a lot of ideas. And finally, I use FinChat to analyze specific KPIs. So key performance indicators, the main indicators of a company. For example, if I want to know the iPhone sales from Apple, not the total sales, just the iPhone sales from Apple over the past 10 years, instead of looking at annual reports and getting lost in hundreds of pages to find a specific number of iPhone sales, I can just ask FinChat and I will get the response in a few seconds. I think it's great, and it's one of the best websites I've seen over years of investing. So I highly recommend to join FinChat, and you can sign up with a 25% discount with my unique promo code. You just have to click on the link in the description. And the second website that I use that brings me a lot of value is called Stock Unlock. With Stock Unlock, you have different tools. You have stock fundamental scoring. That means that every stock has a score in the website between 0 and 5. If you have 0, it's a bad company. If you have a score of 5, it's a great company. So thousands of scores can help you choose your portfolio. And for example, you can only invest in companies that have scores between 4 and 5. That's a strategy. It's really helpful, and I will show you how it works later. In Stock Unlock, you can also compare any numbers of stocks. It's really useful to compare metrics between different companies. There is a beginner-friendly discounted cash flow that we will use later. You can also compare competitors, so that's great if you want to compare similar companies. There is also a portfolio tracking, a stock screener, and an education mode for beginners, which explains to you every metric, how it works, etc. The best value I have found and what I use personally is the first 4 points: the stock fundamental scoring, the comparison of any number of stocks, the beginner-friendly DCF model, and the competitor comparisons. I think it's great, and that's what I use personally. So I use Stock Unlock to evaluate a business in a few seconds with the Insight score, the score between 0 and 5. I use Stock Unlock to visualize financials with simple charts, to also compare data with competitors, and do valuation with the best DCF model I found on the internet. So I highly encourage you to join Stock Unlock and sign up with my link in description. It will give you a 30-day free trial to Stock Unlock, as opposed to the 14-day free trial if you use the normal website. This means that you will have 1 full month to check out Stock Unlock for free by using my link. So just try it out, register to the website, and after 1 month, you will be able to see if it's good for you or not. My recommendation is to sign up to Stock Unlock and FinChat. These two websites will bring you a ton of value. And later in this video, I will show you step by step how I use these websites. So I will give you the tools so that you can sign up to these websites and you can find great stocks. Because if you want to take investing seriously, you need the best tools. You need the best tools to generate wealth, reach your goals, and reach financial freedom. There are other websites that I use, like Guru Focus. I use the free version where you can have an overview of a company in a few seconds. I also use ROIC.ai, the free version also, to analyze financial trends in one page. I will show you how it works. And I use MacroTrends, also the free version, to study fundamentals with simple graphs. These three websites help me a lot, and they are complementary to FinChat and Stock Unlock. That means that if I use these 5 websites, well, I can generate a lot of good ideas. I can generate a very strong watch list. And with everything said and done, let's find great stocks. My process is simple, and I took inspiration from this. You look at a stock and you see if there is 10-year price and financial data available. If this is not available, you discard the investment case. If this is available, you analyze the data and you see if fundamentals are strong or weak. Well, you do some fundamental analysis, and if they are weak, you discard the investment case. And if the fundamentals are strong, you continue and you calculate the intrinsic value with the margin of safety. So you have some price valuation, and you compare the valuation you've just done with the stock price. And if the stock is currently overvalued, you discard the investment case. And if the current price is less than the intrinsic value after the margin of safety, it means that the stock is undervalued, and that's where you buy. Well, I took inspiration from this model and I created mine. Let me show you how it works. This is the entire method I use to generate ideas and build a successful watch list. Let me show you how it works. Let me zoom in so that you can see a bit better. And how this method works is by elimination. Start with the companies you're familiar with, the products you know, like Apple, Google, Starbucks, Disney, Netflix, all the products you usually use in your life. Do you understand the business? That's your first question, your first filter. If you don't understand the business and you think it's too complex for you, well, it's a pass and you go to another business. If you understand the business, well, you can start analyzing the numbers. on Guru Focus, ROIC.ai, or macro trends, like pure numbers. If you don't like what you see, if you don't like the trends over time, it's a pass and you go to another stock idea. If you like the numbers, if after seeing the numbers over a couple of years, you like what you see, you can go deeper. And that's where you analyze numbers with Stock Unlock, with the Insight Score, and you can use the Freeform tool, which I will show you later. If with the deep analysis, you don't like what you see and you change your mind, you don't like at all what you see, it's a pass and you go to another business. If you still like the numbers, if after going deeper into the numbers, you like them, at this point, you can add the stock to the watch list. If you like, for example, Disney, you understand Disney, you like at the first sight the numbers of Disney. If you go deeper, you like it even more. Well, at this point, you can add to the watch list. The yellow rectangle is the big watch list. And once it is on your watch list, you ask, does the business has a competitive advantage? So after doing some work, you see some metrics, you see some qualitative factors, you do the work. And after this, after determining if it has a competitive advantage or not, you do a valuation. And you can do it with multiples, comparable multiples like a PE ratio or the price to free cash flow. And the Stock Unlocks DCF, the discounted cash flow model. And between these two steps, well, what's the link? The link is that if you have found that a business has a moat, well, maybe this business, this stock deserves a premium valuation. And instead of having a PE of 15, maybe it deserves a bit more, like a PE of 20, 25. If there is no moat or very low moat, you don't need a premium valuation, and maybe a discount. So instead of paying a PE of 15, it deserves a PE of 10, 11. So that's the link between these two steps. And once you're done with the valuation, you see, if this is cheap, well, this is a buy opportunity. And if this is expensive, you put a target price on the stock and you monitor it from a distance. If the stock is overvalued, it's not a big deal. You just wait for the good opportunity to buy later. So you write a price. I think it's worth $100 and you wait. You can wait for months or years like this, but you added the stock to the watch list. So over time, you will monitor the stock price. So, and if it drops to your target price, this is the time to buy. So this process can work for the companies you're familiar with, the products you know, and we will go through this. And after you're done with the companies you're familiar with, you can check on Dataroma the super investor portfolios. So you will look at the best investors in the world, like Warren Buffett, and see what's inside their portfolio. And after that, when you're done with all the companies that you like in this website, you go to another website and then another website and then some blogs, some Twitter profiles, some Substacks, and then some stock pitches from investment funds. And then we will use FinChat Stock Screener, and then we will use FinChat AI Assistant. And if you still haven't found a good opportunity after all these different sources of ideas, you can analyze every competitor of the companies you saw. So you can do it with FinChat and you can do it with Stock Unlock. So this is a complete process where you will browse many companies, hundreds of companies. You can even go to thousands of companies if you do it right. So we'll start with the beginning. Let's start with the companies we know. And after you do the work from all these different sources of ideas, you add them to the watch list. You see the competitive advantages of each business. You do the valuation. And for hundreds of stocks, you will see if they are cheap or they are expensive. And you can buy all the cheap ones after you've done the work. Now you have understood the big picture of the research process. That's how I generated a lot of ideas and I found a lot of great investments thanks to this process, this method. But all this template takes a lot of time to do. So you need to be patient. So let the hunt begin. And let's start with the first step, which is to create a watch list with FinChat. We'll do it right now. Let's go to Chrome and let's go to FinChat. Let me log in with FinChat with my login address. And now I'm on FinChat's dashboard. So I can create a new watch list here, clicking on the plus. Okay, this is an empty watch list. So we will be able to add stocks here with key metrics. The second step is to start with the companies you're familiar with, the companies you know. So the best investments you can have are the most simple ones. And if you're already familiar with the products, well, that's a good start. For example, Apple, because you own an iPhone. Apple could be an interesting stock, or Google, or Starbucks, or Netflix. The products or services that you use in your normal life, well, they are most of the time listed in the stock market. They are public companies. So that could be good investment. And I like to do this exercise a lot because you never know where the next investment opportunities will come from. So that's an interesting idea, to just look at the products you use and see the companies behind them. Okay, so for example, you say, I like Netflix a lot. Why not invest in Netflix? The first criteria is, do you understand the business? Do I understand Netflix? Well, it's a streaming business that has been doing this for years and years ahead of competition. So yeah, I would say that I understand Netflix and how it works. You pay your subscription. I would say yes, I understand the business. So if yes, analyze the numbers. So let's go to Guru Focus to see Netflix stock and Netflix performance. So let's go to Guru Focus here. And when you're on their website, you will go here to the search tab and look for Netflix. And you will be able to see here equity summary. And here you are on Guru Focus to see some Netflix data. You have some Guru Focus score. I don't know if it's relevant or not, but that gives you an idea of the financial strengths, growth, profitability. You have some stock chart over 10 years. You can see the stock chart for all time, for 5 years, etc. What is really interesting in the Guru Focus websites are all these metrics that are already calculated, that you don't need to do it yourself, to calculate it yourself. And what is even more interesting is this part of the website, where over years, and you can see this starts from 2012, from 2023, you have the numbers, you have the revenue trend over time, you have the net income trend, EBITDA trend. Okay, let's just focus on revenue. You can see a smooth ride, and this is on an annual basis. You can look at quarterly basis or trailing 12 months basis, but I'll just focus on an annual basis. And you see some good revenue growth, okay, some net income growth that has beautifully increased since 2016. And after that, on this chart at the right, you have the cash level and the debt level over time. So you can see that since 2017, the debt level increased by a lot and then stabilized here, but nothing really risky, I would say. You have 7 billion of cash and 14 billion of debt, which means 7 billion of net debt for a company with a market cap of $250 billion. That means that you have to add 7 to get the enterprise value of $262 billion of enterprise value. Okay, that's the second chart. You have some financial position. If it's healthy or not, I would say it's reasonable. On the third chart, you have the cash flow. Oh, wow, you see some great thing here. You have some negative cash flow generation for years and years and years. Since 2020, you have some reversal. And then if I remove these and focus on operating cash flow, okay, that's very volatile. And if I focus on free cash flow, this is the same trend. So the business has been generating some cash flow recently, but nothing extremely good before in the past. And this is at the right the comparison between ROIC, return on invested capital, and the WACC, weighted average cost of capital. So you can see over time that this ratio has been oscillated and it has been not smooth at all. And this chart is also interesting. You see the buybacks over time, or where there has been share issuance over time or share buybacks over time. So you see most of the time an additional share count, more shares, and in 2023 some change. You have some buybacks, 2%, 3% buybacks, nothing really extreme. Okay, so I would say that revenue growth is here, net income growth is here, but there is some strange cash number, some strange cash generation. And I believe that's because of this business model of Netflix, where they have to reinvest every cash flow they have into the business to generate more content and more content and more original content. So that's part of the business, I believe. We will see later if it's very risky or not, but now you have the idea. And GuruFocus has an estimation of fair price over time. This can vary, but you have a rough estimation of, in their opinion, if this is expensive or cheap. And you've seen this beautiful 70% crash in 2022, where the stock was extremely cheap. Also, you have a couple of ratios here on GuruFocus. There are a lot of ratios, so maybe focus on the main ones, like the gross margins. You just see the current gross margin. You don't see historical gross margins over time. You will have other websites to see the evolution of gross margins over time. But now we see the current gross margins, like right now, operating margins, return on equity, return on assets, which are good, return on invested capital, okay. I will not look at this. I would not look at this. I will look at the PE ratio, which is at 50 right now. Forward PE ratio at 35. Okay, so we have some growth estimated for next year. We have some PEG ratio, which is quite high at more than 2. And price to free cash flow is here at 38. Definitely expensive. Okay, and for these liquidity ratios, I will look at the current ratio, where I see that the current assets are higher than the current liabilities. So in the short term, they can be quite healthy. They are quite healthy, and they can survive in the short term for any negative shock, I would say, in the short term. So, okay, and you have some buybacks program. You have no dividend. Okay, only some buybacks recently. Okay, that's the first website. Let's go back to our pages document. So GuruFocus is the first website here to analyze the numbers. Now let's see ROIC.ai. So ROIC.ai, let's look at this. And this is this website where you will look at Netflix. Let's go to summary. And we have these page. In one page, you can look at all the financials over time. I think it's really useful to see the correlation between, for example, per share metrics and the stock price over time. And you have the revenue per share, earnings per share, free cash flow per share. As we've seen in GuruFocus, you have some negative numbers for the free cash flow per share over time, and then some reversal, some big reversal, big time in 2023. But over time, revenue per share has increased by a lot. And in the last 10 years, I would say, it went from 10 to 70. So that's a lot. And same for the earnings per share that were very small, very low in 2010, 11, to now at EPS of 10. So that's some great growth here. You can also look at the basic weighted average shares, so the number of share, the share count, which were at 370 in the past, and now 440. So more shares, which diluted shareholders. Do you see the operating margins over time? Okay, so some 12, and then 1, and then 5, 7, 5, 4, 7, 10, and then double digits. Oh wow, 20, 18, 18. So okay, some changes here. I don't know what they did here, but okay, you have some decrease in margins. The effective tax rate is here and it changes over time. Okay. The profit margins, I believe, followed operating margins, which means single digits here and double digits here. Okay, that's very true. You have the long-term debt that gradually increased, as we've seen on GuruFocus. And in 2017, you have some big growth in long-term debt. And now the company is slowly decreasing the debt, but it's still high, which means you have a return on invested capital that varies a lot. Okay, ROIC of 5% and then 15%. And the return on equity here at 20%, I would say. Okay, so you have some growth. The good news is that every quarter when they release some earnings, there is a conference call, and on ROIC.ai, you have a you have a transcript actually of the entire conference call. So if you think that the CEO said something about a specific topic in, I don't know, 2022, you can look at the transcript here and find a specific word, find a specific topic that that is interesting to you. Now this website puts a PE of 57. That's why I said it's important to have a rough idea of valuation and not a specific number, because you can twist your number when you want. GuruFocus told us that, GuruFocus told us that we had a P ratio of 49 and ROIC says 57. So, okay, I would say roughly expensive. And if we go back to our template, we see that the next website is Macro Trends. Let's look at Macro Trends. Now we have a better idea of the numbers, how it works. Macro Trends, Netflix, I would say. Now we are on Macro Trends. We have different tabs here. Let's start with revenue and profits, where we will be able to see close, when we will be able to see some financials over 20 years. Okay, so this chart starts in 2009. And so this is trailing 12 months. This is quarterly. And this is the quarterly growth. What's that? How can I remove this here? In 2011, you had a lot of growth. And then it slowed down. And now you have overall 30% growth of revenue that has substantially dropped in 2022, which caused the stock price of 70%, as we've seen before. That's the revenue for Netflix. You can also see the trend, the long-term trend of net income over time. And this is quite different from revenue. My guess is that they had a specific profitability business model that changed in 2017 for some, I don't know, economies of scale, for some ads or for some budget that changed in 2017. But net income increased a lot since 2017. And I believe this led to earnings per share, which follows the same trend of net income. Okay, if we go to margins, I think we will have the same results as we've seen in ROIC, which is the gross margins over time since 2009 of approximately 30%, and it recently went up to 40%. The operating margin over time that fluctuated to sometimes 1%, sometimes 4%, 7%, 8%, and now it's up to 15%. So the net margins were really low in 2012, and now it's quite high at above 15. Okay. And over time, what is great with macro trends is that you can see price ratios, so PE ratio over years. And as you see, this is the stock price, this is the EPS, and this is the PE ratio. As you see, with the big net income, big earnings per share spike since 2017, the PE ratio decreased substantially. So you have a PE ratio that went from 200 to 15 or 20 because earnings went up a lot. On the other ratios tab, you see the current ratio. So how healthy is the balance sheet in the short term? You see that it's quite healthy. And you see, for example, return on equity, return on assets, return on investment. But I think I have a fair, oh wow, that's some return on equity of 2%. And then it went up over time. I think it's all linked to net income. The net income was so bad in 2012, so every ratio looks bad in 2012. So, but it increases over time, and that's good news. Okay, so let's go back to our template. Now we have a fair view of, okay, stable revenue growth over time, but about profitability and cash flow generation, that's a mess. That's a mess. Okay, net income has increased substantially in 2017, and this situation is linked with the debt. Maybe there is a correlation between the two. Maybe they need debt to be profitable. That's some good question. And about the free cash flow generation, we see that it's a mess, and I believe Netflix doesn't want to have cash flow at the end of the year. They want to reinvest all the cash into their business. And that's, I believe, part of their business model of reinvestment to have better content every year. So, okay, some increase in share counts, some long-term trends of improvement of margins since 2012. Okay, so if you like these numbers, you can go deeper. And if you don't like this number, you take a pass and go to another stock that you like. It can be another company that you're familiar with, Disney or Google or Microsoft, or you can just go to the second step of the second source of investment ideas. So let's say we like the numbers and we want to go deeper. We can analyze the numbers with Stock Unlock. Let's go to Stock Unlock right now, and let's look at some numbers. Sign in. I just signed in to Stock Unlock. This is my dashboard with my eToro portfolio. And if we go to the search tab and we write Netflix here, we will see a lot of data. And if you prefer, you can switch to light mode or switch to dark mode. That's your preference. And what we can first see is the insight score that Stock Unlock gives to Netflix. This is the score. Stock Unlock does a compilation of every metric that could be growth or financial health of the balance sheet or the positioning of the company or the moat, competitive advantages, return on investment, big improvement of margins over time, or valuation. It takes all this data and condenses it into a score. The score can go from 0 to 5. So if it's above 4, it's a very good investment, I would say. Right now, Netflix has a score of 3.53. So you have some very good insights, 6. If you look at what is below, you have all the metrics that constituted this score. You have some very good insights, some good insights, average insights, 2 bad insights, and 4 very bad insights. So if you scroll down, you have a lot of metrics, and you can look at the very bad insights, for example, which dragged the score down. And for example, one very bad insight is the next year projected EBITDA. EBITDA is a type of profit that is used by analysts, and it's earnings before interest, taxes, depreciation, and amortization. So this growth is estimated to be very bad. Okay. The second very bad insight is average analyst price target. So a lot of analysts in Wall Street think that the stock will go down in future years. Okay, I don't care about this. Another very bad insight is the intangible as a percentage of total assets. So that raises question. And the final one is the tangible book value is negative. Okay, so these two elements at the right, they raise some questions about our analysis of Netflix. And that's what I like most about the Stock Unlock Insight score, is that you can just put the ticker or put the name of the company, you have a score, okay? So that gives a first indication of whether the stock is good or not. And if you look at the bad insights or very bad insights, you have some red flags of the company. So things that maybe you missed during your analysis and things that you have to be aware of. Why are the intangibles as a percentage of assets very bad? Why is the tangible book value negative? If you have to dig deeper, that's where you will find the information. Okay, so we have this good score. I would say it's a normal score, 3.5. It's not nothing extremely good, and you have some average value for the current ratio, some shares decreasing, which is good. What is very good about Netflix, you can see 6 elements. That will be maybe the main reasons why you buy Netflix at the moment is because of these good and very good insights. We can look at this. There is next year projected earnings per share that are very good. So the company is expected to grow a lot. That's great. You have some growth in revenue too. You have some shares decreasing. You have what is very good, the cash conversion. So we've seen that recently in 2023, Netflix generated a lot of earnings and a lot of cash flow, but I would not trust these very good insights because that's just a one-off event. And we've seen from previous websites that the free cash flow generation is very volatile. So, okay, but you have the information here. What is very good is the operating cash flow increasing. For the same reason, I would discard these elements from our thesis. Free cash flow increasing, okay, that's just temporary. And you have some management with share-based compensation as a free cash flow, return on invested capital, return on capital employed, which are very good, and I agree with that. The price to free cash flow is 36, is below the 5-year average of 180. Okay, they put it with the very good because that's also part of the analysis. As we said previously regarding valuation and comparables, these valuation tools like the P/E ratio or price to free cash flow can be used to compare the current PE to the historical numbers of P/E ratio. So you can compare the current PE to the 5-year average, and indeed it's cheaper than in the past. So I understand why they put this. For Netflix, it's a growth stock, so in the past we had an extremely high valuation, so maybe this is not really relevant to have a very good insight for this reason. But on average, I would say that this metric is very good, and that's a very good addition to Stock Unlock. So, what is in this page also? Netflix is in the media industry. Yes, you can have some industry insight. What if we click here? Industry characteristic. That's great. That's great. If you don't know how the industry works, you have some information here. Okay, so you have a score, which is good. You can look at the financials if you want to manipulate some numbers and again have some charts. And for example, for the past, let's see, 2023, you have to move to the right to see other numbers. I prefer to do the reverse and see the revenue from 2004. So that's why I started with 3 websites like Guru Focus, ROIC, and Macro Trends, because as we've seen, these 3 websites have a number that go back to 2012 or 2009. The advantage of paying websites is that I can go back to 2004. So I can really understand the revenue growth over time. And for 20 years, I have all these data. Let's look at the figures, yearly figures, and you have some graph here. So that's some quarterly figures. You can see the evolution over time, trailing 12 months, yearly. Okay, you have some amazing growth over time. And okay, let's go back to further. Okay, 2004. Add percentage change line. You can see the evolution of the revenue of Netflix over time. And in the beginning, it was very small. So that's why the revenue growth is insane, plus 46%. Then in the great financial crisis, a decrease of growth, but still growing, which is great. And then a comeback of growth, and then a slowdown, etc., etc. If we look at the trailing 12 months, I believe growth has come back. So if you look at quarterly measures, okay, so you see some small reversal here that's still in process. Okay, so you can go through everything, every line, every aspect on a quarterly basis, on a yearly basis, on a trailing 12 months basis to see all the information of the income statement with some good lines on some good tables. There is a chart here that you can see over time since 2004, which is great. And you have a lot of nice colors. You have the same information for the balance sheet. You see the current balance sheet with all the assets and liabilities, and the same way you did with the income statement. You can look at numbers since 2004 for assets, current assets, the debt, etc., with some good trends over 20 years. Same for the cash flow statement. You have all this information since 2004. So there is a mess here of net debt repayment. Okay, so okay, that's when the debt increased. Okay, what a mess. Okay, that's a cash flow from operating activities that you see the big spike. You have some reversal here when the company generated some cash flow. And again, for all the metrics, you can see some big graphs, and that's some metrics over time, like the free cash flow margin, gross margin, operating margin, net margin, everything that you need about the evolution of a metric. Everything that you need here is in Stock Unlock, so that's great. In this tab, you have some dividends, but the company doesn't pay a dividend, so it's empty. But let's focus on the main aspect of Stock Unlock. We saw the insight score. And in the right, you see view in free form, which leads to this page. And this will show some good graphs. For example, if you want to see operating margins over time, operating margin over time, you have this, and you can compare it to revenue growth to understand how it works. And I believe that if you do free cash flow here, you can see, let's see that it is not at all correlated. You have some revenue growth, but free cash flow is just not here. So that's some quarterly, yearly, trailing 12 months as you want. And you can change the format of this table if you prefer like this or like this. What is really interesting, and let's see if I compare net income, for example. What is really interesting with the freeform tool is that below you can have the low, the average, the median, the high, the latest, and the CAGR over time. You can have the compounded annual growth rate of revenue. So you can see 26%. And you can see, same thing for net income, a CAGR of 46% over time. And Netflix is definitely a growth stock. If you compare to, I don't know, Disney, so maybe that's a similar company and you want to compare Netflix numbers to Disney's numbers. Disney numbers go back to 2000, so we will just compare them from 2004 or something like this. It doesn't matter, 20 years ago. And if we see the CAGR of revenue for Disney since 2004, we have 6% compared to 25% for Netflix. And for Disney, the net income CAGR is 1% compared to over 30%. So that's a different animal, and maybe that's why the stock deserves a premium. And if you want to remove Disney here and just see the PE ratio over time, oh no, I have to put price. Earnings ratio, you have price to book, price to free cash flow, everything, and you see the evolution of the PE ratio. You can see the big spikes, and PE ratio has been very volatile. It went up to 500, 600, and then went back to reality at a PE of 30, 20, etc. So it's not important to look at CAGR here. It doesn't matter. Just have the average of 117. But if we go to recent data, you see that with earnings increasing bigly, you have a P ratio that went from 200 to 15 to 30, etc. So compared to historical figures, that's quite cheap. And it was quite cheap here for business growing that fast. A P ratio of 15, I would say it's a great deal for a business of this quality that everybody knows that is great with huge pricing power. I would say that it's a good deal at a PE of 15. Right now you have a PE of 46. Okay, so that's the main tools that you can use with Stock Unlock. You have the scores, the insight scores, where you can have some red flags of the business. So things that you have to look at and monitor, and maybe this will raise some questions about the business. And overall, if the company has a good insight score, you can say it's a good stock, a good investment opportunity. And if the score is really bad, well, you can say it's not a good investment opportunity right now. And the big thing with Stock Unlock, the big tool is the free-form tool, where you can really manipulate numbers and compare metrics with competition, with other companies for 20 years. So the data comes back really, really far, and we've seen numbers since 2004. So you can really see the long-term trends of financials over time. Let's go back to our page document. So if you don't like the numbers from Stock Unlock, if you say, no, I don't like the change in free cash flow, I don't like the big profitability spike in 2017, I would prefer to have slower but more stable growth, like 7% growth for 20 years. I don't like the volatility. It's a pass for me. Well, you can pass and look at other opportunities. You can start back at the first step, start with the company you're familiar with, and start analyzing, I don't know, meta platforms. So with Facebook and Instagram, etc. This could be a good investment opportunity. Or Apple, for example. And if you like the numbers that you've seen on Stock Unlock and you've done some calculations and you've done some analysis of the long-term trends, if you like the numbers, you can add Netflix to the watch list. So that's the big yellow rectangle here. So let's go to FinChat, add stocks here, and we will add Netflix in our watch list. Here, save stocks. Perfect. Okay, this is the only stock we have on our watch list, and you have some data here: ticker, number of shares, market cap, enterprise value, 3-year revenue CAGR for 5 years, etc., etc. I will just put my favorite metrics here: revenue CAGR, diluted forward PE. Okay, let's remove every metric we have here, and let's put CAGR. And let's put the 10-year revenue CAGR in our watch list. Also, let's take the 10-year diluted EPS CAGR, and let's add the return on invested capital here. Let's add the return on equity, ROE, and the PE ratio. If I put PE, no, I would put price, earnings yield. No, let's say ratio. Okay, that's the forward PE ratio. That's the PE ratio here. So Let's leave here and move this. That's just my personal preference. I will start enterprise value. No. But to compare market cap and enterprise value, that's the net debt. And I will just add the net debt. That's just my preference here. Debt, net income change. Okay, so let's just add the net debt here. Okay, so in my watch list, I want to see the market cap, the ticker, revenue 10-year CAGR, the diluted EPS CAGR, so I can compare the growth in 10 years for revenue and earnings per share. So I can see, okay, this company has grown more profitable with more earnings compared to growth in revenue. I can also see the return on invested capital right now, which is 13%, the return on equity 26%, some good operating margins. You know what? We'll just remove operating margins. And you have a P/E ratio of 48 and a net debt of this 9 billion. Okay. Maybe I will just add price to free cash flow price to free cash flow. I like this a lot. And okay, that's a price to free cash flow of 40. Okay, that's our watch list. I've put the metrics I like, and whatever metrics you like, you can just adjust your watch list. So you can compare, I don't know, if you like cash from operations, if you like to observe margins over time. And when we will add, I don't know, 10, 20, 30 stocks in our watch list, we will see the growth in EPS for every stock we have here. And we will be able to compare the return on invested capital for the 30 stocks that we have on our watch list. So that's why I like creating a watch list on FinChat. I think it's great. And you can compare numbers with different companies that you have on your watch list. Okay, let's go back to our template. Does the business has a competitive advantage? That's where some work has been done and it takes some hours sometimes to do. You need to understand the business model, yes, and you need to do the qualitative stuff of having a moat, etc., as I've shown you before. So that's where you have to do the work. There are some qualitative stuff like network effects or brand recognition for Netflix, but on a pure quantitative metric, I would say that you can look at the charts from FinChat that are really helpful. Go to Netflix. And the metric will be return on invested capital. Popular section was that. No. Income statement, I would say ratios. Maybe if I just put return. Okay. Return on invested capital here, and you see the evolution of the ROIC over time. You see a disastrous 2012. That's normal, and you see the evolution over time. So not a big moat if you only look at quantitative numbers and you see a return on invested capital of 10, 12, 13%. You may say, okay, the moat is quite low on a pure quantitative basis. Let's look at gross margins. Gross profit margin here, and you see the evolution since 2004 of the gross margin that goes up. So that means more pricing power. So Netflix is allowed to increase their prices without losing customers. So that indicates a good moat. If you can increase your prices every year and your Netflix subscription goes from $12 to $13 to $14 to $15, and your customers will still pay $15, well, that's a good indication of a good moat. And for example, there are other things that you will not accept as a customer if the prices change. If you go to McDonald's and you have some burgers that is sold for $8, and then next year it goes to $18, you will not take the burgers. But for Netflix, if it goes from 10 to 20, a lot of people will keep watching Netflix for $20 per month. So yeah, that's some good indication of competitive advantage. After that, if you want to do more work on competitive advantages, you can do the qualitative aspect of it. And if you want to know the strategy of the business, you can go to Google and see Netflix investor presentation. That will be the business stock pitch, the presentation from the business, letter to shareholder, financial statement. You will have everything you need here. And for example, if you want to understand the mindset of management, you can read the entire letter to shareholders. So you can do some deep work on this for this year, but also for last year. And if you don't want to read, you can watch some videos, because all these data, all these documents are also in videos. So you see if the company has competitive advantages, you compare numbers, you compare qualitative stuff with competition, you compare, I don't know, the churn rate of Netflix compared to Amazon Prime Video or Netflix Plus or Paramount. You do the work, and in future modules in this cool community, I will show you exactly how to identify a moat, how to identify a competitive advantage. It's really useful, but sometimes it takes a lot of time to see if a business really has some competitive advantages. If you have some numbers like this that give a mixed view on the moat, well, you can do some qualitative stuff about the vision, about competition, etc., etc. So we will say that for Netflix, let's say we don't think there is a wide moat because it's a streaming business and you have some good competition like Disney or Amazon Prime Video, which is as good, but you don't have no moat. You have a brand recognition and the business has been here for years and years before everybody else. So let's say you have a narrow moat or medium-sized moat. So maybe it deserves a premium valuation, but not a big premium. The next step is to do a valuation with multiples and stock unlock DCF. As we've seen before on stock unlock, the price earnings ratio, even though in 2020 you had a PE of 80 and now you have a PE of 45, I think that's still expensive. Another tool that you can see when you compare some valuation is the tool from Stock Unlock, where you will go back here to the Netflix tab and go to the DCF tool. You click here and now you have this interface. And this looks a bit odd right now because it's a calculation based on free cash flow. And as we've seen before, the free cash flow has been quite volatile. So we can just compare earnings that has been more stable, I would say, or maybe operating income, or that's the same. Let's go to net income. So with the DCF model, we project net income over future years. And let's say we want to project 3 years. 3 years of net income. The website indicates that the growth rate has been 13% over the past 3 years. So they say, oh, if we have the same growth rate than in the past, it will grow 12%. Let's say that I think it will grow 7% earnings over the next 3 years. What's the buyback program? The shares have been decreasing 1% per year over the past 3 years. Let's say they stop buyback. It was a one-off event and they won't do any buybacks in the future. What's the price earnings ratio after 3 years? Well, now it's at 47 or 50, something like this. I think it can go back to 30. And then you have your discount rate, which is 10%, and I will keep it at 10%. Well, if you have these estimations for the next 3 years, the earnings will grow at 7% per year with 0 buybacks, and at the end, the PE ratio will be 30. So the average PE ratio in the past has been very high, and the average PE ratio for the S&P 500 is, let's say, 15. So it deserves a small premium because there is some moat competitive advantage. Okay, I will not put 30 at a PE ratio. If it deserves a PE ratio with a premium, I would say 25. And it happened in the past. In 2022, Netflix had a PE ratio of 15, 20. So it can happen in the future also. Let's say it deserves a small premium and we have a PE ratio of 22, 23, 25. Okay, you have a rough idea. With these estimations, with these forecasts, we have a fair value of minus 50%. That means that the stock is overvalued by a lot. And if you invest right now, you have a estimated CAGR returns of minus 13%. So with these forecasts, Stock Unlock doesn't recommend to buy the stock. And if you think that the business will not grow 7%, but it's very strong and it will grow 30%, you never know. And the price earning ratio at the end of 3 years will not be 25, but will keep the ratio that it has now at 45%. Well, you have a fair value at plus 60%, which means if you invest right now, the expected CAGR is plus 28%, which means the stock is cheap and you have to buy it now. And if you reduce the growth rate, 20%, you have a cheap stock, you have an undervalued stock. And you can project for 5 years or 10 years, but that's just insane if you project these kind of metrics for 10 years. So let's just keep it to 3 years. And now, it resetted my numbers. So let's just say 15% growth, 0 buyback. And you will keep your PE ratio of 45. And it means that if these are my assumptions, you can play with the numbers. But if these are my assumptions, the fair value is plus 10%. So it is expected to grow at 13% per year. Right now, I think the business will go at, say, 80%, and the PE ratio will go back to 25, which means the stock is highly overvalued. So if I go back to my page document, I do valuation with multiples, which indicated high valuation, P of 49, something like this. So I'm not comfortable paying a P ratio of 50. And we did the Stock Unlock DCF model, which gave me an overvalued stock of 50%. So I would be able to buy this business at half the price that it is trading at now. So yeah, the business is very expensive in my opinion. So no, it's not definitely not cheap, so not to buy opportunity, and it's expensive for me, in my opinion. So I put a target price and monitor it from a distance. So my target price, as I said, is approximately $300. So if it goes to $300, I will be seduced by it and I am likely buying the stock. Let's go back to our watch list here, and you have the net income. I can also add the price here, stock price. Okay. And let's look, where is it? It's here. Market cap, price, here. Okay, I added my target price to this column, the average cost basis, so I can have an idea and compare it with the current stock price of approximately $600. You can personalize your dashboard as you want. And if you click on performance here, you have 1 month performance, year-to-date performance, 3-year, 5-year, 10-year CAGR. And since inception, I believe in 2004, or something like this, you have some 30% returns on your investment. And with FinChat, what is really good is that for every stock that you have on your watch list, you have some news related to the stock in your watch list. So to monitor the stocks, for example, if you think they are overvalued, well, there can be some news that you want to monitor to have some information about the competition, of if there are changes in the business model. And this could be useful if you want to monitor them from a distance, but also for the stock you own that you have bought. You just added them to the watch list, so you will have the news here, and you will have all the information you need, all the news that happened in the world that impacted Netflix, for example. Okay, so if we go back to our template, our process, we did everything here, and it passed all the criteria. I understood the business. I did some analysis of GuruFocus, ROIC.ai, macro trends. I analyzed the lines, the long-term trends. I like the numbers, so I continue with Stock Unlock with the insight score, which raised some red flags, and I saw what is good, what is bad about Netflix. And using the free-form tool, I used Stock Unlock to see numbers in detail, and I liked what I saw, so I added the stock to the watch list. And the step after this is to analyze competitive advantage and to compare with competition, for example, or to analyze ROIC or gross margins. And with that, I estimated that the business deserves a small premium in valuation because it has quite a small moat or medium-sized moat. So the valuation with the multiples and with the DCF leads me to the conclusion of it's still expensive. Despite the premium of the valuation, it's still expensive. So I just go back to the watch list and add a target price on my stock. And that's an example of stock analysis that you can do to fill your watch list with great stocks. And if you're done with all the companies that you know and the products you use in your life, and you added your favorite ones to your watch list, well, you can go to the second step of looking at super investor portfolios on Dataroma. Dataroma is a website that compiles all the all the stock portfolios from the best investors in the world. So let's go to Dataroma right now. And you will see super investors, Dataroma. And when we are on Dataroma, you can see all the portfolios from all the best investors in the world. So for example, if you want Monish Pabrai, the best Indian investor, you have his portfolio, his portfolio here. So 4 stocks, okay? If you want, for example, the best of the best, well, you have Warren Buffett here from Berkshire Hathaway. You have his entire portfolio of Berkshire Hathaway here. And you see the first position is Apple, 50% allocation, which means half of his stock portfolio is in Apple. And you see Bank of America, which represents 10% of its portfolio, American Express 8%, Coca-Cola, Chevron, Occidental Petroleum, etc., 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 to the smallest position of his portfolio. And if you want some ideas, you can clone ideas from these investors. Because if Apple is in Warren Buffett's stock portfolio, you can say that Warren Buffett likes Apple stock. You can say that Apple passed the Warren Buffett filter. And if it's good enough for Warren Buffett, it's good enough for me, it's good enough for you, it's good enough for every other investor, because that's the best investor in the world. And all the companies that you see here are potential investment that the best investor in the world likes. That means that instead of looking at the companies you know, like Starbucks, Netflix, etc., you can look at companies that the best investors in the world have. And you can go through the entire process of looking at Guru Focus or macro trends, and then Stock Unlock, FinChat, valuation, etc., etc., for every one of these businesses. And for the Berkshire Hathaway stock portfolio, you have 41 stocks. So you can go through the 41 stocks and ask the question. For example, let's start with Apple. In our template, we have, do you understand the business? Yes. You go to Guru Focus, macro trend, ROIC.ai, you see the numbers. Imagine you don't like them. You say, okay, no, not for me. You take the other one, Bank of America. Go back to the first question. Do you understand the business? No, it's a bank too hard for me. I'm not a banker. I don't know how it works, etc. I don't use their products. No. Go back to another one. American Express. No. Coca-Cola. Yes, I understand the business of Coca-Cola. I go to Guru Focus and I like some numbers. I go to Stock Unlock and the inside score, for example, gives me a very bad score. Oh, you know what? Let's see the score of Coca-Cola. The ticker symbol is CO. And let's see the score of Coca-Cola. 3.29. It's average. You say, oh no, I don't want average companies in my portfolio. I just want good or very good companies. So no, just for this reason, you look at the bad insights here and say, okay, that's reasonable and that's not fake, that's bad for a reason. For example, you can have some bad valuation or bad growth, etc., etc. I'm not doing it here, it would be too long a video. But yeah, you don't like what you see, bad stock unlock score. Okay, let's go back to the first step and go back to our source here. Chevron, Occidental, Kraft Heinz, Moody's, you do every single one of these companies and you just focus on the companies that you understand. To see if you understand the company or not, just go to their website. If you understand their products, what do they sell, it is easy or not to understand. And you will see if it's too complex for you and you don't understand what they sell, even after looking at their websites, it's maybe too difficult. It could be too difficult for you, but for somebody else, very easy because they are very comfortable in this industry. For example, maybe I'm not comfortable investing in Bank of America, but another person can be very comfortable investing in banks. So that will bring them to the other steps. And after you're done with Warren Buffett, you can get lost and look at every portfolio you see here. Bill Miller, for example, that's a pop-up. You can look at Bill Miller's portfolio and do the exact same thing of going and looking at Stellantis, Western Alliance Bancorp, etc., 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 etc. You have the whole process, the whole method of do you understand the business? Do you like the numbers? Do you like the numbers in details? And if you like everything, you add them to the watch list. You understand the competitive advantage. Does it have a competitive advantage? You do, does it deserve evaluation or not? You do the valuation with multiples or the DCF, and you see if it's cheap, well, that can be a buy territory. And if it's expensive, well, you put a target price and you leave them alone and you monitor them from a distance. You do it again, again, and again. And I get asked a lot of the time, where do you find your investment ideas? Well, most of the time, I just clone the best investors in the world. And I think Dataroma is a very, very good hunting ground. A lot of people say that cloning ideas is like stealing ideas, but I don't think it's true at all. It's just getting inspiration from the best investors in the world. If the investment and if the stocks passed their filter, the Warren Buffett filter, the Bill Miller filter, I think it's some great filters. If, for example, take for example the biggest position of Warren Buffett's portfolio, Apple. If it's 50% of the stock portfolio of Warren Buffett, it is there for a reason. It's because they like Apple a lot. So maybe I will put more emphasis, more work into Apple stock and pay a lot of attention to financials, to the mode, how does it work, competition, iPhone, Android, all of these things, the smartphone markets. You can get lost online, and that's great to just look at articles, news, see how it works, etc., etc. I can clone the best ideas from the best investors in the world, and you have a lot of stocks over there. And if you click on the S&P 500 grid here, you will see all the stocks with a lot of ownership from a lot of gurus. That means that if the stock is here, it's Alphabet, it's a stock that a lot of gurus own. So it's worth paying attention to it. Same for Microsoft, Meta, Amazon, Berkshire Hathaway, MasterCard, etc., etc., etc. You can just look at all these stocks and see all the numbers and compare all the numbers for all these stocks. And these stocks have to go through all these filters to get added to the watch list. And after you do the work, you can buy them. And I think with the first two blue rectangles, you will have a lot of ideas. And you will see a lot of trends, a lot of good financial fundamentals, a lot of bad fundamentals, and you will wonder why a good investor has invested in this company. Maybe they know something, maybe they understood something that you didn't. You never know. But remember that quantity wins over quality in this game, and you want to see as many stocks as possible. Maybe every 1 out of 10 stocks, you will see the business, you will understand the business, you will understand the numbers, you will like the numbers a lot, you will directly understand the competitive advantage over competition with qualitative factors, you will do evaluation, and the stock will appear cheap. And this is the opportunity to strike. That's what you want. That's your secret formula. And if you turn a lot of rocks, if you analyze 100 businesses, you will find 5 or 10 good stocks. And if they are at the good price, this is the time to buy. And after you've analyzed all the stocks from all the gurus, all the best investors in the world, I think it's a very, very good hunting ground. After you've done all this work, you can look at Value Investors Club. This is a website. Let's go to it. Value Investors Club. And in this website, you will have stock ideas written by individual investors. For example, here you have a stock pitch about Energean. So somebody wrote about this stock and did the analysis for you. So the key metrics, attractive valuations, the conclusion, what are the catalysts, the competitive advantage, smart management team, capital allocation. They did the work for you, so you can, if you understand the business, you can go deeper. If you don't understand, you watch another one, another one. I think if you don't have an account, you have a 3 months delay. In this computer, I didn't log in, but yeah, if you create an account, it's very easy and you have real-time information, real-time analysis live. And for example, if you want to have more information about Netflix, for example, that you like a lot, you can just type Netflix here and you will see that there are plenty of articles written about Netflix in 2003, but also in 2022. And for example, if you take the latest article, it was written in October 2022 when the stock crashed and lost 70% of its value. And somebody wrote an analysis of Netflix and why he or she thinks that the stock is undervalued and can go up. So people do the analysis for you. Well, they are humans, so there can be mistakes in the analysis. But if you read every article on Netflix since 2003, you will get a better understanding of the competitive advantages, of the risks of investing in Netflix, of competition, of margins, of valuation over time. And if you go to the search bar and you look at Netflix, if there is an S, it's because people were short Netflix. So they think the stock price will decrease. It's very interesting to read short position equity research reports because they give you the other side of the coin. They give you the negatives of investing in Netflix and what's wrong with the stock, what's wrong with the company, etc. So you can go back to idea, and if you're curious, you just look at every company that is being pitched in this website and look at everything. And you have an infinity of stocks that you can look at here again and again and again and again. You have an idea generation process that is infinite. And again, if you read some article on Value Investors Club and you like the idea, you go through the filters. You go to, do you understand the business? If yes, you analyze the numbers. If you like the numbers, you go deeper. If you like the deep numbers, well, you add it to the watch list. Again, competitive advantage, valuation, DCF, and then you have your conclusion. So if you want to look for new stocks, Value Investors Club is great, but you can also use this website if in the method before, for example, you go on Dataroma, you look at Warren Buffett's portfolio, you look at Apple, and you want to know more about Apple, well, you can just go to Value Investors Club, write Apple, and you will get plenty of articles, plenty of analysis about Apple. People that do the work, and they will tell you a lot of things about the analysis, the fundamentals, the competitive advantages, the margins, the CEO, the management, the products, the change in management, the change in products, what are the future products that will impact the business model, etc., etc. So that's very useful. After that, if you want more stock ideas, you can go to 555 Rousseau Student Investment Fund. That's an investment fund. And if I copy paste this to Google, I will find this website. And in this website, you have an investment fund that is managed by students at Columbia Business School. And you see plenty of articles, plenty of stock analysis here made by students that are very high quality. And for example, if you like a specific company here, say Cintas, somebody wrote something about Cintas. A student wrote a deep analysis of Cintas in 2020. So they have some numbers here. There is a summary, investment thesis summary. People do the work for you. You don't have to look for the numbers. You don't have to check the numbers. They are here. And they have the pros and cons of investing in Cintas, the market share analysis, what do they do, etc., competitive advantages. You have, how many pages is that? 10 pages about the analysis and a lot of sections, base case, bear case, what are the risks. You go through every one of these stock ideas. For example, you don't understand these businesses, but you understand Cintas. Okay, go back to the method and ask yourself, do you understand the business? So yes. Go to GuruFocus, ROIC.ai, and MacroTrend and see the numbers from a bigger time frame. You can also look for deep numbers and dig deeper into stock unlock, add to the watch list, etc., etc. You continue your process. But in this website, Rousseau Student Investment Fund, you can have plenty of ideas, and most of the time, these are great companies. So the work has been done, and the number here is the year the article has been written. So this has been written in 2023, this in 2020, 2021, a lot of things. The next source of idea that I use is some blogs, Twitter, and some Substacks. So for you, I have written everything, so you can copy everything. And I'm giving you everything away for free. These are my favorite blogs. These are my favorite Substacks that I use. And I will show you every one of these websites that I use very regularly. I'm sharing it with you for free because you deserve it and you clicked on this video. So this is the first link, the corner of Berkshire and Fairfax. This is a forum where people can just come to the forum and exchange ideas. I don't have an account on this computer, but it is very easy to register, and people are just chatting about the stock market. And they think it will impact specific stocks. What do you think about insurance brokers? People will give their opinion. Well, you will just see every ticker symbol that you have here. You say WTW. Okay, what's that? WTW stock. What's that? Willis Tower Watson. Okay, the stock price looks like this. And again, for every company you find through the forum, you go to the same process. Do you understand the business? Do you like the numbers? And etc. etc. The second blog that I use a lot is this one. Is Invest Seekers. This guy writes good articles, good analysis of a lot of stocks for free. For example, let's look at this one, Applied Materials. He writes a complete analysis of a company, and you can clone his idea. You can just read what you have here, and if you like it, go through the different filters if you understand it, if you like the numbers, etc., with FinChat and with Stock Unlock. But just these are some ideas that you can clone from this website. Another blog that I use a lot is this Substack, Wolf of Harcourt Street, where again you have plenty of ideas. So you go to this website and you check every one of the stocks that he mentions here. You check everything. And if you want more, let's go through another one. This Substack, open with Chrome. Let's go. And this is another Substack called Stock Opine. And look at this. Hashtag. What's this company? Some articles on margin expansion. Paychecks. Okay, Booking Holdings. Okay, you can just click on it. What is it about? And you have everything. As you see here, this is blocked because you have to pay to see the whole article. Some articles on Substack you have to pay, but most of the time you can read everything. And for this example, I can only read maybe 20% of the article. Well, you have the stock idea, you can do the work by yourself. Another Substack I like a lot, let's see, here, open with Chrome, is Brille Capital, Thursday Think Tank. Here you have other companies that you can do the work on. Again, RH, TinyBuild, Evolution AB, BitDang, etc., etc., etc. Just clone every idea you see here, and that's some inspiration. Another one, I'm giving you everything, guys. Chrome, let's go to this. Long River. You have to sign up, I believe, to have these analyses, but that's very detailed analyses with great companies. So go to Long River, sign in 2 minutes, you have the articles, that's for free, completely for free. Another one is, let's see, this one. You don't even have to do the work. I mean, the stock idea generation process is automatic. You just see what the best guys on Substack, what they write about, and you copy their investments. Sleepwell investment, deep dives. Let's go to deep dives. Everything. You have everything. Viva, Will Scott Mobile Mini, NVR, Thor Industries, MIPS, everything. I continue, even though you have to pay to see the complete articles on Substack, you have the ticker symbol, so you can do the work. Another one is this one, let's see. Investment Ideas by Antonio, that I like a lot, and he writes about stocks that he likes. So he talks about Spotify. Okay, keep reading. I have a complete analysis of the recent quarterly results from Spotify. What are the changes? Completely for free. Another Substack that I like is, where is it? This one. Where was I? Okay, this is one, Fairway Research, with again a lot of good companies. SDI Group, okay, you're curious and you're intrigued by this. There is a complete analysis. Continue reading. There is a complete analysis here. Oh, it's huge, completely for free, explaining all the products, all the services, all the margins, all the historical figures, all the management stuff, all the competitive advantages, all the valuation tools, everything completely for free. And let's look at another one here. Where was I? Fairway Research here. Another one here, Global Quality Investing, again, Midis Team, CSAM Health, Avalara. I don't know these stocks, and that's a good hunting ground because these guys have done the work. Let's look at another one. And where was I? Here, 41. Let's go. 41 investments. And again, current investment ideas. These guys share their investment ideas of the moment. So you can just take advantage of this and take all the ticker symbols, take all the company names, and do the analysis. If you think that it's not enough for you and you want to do deeper research, you can do it with the website, with FinChat and with Stock Unlock. Also, there is another one here. Henry Fund, that's different. That's not a blog. That's not a Substack. That's not a Twitter profile. Oh, by the way, I have not shown Twitter profiles. That may be in another class. I will show you some Twitter profiles that I like a lot. And yeah, Henry Fund is some, I believe, investment fund from a company, Department of Finance, from a college. And again, I believe that some student that write good analysis about stocks. And this is the 2023 research, but in the past there were 2022 research, 2021 research. Maybe if you send a mail, you can see and read the research from past years. And let's see this analyst, Emily, that wrote about waste connections. Okay, you click on it, and you have a complete analysis, a complete equity research paper. Here, the analysis is done. She analyzed everything, all the numbers, all the industry, etc., etc., etc. And you have 10 pages of analysis for this company. The valuation is done, etc. You just have an opinion. Maybe the valuation is wrong. You do it yourself. But these are ideas. That's how you generate ideas. And finally, I think that's the last link I have here. It's a Reddit link. Okay, let's go to Reddit. Accept. This is a Reddit community called Security Analysis, which is the name of a big investment book, very famous investment book. In this Reddit group, people share ideas and comment on recent podcasts. They talk about the big gurus, the big investors. They share ideas. So you can take ideas from there. And what do I have here? You can also get lost in the Guru Focus articles. Let me show you. If I go to Guru Focus, in the website, you have some articles. For example, somebody wrote a quick analysis on Netflix. And let me see articles here. But they can write about any stock they want. So you have here some articles about companies. PayPal, Comcast, Discovery, Nvidia, Meta, etc., etc., etc. So you can get lost with the analysis, and you have 300 pages of people that wrote articles about investments. You can have a lot of ideas just scrolling here, and if you find a compelling title or anything, you can just put the ticker and do your analysis, but you can generate a lot of ideas with these articles. Most of the time, these are short articles, but you just want the name of the company. You just want the ticker symbol. And also what I've written here is that you can get lost on Guru Focus, but also get lost on a website called Seeking Alpha. There are also some articles. You can also use Seeking Alpha as an equity research tool and read the articles. You go to Seeking Alpha, and let's say you want more information about Netflix. And now we are on Seeking Alpha with Netflix. You can create an account for free, and you have some metrics again and again. And you have some, where is it? Related analysis, I think. Oh, no, I think it's here. Analysis. And if you want to read more analysis about Netflix, some individual investors have written some stuff about Netflix. You have 5 pages of articles. Well, you can just click on it, and for sure there will be sometimes mistakes. We are all humans, but if you read everything, I guarantee you that you will have a better understanding of Netflix. So, okay, go through this. You can also have an analysis here with many numbers, many charts. They will talk about competition, they will talk about their products, etc., etc. You can read these articles. As I say, get lost in the website where you just read articles and read other articles and read other articles. And that's where you can find value. So let me go back to page. This is our list that we've seen, the list of blogs that I like a lot. And that's it, I think, for the blogs section, the Substacks section. What is really important is that you take the companies from these websites, the ticker symbol, but you have to go through the numbers. You have to do the work by yourself. Even though you have a complete analysis, which is great, double down the analysis on the numbers. Do it especially with Stock Unlock and with FinChat. That's really important. After that, after you've seen all the blogs, all the Substacks, after you've read all the articles on Seeking Alpha, you can read stock pitches from investment funds. Official public investment funds have some quarterly letters when they talk about the recent buys or the recent sales that they did in their public portfolio. So this is public knowledge, and I have here two websites. Let's go to the first one. In this website, which is called Capital Employed Stock Pitches, you have some stock pitches from real investment funds. So in 2024, you have 21 superb stock pitches in February. You click on this and you have some interviews. Okay. And if you scroll down, you have the stock pitches. You have Marks Equity Research that has written something about CSW Industrials, and then another company that has written something about Burberry, Franco-Nevada, etc., 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 etc. You can continue, and we've seen this for February, but you can do it for other months. But I believe this website does a compilation of real investment funds and, again, more substacks. So, for example, if we look at this analysis of Franco-Nevada, I don't know if this is a real investment fund or not, but this is just a Substack, and you have the analysis here, the complete analysis of Franco-Nevada, which is a Canadian company. You have a lot of numbers, etc., etc., etc. There are a lot of pages of this analysis completely for free. And let's see Muddy Waters on Fairfax Financials Holding Limited. You are here, and I don't know if this is a Substack or a real investment fund. Let's get to this website, Muddy Waters Research. I think that's some real stock research, equity research company, some real official public company. And you will find the information here, I think. I don't know. Where is it? I don't know. I don't know where it is. Download the report. And if you download the report here, I agree. Let's see. Let's see. I will have the report on Fairfax Financial Holdings. 72 slides of why you should invest in this company. Okay, let's go to another one. I don't know. Let's go to Eagle Point Capital that does something about Hilton Grand Vacations. Well, again, you have a complete analysis for free. So after you've read everything, you can do your own analysis on Stock Unlock and FeedChat again. And the second website I have for stock pitches from investment funds are these stock pitches from this website. And I think, okay, this website is a compilation of real hedge fund letters. So no Substack, no individual investors, just pure professional work with real hedge funds. So you have 2023 letters for the Q4, and you have plenty of letters here. And if you want to know something about, oh, I think that's the document we saw before. If we click on this, you have 72 slides. Okay, absolutely great. You have the document Muddy Waters here, short on Fairfax Financial. I think, okay, and this is a short, so they are not bullish, they are bearish on the position. They don't think the stock will go up, they think the stock will go down. But you can go to another letter like this one, and you will have the letter. In this letter, they will talk about an investment. Third Point Capital. In this letter, they will talk about a stock, and you go through every letter for every quarter, and you will spend hours and hours searching for new business opportunities. And again, you ask the same questions. Do you understand the business? If yes, you analyze the numbers. If you like the numbers, you go deeper. If you go deeper, you add to the watch list. You look at competition, competitive advantages, you look at the moat, you do a DCF. And I've shown you a lot of websites that I use to generate ideas. What works a lot, what works really, really well is FinChat Stock Screener. Let's go back to FinChat. And here you see the screener. Some people love screeners, and some people even use Stock Screener as a first source of investment ideas. I just didn't want to put it first because I wanted to show you first the websites that I used, but if you want, you can start with the screener. It will generate a lot of ideas. So we have the screener from FinChat. And I think that FinChat Stock Screener is the best stock screener that you can find online. So how does a stock screener work? You want among all the companies that exist in the world, you want to invest in, say, companies that are in the US. Okay, it will filter out all companies that are not in the US. In which industry? No specific filter for this. In which exchanges? No specific filter for me. I will select key criteria like the diluted earnings per share 10-year CAGR, the shares outgrowth 10 years, and I will say that I added these screener criteria, which means that this website will give me all the stocks that are based in the US with the revenue that has grown over 10 years from 0 to, say, I don't know, infinity and minimum 5%. Okay. Diluted EPS, I want, 5% to infinity. And the share count, I want it to decrease over time. So I want to have, -2. Let's start wide. And run screener. This FinChat screener will give me every stock that fits all these 3 criteria. You have Apple, Visa, MasterCard, and you can sort it out by revenue growth, for example. Among all the companies, the best company that is growing the fastest in terms of revenue is called TAP Global Group. And growing 31%. But if I want more EPS and I want it to be very profitable at 10%, and another criteria that I want is that, let's say, I want the PE ratio, forward PE ratio. I want the PE ratio to be between 0 and 20. Let's say 0 and 15. Run screener. And this beautiful website will give me all the stocks that have a PE ratio between 0 and 15, growing their revenue at 5% or more, growing their earnings at 10% or more, and decreasing their share count by 2% or more. I want more buybacks, -5%. You can be very selective in your criteria. And you can reduce the amount of companies that it generates over time when you increase your filters. So now I only have 1, 2, 3, 4, 5, 6 companies. These could be potential investments that have strong growth and are quite cheap. So you can sort by PE ratio. There is a PE ratio of 1. I think either it's a mistake. I don't think so. I just think it's an accounting one-off effect that makes earnings go up by a lot. It happens. And you have some PE ratio of 5, 6, 7, 8. I know Toll Brothers. I know Group 1 Automotive. I know they are both great businesses. And they have been buying back their shares for Toll Brothers at 5% per year for 10 years. Group 1 Automotive, 5% per year. That's great. So I can just GPI. Let's see if I put GPI here. I have Group 1 Automotive on FinChat. And I have the dashboard for Group 1 Automotive on FinChat. So I have all the numbers I need here. And also I have all the numbers in details here for 10 years in a row. I can see the balance sheet, income statement, and all the ratios over the years. I think it's great and it's very clear. And I can do some modeling here, which means that I can have some forecasts for the revenue, for the margin, etc., to have some estimation of the future for the company. What is great is that I can go to charting. I can remove what I had written here and do GPI. Group 1 Automotive, and I don't know, let's look at the PE ratio over time, the return on invested capital. Let's look at the return on invested capital. I will see that the return on invested capital has grown a lot, from 4% in 2008 to 5, 6, 9, and then in COVID times 15%, which is huge. So something big is happening here. And if we want to look at the ratio, you can have some, I don't know. No, I want to no, you know what? I want some revenue, earnings, you have everything in detail. Actually, that's great. And at the same time, you can have another metric like the PE ratio. So I will have my PE ratio in orange, which went from 25 to 4 to now 5 or 6. But let's come back to our screener. That's the best screener you can have. And you can have every filter that you want. Look at this. Look at this. If you're lazy and if you don't want to read every articles of every website I've shown you before, just play with the FinChat stock screener. It's great and you can find companies in the US, but look at this. You can also look at companies, for example, in Japan. If you look for some companies in Japan, for these same key financial metrics, what do we have? No results. Okay, let's remove this one, the share buybacks, and we will find some results. It's just that in the US, you have way more companies with buybacks. In Japan, that's a different culture, so we have less buybacks. And here, if you want some companies in Japan, you can find great investment opportunities. If you think the S&P 500 and the American indices are too expensive, just go and fish in another lake, in the Japanese lake. You can have some great EPS growth over 10 years, great revenue growth over 10 years, and you can have some beautiful investment opportunities that you can find thanks to FinChat Stock Screener. It's the best one. Say that I want to focus on free cash flow. Free cash flow from operation, where is it? Free cash flow per share. Free cash flow, let's see, free cash flow from operation. I want to focus on this regardless of the PE ratio. I want a free cash flow from operation growing 20% per year. That's it. From any country in the world. Let's see what I have here. We have some great results. And if we sort it out by growth in cash flow from operation, you have a lot of good stuff. You have a lot of good stuff. And what do you have? Country? Oh, from a lot of different countries. Japan, US, Canada, I don't know, KR, what's that? Korea, US, TW, US, Canada. You have a lot of companies from the entire world. And as a French guy, let's look at France. Do we have some great compounders, some great companies growing their cash flow from operation 20% per year in France? And yes, we have some great businesses. And for example, if you want to invest only in French businesses, you can look at this. You can take a look at this and play with the numbers, with the charting that we've seen. You combine this with the stock unlock tools and with FinChat tools and stock unlock tools. You have all the tools you need to make a good portfolio, a good watch list. And this is infinite. If you need some good investment ideas and you put a PE ratio which is lower than 10, you will find some investment opportunities. If you want some companies that are growing their revenue really fast, you will find them. If you want earnings growing fast, you will find them. If you want some good operating margins increasing over time, you will find them. If you want some gross margins, some huge pricing power, 90% margins, you will find them. That's great. Let's have some gross margins at an insane level, gross profit margins over 90%. That can happen. And in France, we have one result. Okay, very good. And let's see worldwide. And we will have some great results. These are wonderful companies that have grown very fast with extremely good gross margins. And let's look at this TPL. I personally own this stock. I can look at TPL. Look at this. Look at this. This is maybe the best company I found in the stock market, where you have a fabulous business model, really simple, and growing 25% per year for decades. And if we go to charting, and instead of having group one automotive here, I have TPL. And let's go to free cash flow. Let's look at the free cash flow per share. Let's look at free cash flow per share over time. You see this wonderful trend from 2004 and to 2023. Now, it's wonderful. It's a 50x in 20 years. And at the same time, I want the return on invested capital. I see that this is amazing. This is amazing. The business, because of accounting measures, have had a return on invested capital of 1000%. But yeah, if you adjust for some accounting stuff, you have return on invested capital of 60%, 100%, 50%. Even if you say it's 30 or if it's 60, it's huge. It's huge. Regardless of the metric you use, that's some very good financials. And on FinChat, you can have segment and KPIs. This is one of the best tools you can find online. And this is, I think, only on FinChat. And I use them a lot. It's when you want to dig deeper to the numbers of a specific company, and you will see the KPIs, the key performance indicators of a business. So, for example, for TPL, they own lands in Texas. That's part of their business model. So you can see the number of acres owned, the surface owned. And since they began reporting it in 2017, they had 900,000 acres, and it's slowly decreasing. So they are selling some of the land they have. But the KPI can also work for bigger companies. We talked about Apple before. We can go to KPIs, Apple, iPhone revenue. Okay, very simple. And you have everything. It's as simple as this. You have all the iPhone sales in a couple of seconds. Instead of looking for hours in annual reports to look for specific number, just type whatever you want here on FinChat, and it's beautiful. And I think you can even have a CAGR here. You have a CAGR of 9%. So revenue of the iPhones have been growing 9% per year for a decade. Then you have other KPIs. iPad revenue, okay, boom, here. Other KPIs, Mac revenue, Japan revenue, okay, great. Let's remove this. And if you do that, you can compare the revenue of Japan to iPad revenue, see if there is some correlation. These are Japan revenues over time. And let's see total revenue. I want total revenue and Japan revenue. And they started reporting this Japanese revenue in 2013. And if you click here, I believe stacked bar chart, you can have the amount of the Japanese revenue compared to the entire revenue from Apple. So that's great. You know what? Let's do it for another company. Let's do it for Meta platforms. Meta platforms, so Facebook, Instagram, WhatsApp, you have segment, KPI, Meta platforms, daily active users, you have a lot of KPIs here. Asia Pacific daily active users. Let's see, over time, you have this in a couple of seconds. That's it. Very, very simple, very effective. You can see another one. Rest of the world daily active users, family apps revenue. Let's see. And let's take a look at Europe revenue. Let's remove this. And you have this. Very easy. Very, very easy. Very, very convenient. And you can combine the screener, the charting, and the watch list to have some very good tools. Let's edit the watch list and say that we wanted to add some meta. Okay. Let's add meta to the watch list, but let's add also, I don't know, Disney, that we liked a lot for some reason. Let's say that we like a lot TPL. And that means that within our watch list that we have here, we have these metrics: revenue 10-year CAGR, diluted EPS growth, and we can compare the stocks on the watch list their return on invested capital. TPL, Walt Disney, Meta, etc. For example, you have here TPL at 100% return on invested capital, then Meta Platforms at 26, etc., etc. And if we want some good valuation, you combine this website with Stock Unlock. You go to Meta, you go here, you go to Stock Unlock. By the way, we will see the inside score, very good, 4.34. Let's go to DCF. Let's go to this. And let's estimate that, just for the example, for 5 years, it will grow at 15%, and there will be no buybacks, and the PE ratio will be 20 for any reason. You can say, oh, the stock is overvalued. But if you think the business will have a PE ratio of 25, well, it's undervalued and there is some good upside to the stock. So you can say this is a good buying territory and you can buy it for your portfolio. And just for this example, we say that this is undervalued after you've done all the calculations, and the fair value is this. So 536. Okay, same exercise for TPL, and I think you can even switch companies in this tab really fast. So you can just go from DCFs to DCFs. And again, you think TPL that has grown 15% per year for the past 5 years will continue to grow 15% with no buybacks and a PE ratio of 30, because I think the quality is exceptional, the moat is very wide, so it deserves a wide premium to the overall market. Not a PE ratio of 15, not a PE ratio of 20, it will be between 25 and 30. So if I have a PE ratio of 25, I have approximately a fair value. A fair value could be good enough. You can buy a stock at a fair value. And if you think it has an extraordinary value, an extraordinary moat, you think it will grow at 15% per year, that's huge, and it deserves a PE ratio of 30. Well, in this case, the business is undervalued, and you can expect a CAGR of 13%, 14%. And if you are not comfortable with the business, with the moat, you have not understood it really well, you think it deserves a P of 20, you can say, okay, it's overvalued for the moment. I'm waiting 20% to buy. So you have a fair value of 1,200, something like this. So let's go here and put a fair value of 1,200 here. And let's do the same thing for Disney. And I think the financials of Disney are quite terrible, especially for free cash flow. So let's put earnings. Ooh, terrible earnings. Operating income, terrible. Well, you can look at key metrics like operating cash flow that can maybe work better. And I think it will have no growth in operating cash flow over the next 5 years with no buybacks and a price earnings ratio of 25, say 25 off, because it's Disney and it has some brand recognition, but in reality, I would not pay more than 15 personally for Disney. So the fair value is about minus 40%. So 66, I add this price to the watch list. And that's it. That's it. That's how it's done. And you can build over time a watch list with your price targets here, and you can compare key metrics within your watch list, and it's great. Life is good. You can spend hours and hours building your favorite watch list of your favorite companies. And if we go back to our method, this is the FinChat stock screener, which is really, really important. And you can have a lot of great ideas like this. And what is even better with FinChat is that you have an AI assistant. So let's go back to FinChat and use it. It's even better if you combine it with the FinChat stock screener. You can go to FinChat and ask FinChat, what is in Warren Buffett's portfolio? Let's see what it generates. Okay, it's loading. And you have everything. It does the analysis for you with the allocation, Apple, Bank of America, etc. But you can also ask, instead of asking general questions, you can ask some good questions like, give me 5 companies with ROIC above 50% and an amazing earnings growth in the last 5 years. So you want companies with higher investment potential that have shown that they are very profitable. Okay, it's loading. Oh, and by the way, for the Warren Buffett portfolio, you have all the allocation by companies and by sector, by industry, which is great. Okay, so I asked FinChat to give me 5 companies with high return on invested capital and amazing earnings growth in the last 5 years, and he gave me 5 companies: Apple, Nvidia, Novo Nordisk, Mastercard, and Tata Consultancy Services Limited. Oh, he gave me even more. It over-delivered: ADP, O'Reilly Automotive, AutoZone, IDEX, and PT Bayan Resources, with a small description of this. So if I wonder what is AutoZone, I have the description here. Give me more information about AutoZone. About AutoZone. AZO, sorry. Let's see. Oh, and after he gave me the 10 companies, I have a table with the key metrics. Diluted EPS growth. I can compare them. It's great. It's really great. It's great. And now I have more information about AZO, AutoZone, the foundation, what it does, the margins, the return on capital, the PE ratio, the analyst coverage, the key metrics that I have to look at here, the estimates for the future. It's loading. The growth, the CAGR of the past, revenue, diluted EPS, the forward EV sales, the revenue per share, etc. I can see here the return on total capital, return on capital employed. That's great. And I have some charts here that I can play with, revenue or EBIT, free cash flow, etc. These are the estimates for future years of operations and the price targets from analysts on Wall Street. So I have the rating from key analysts on Wall Street with a lot of buy. 6 analysts in Wall Street think it will be outperforming or hold, etc., etc., etc. I have the stock price, and I have some peer comparison. So FinChat gives me all the competitors of AutoZone, Home Depot, Lowe's, O'Reilly, Ross Stores, Tractor Supply, Best Buy. Some companies may be real competitors, but some companies operate in the same industry, so you can see them as competition. You have the companies here, all the competition, the different market caps, and you have some KPIs from AutoZone, like the total store location over time. I think it's great. I think it's great. After this, I can ask even more questions. What is the current financial performance of AutoZone? How does AutoZone compare to its competitors in the automotive retail industry? Okay, let's ask this. That's the equivalent of ChatGPT, but for finance. ChatGPT for investing. That's the best tool you will find for artificial intelligence tools. Okay, everything. You have everything in a few seconds. That's absolutely wonderful. And you can go for hours and hours like this. So if you have a FinChat account, you can play with the AI assistant, you can play with the screener to build a strong watch list. And if you combine with the valuation tools from Stock Unlock, the insight score from Stock Unlock, I think that's the best tools you can have online. Currently, that's the best tools. So I highly recommend that you use these websites for your stock research. And let's see our method. The final step is that if you haven't found a good opportunity among all these different sources of ideas, if you still haven't found a good opportunity, analyze every competitor of the companies you saw. And we've seen with the AI assistant that FinChat could generate competitors from any company. They can say, okay, here are the 10 other similar companies in the industry. But you can also do it with Stock Unlock. For example, if we go back to Stock Unlock and let's say we have Netflix here, Stock Unlock indicates the competition. I believe this is here. Similar stocks. Look at everything. And you do the same process for every company. And you have a small summary of the business, IPO date, etc. And if you analyze, for example, Roku, you do the analysis, you don't like it, not for you, not good financials. You do again similar stocks and get lost into the competition space. And you will have WWE, some catch, okay. You will have some financials, you will get lost, etc., etc. And that's it again and again and again. And you can compare all these competitors with the freeform tool and compare the price earnings ratio for each of them. I don't want this. I want the revenue for each company in the industry, in the entertainment industry. And I have all the revenue from that could be a mess if you have too many competition, too many competitors, but you understand my point. It's just that it's endless, and with Stock Unlock and FinChat, you can generate ideas forever. And with that, that's the end of my big process, my big method of finding great stocks. I'm sure if you follow these steps with these websites, you will build a strong watch list. And after you've done all the work, you will be able to create a strong stock portfolio. And this is the most exciting part of investing, when you just keep hunting and hunting for good opportunities. And you have seen that I used a lot FinChat and Stock Unlock. So I highly recommend that you sign up with the links in description. As a reminder, you can sign up to FinChat with my link in the description and you will get a 25% discount. And you can sign up to Stock Unlock with my link in the description. So you can get 1 month free. If you want to take investing seriously, you need the best tools. And I believe that these two websites are the best tools. You've seen the results. I don't have to tell you. You've seen the results and you've seen all the stock screener, the DCF, how easy it is. You've seen the AI assistant. You can ask any question you want. You will have all the numbers that you need, all the KPIs that you need. You will have a score to have, quick view in a snapshot if a company is good or not. So now that you know how to pick great stocks, this is the time for you to find your investment style. And in the next video, I will show you the different investment styles that exist so you can choose the one you prefer. Now that you know how to pick great stocks, it's time for you to have a specific plan. In this video, I will show you the different strategies in the stock market so you can choose the investment style that you prefer. Here is what we're going to cover. We will first talk about diversification and see the positives and negatives. I will show you what is diversification, how it works, and how a good diversification can reduce your overall risk of your portfolio. And then we will talk about the different styles of investing. For example, dividends and income investing. Some investors like to play it safe and invest in strong, profitable companies that pay dividends every 3 months. So they have a passive income with these dividends, and this is the safest investment style, I would say. But you can also invest in growth stocks. So that's where you will have the best reward, but also the biggest risks. So I will show you how it works, and if it fits your temperament, you can try some growth investing. And growth investing is often compared to value investing. So I will show you what is value investing, how it works, how is it different from growth investing, because there are a lot of differences. Not everyone can do value investing. And finally, we will discuss investing in quality stocks, how this strategy can outperform, what's the risks of investing only in quality stocks, because You can invest in very strong, very good company with a very special brand. Every time you want to invest in these stocks, you have to pay a premium. They are never cheap. So it sounds very appealing to invest only in the best quality of businesses in the world, but the price that you have to pay to invest in these stocks can be very high. So it's all temperament. If you're willing to pay up for these great quality businesses, that's a style. And for this, you need a lot of patience. As always, I encourage you to subscribe to my YouTube channel, which is called Christophe Noor, and follow my accounts on Instagram and TikTok for more exclusive content. And I also encourage you to share the course. Let's start a revolution and change people's life together. Investing in the stock market has a lot of benefit for your wealth over the long term. And if you have some friends or family members that want to grow their wealth over time, please share the course. And the pro tip is to watch the video at 2x speed. And let's start with portfolio diversification. So when you build a portfolio, you can have 3 stocks, 5 stocks, 10 stocks, 50 stocks, or 100 stocks, or even more. That's your style. If you like investing in only 3 companies because you're confident in them, that's your decision. If you only found 3 investment opportunities, well, that's the best portfolio you can have. Portfolio diversification is when you have a lot of stocks in your portfolio in many different industries, many countries, and many different market caps. So you can have small companies, but also large companies in different countries. So that can be the US or also Canada or European countries or some countries in Asia, whatever investment opportunities you find with many different industries. So if an industry goes into a slowdown, for example, for home building, well, you have home building companies in your portfolio, but you also have software companies in your portfolio, and you also have food companies in your portfolio. That means that when there is a risk somewhere that sector is slowing down and these stocks are crashing, well, the other parts of your portfolio are holding well. And if you have a diversified portfolio, your portfolio will not crash because a specific industry is crashing. And diversification reduces the overall risk of your portfolio. If you have a portfolio of 20 stocks and one of these stocks goes to zero, well, you have 19 other stocks. So if you have a equal weight portfolio and for 20 stocks, it's 5% per position, and one of your position goes to zero, when you can only lose 5%. That's the point of diversification. You still have 95% of your portfolio that is holding well. So portfolio diversification is when you spread your investments around to limit your exposure to a particular stock, industry, or country. If there is a recession in the UK, for example, and the UK is going down and every stocks in the UK are going down, you don't want your whole portfolio to be UK businesses because that's where you will suffer the most out of this situation. You want to be in the UK, but also in France, for example, or in Spain, in the US, in Mexico, in Japan, etc., etc. That's the role of diversification when your risk is spread around different countries and different industries. An important thing is to choose non-correlated assets for your diversification because some industries can be correlated and hit by the same risk. For example, you can buy a company building a home, so in the home building industry, but you want to diversify, so you want a company that sells swimming pool, okay, and you want a company that sells beds. Okay, so you're comfortable in these 3 industries that you know really well, and say there is a rise in interest rates and home affordability changes, and it's much harder to get a new home for first-time buyers. There will be fewer buyers of homes. So there will be fewer swimming pools that are built, and the home improvement industry will also be impacted by this change. So 3 industries with different markets can be impacted by the same risk: homes, swimming pools, beds. You wanted to diversify, but the same risk impacted your portfolio. So that's the point of choosing non-correlated assets for your portfolio. And you want very different companies, like a company selling homes in Europe and then a gaming company in Mexico, which has nothing to do with each other and a specific risk will not impact the other company. Also, portfolio diversification allows you to capitalize on market opportunities. For example, you have a portfolio and you see in another industry that you don't own, another industry is crashing, and some stocks have fallen 50%, 60%, 70%. You see some deals over there. So you can invest in this industry during the crash when everybody panicked. Well, you can arrive and buy some of the stocks in this crashing industry. So you can take advantage of new market opportunities and also diversify your portfolio because you didn't own these stocks in this industry before. So you can kill two birds with one stone. And diversification also reduces the amount of stress you have and your emotional bias. If you only have two stocks and one loses 50% of its value, it will have a big impact on your portfolio and you will be stressed. And that's where you make stupid mistakes. That's when you sell at the wrong time, that's when you panic, and that's very bad for your investment strategy. You want to build a strong portfolio with strong companies, but you also want to sleep well at night. If having just a few stocks, so a very concentrated portfolio, if it's going to stress you out and you're not going to sleep well at night, that's not the point of investing for the long term. If you have a diversified portfolio and you are not stressed, you can take advantage of these opportunities. So that's a very good point for diversification. Now, the first 4 points have been positives about diversification, but you also have drawbacks. You also have some negatives. For example, diversification decreases your potential returns. If a stock is a 10x, if a stock does a 10x, so wonderful investment, great results, but it's only 3% of your portfolio, it won't make you rich. And that's very true. If you have a portfolio of 30 stocks with equal allocation of about 3% of your portfolio for each position, if a stock goes down to zero, it's not a big deal. You will only lose 3% of your portfolio value. But if a stock does a 5x, a 10x, it won't make much difference because it's only 3% of your portfolio. Compare on this situation to the opposite extreme of only having one stock. If it goes up 10x, your whole portfolio will go up 10x, and that will make you rich. So the more you diversify, the less impactful your investment results will be. And if you have great investment results for one of your stock, it won't make a difference because it's only 2% of your portfolio, 3% of your portfolio. The other big negative of diversification is what we call diversification. When you have too much diversification, the risk-reward trade-off is worsened. Say that you have, for example, 300 stocks, so a portfolio allocation of less than 1% per stock that you own. Having hundreds of stock is difficult because you have to monitor 300 stocks and it will bring you average returns. If you have 300 stocks, it's very difficult to beat the market because you are the market when you own 300 stocks. It's as if you bought the S&P 500 and expected to beat the S&P 500. That's impossible. You have so many stocks in your portfolio that you are the market. So if the market goes down overall, you go down. If it goes up in overall, you go up. But you won't be able to outperform global indices. And the thing that you have to add to these average returns is that every time you buy and sell a position, you pay transaction costs. If you only have 3 stocks in your portfolio, you buy your first stock, second stock, third stock. And at the end, you sell first stock, second stock, third stock. You have 6 transaction costs. And every transaction cost that you have when you buy or sell a stock, this will decrease your performance. If, for example, you have some transaction cost of 0.1% every time you buy or sell, well, if you have 3 stocks that's a thing. But if you have 300 stocks, you have to take into account 300 transaction costs every time you buy and 300 transaction costs every time you sell. So a lot of hidden costs that will drag your performance over time. And that's not what you want in the stock market. You want to be diversified, okay, but too much diversification will lead to very bad results. A lot of investors don't like diversification for these reasons, for the diversification aspect of diversification. Charlie Munger, who worked with Warren Buffett and was one of the best investors, said the idea of excess diversification is madness. Wide diversification, which necessarily includes investment in mediocre businesses, only guarantees ordinary results. If you have a portfolio of 300 stocks, don't expect extreme performance, extremely good performance. You will have ordinary results, average results. And the extreme other example on the opposite is having two stocks. You won't have ordinary results with only two stocks. You will have either very good or very bad performance, but you will not have ordinary results. The more you diversify, the more ordinary your results. So the other side of the coin is portfolio concentration instead of diversification. And when you look at the best investors in the world, they made their fortune with a concentrated portfolio, not a diversified portfolio. If you want to make strong returns, focus on the best companies with a concentrated portfolio. If you own the five best companies of the entire universe, you will make a lot of money and you will have a concentrated portfolio with very, very strong companies. If you don't find opportunities in the market, don't fill your portfolio with bad companies. For example, if you have added to your watch list a lot of stocks, but they all appear overvalued, so they are all expensive, don't buy them just because you want your portfolio to be diversified. For example, if you have a portfolio of 5 stocks and you want to reach 20 stocks, don't buy the remaining 15 stocks just because you want to fill your portfolio. If you don't find opportunities, don't fill your portfolio with bad companies, with bad investments, with overvalued companies, with expensive stocks that will have mediocre results. The big takeaway is few bets, big bets, infrequent bets. You don't want to buy every week, every day. Just focus on the best opportunities you find and build a strong portfolio that could be concentrated first. And over time, when some stocks will collapse, you will find some opportunities elsewhere and you will fill your portfolio with great stocks. And you can start like this. At the beginning, have a concentrated portfolio, and over time, the more comfortable you get with some industries, you can have a diversified portfolio. So you can start with 5 stocks, and after a couple of years, you have 20 stocks, 25 stocks that you follow very closely and you know very well. The goal is to have few bets, big bets, infrequent bets with the best opportunities you can find. And now that we've seen portfolio diversification, let's talk about choosing your investing style, the different strategies that you have in the stock market to generate wealth. You can choose between different styles: the dividend investing, the growth investing, the value investing, and the quality investing. You have other styles, but that's the biggest ones, and that's the most important ones. Let's start with dividend and income investing. That's where you have a whole portfolio of companies that pay dividends. That means that you can have a passive income with your dividends that you get every year. And in this table, you see that depending on the amount you invest and depending on your dividend yield that you get with your portfolio, you can estimate to have some good yearly income. Some companies don't pay dividend at all. Some companies pay a small dividend, 1% dividend. Other pay some bigger dividends like 3% dividend yield, 4%, 5%. And some companies pay very big dividends like a 7% yield, 8% yield. And you can build a portfolio of companies with 3%, but also companies with 5%, 8%. You can have your diversification in your portfolio around different companies, and the average dividend yield of all your companies will be the yield you will get out of your portfolio. And for example, if you have an average dividend yield in your portfolio of 5% and you invested $1 million in the stock market, well, you will have a gross pre-tax yearly income of $50,000. And after the taxes you will have to pay with this, that's money in your pocket. So that's some great passive income that you can get with dividend investing. With dividend investing, you can benefit through regular income, usually paid in cash as dividends to shareholders from a company's net profits. That's the point of giving dividends, and capital appreciation. At the same time that you are paid some dividends at the end of the year, at the end of 3 months, 6 months, the stock can go up. The increase in the price of a stock between the time it was purchased and sold in the open market, that's your capital appreciation. At the same time, for example, if you have a dividend yield of 5%, so you get 5% every year, and if at the same time the stocks in your portfolio that you own grow by 5%, you will have 5% plus 5% return this year. You will have a 10% return. It also works if stock drops in value. So if every stock of your portfolio loses 5% of its value, you will have your regular income plus 5%, but also some capital depreciation minus 5%. So you're flat for the year. But the point of dividend investing is having passive income. And the most important part of dividend investing is the regular income, not the capital appreciation. You want capital conservation. That's a good point of dividend investing. Only investing in stocks that are stable over time or slightly increasing over time. But the main focus of dividend investors is the dividend yield, is the regular income you will get, the passive income. Capital appreciation, I would say, is just a bonus that you can get with the stock prices of your stock. So the benefits of dividend stocks is that for the investor, you have a predictable income. If you have 5%, well, you will have 5% at the end of the year. You have reduced risk because you will have your 5% every year. It doesn't vary. Most of the time, it's regular 5%. And you will have profit without selling. You can earn your 5% dividend yield at the end of the year without touching your positions, without touching your portfolio. You will not sell your portfolio to receive the dividend. It's just some money that goes into your account. And there are some benefits for the companies that pay dividend. Investor loyalty increase because if all of your shareholders they are dividend investors, well, they will never sell out of your stock. They will just receive their 5% per year and just not touch and not panic sell and not leave your ownership for years and years. So you have some investor loyalty. You have some stock price boost because if you pay a good dividend, it shows that you have some strength, you have some good balance sheet, and the market sentiment towards these stocks is good, which means that more people can buy your stock if they want the dividend, which will boost your stock price. In theory, that's how it works. And that's a good use of extra cash. If at the end of the year a company has some cash on its balance sheet and doesn't know what to do with it, they don't have reinvestment opportunities, well, giving dividends to investors is a good way of spending your cash. You make your dividend investors happy, and most companies want their shareholders to be happy, so everybody wins here. I have some examples here that show investments to earn $1,000 per year in dividends. This will vary over time because of valuation, because of increases in dividends over time, but you get a rough idea. For example, some companies like Coca-Cola have a 3% yield, and some company at the bottom of this chart like AT&T have 7% yield. So you can only invest $13,000 into AT&T, and that will generate $1,000 per year. And you would have to invest $30,000 into Coca-Cola with a 3% yield to reach $1,000 per year. So Some dividend investors only invest in companies with a 5% dividend yield, 6%, 7%, 8% dividend yield because they think that the higher the number, the higher the passive income. And again, in theory, that's very true. So you can only focus on companies that pay a 7% dividend yield and put all your money in that, and you will earn a 7% yield every year on your investment. That's a strategy, and that could work really well. The dividend terms to know for this strategy are the dividend yield. So that's only the amount of dividend shown as a percentage of the share price. So as we've seen before, it can be 1%, 2%, 5, 7%. There is also a dividend growth rate, so how much the dividend has grown over time. For example, if a company is making more money every year, they can reward shareholders with a bigger dividend every year. So your dividend yield can increase over time, your dividend payment can increase over time, and you have some big, profitable, strong companies that have increased the dividend payment for 20 years in a row. These companies are great investments for dividend investors. You also have the dividend payout ratio, which is the amount of a company's earnings paid to shareholders as a dividend. It's the share of earnings or cash flow that is used to pay dividends. You have the dividend reinvestment plan. So that's plans designed to roll over investors' cash dividends into their share purchases automatically. You can do some automation to the process of dividend investing, and that's how it works. Also, you can have some preferred dividends. So dividend paid to preferred stocks shareholders, typically higher than common stocks dividends. When you buy a stock, you can buy the common share or preferred share. You can have different voting rights depending of this type of share, this type of share, and you can have some different dividend payments if you buy this share or that share. For example, sometimes you have two classes of shares, the common shares and the preferred shares. For the common shares, you have a regular dividend and a voting right. And for the preferred class, the preferred share, you have no voting rights at all, but you have a bigger dividend. So some people just want the big dividends and they go to the class of preferred shares to have a bigger dividend and they don't care at all about voting rights. That's a strategy. So that's preferred shares for preferred dividends. And finally, you have qualified dividends. Dividends taxed as capital gains instead of income, lowering the tax burden. You can do some change to improve your tax rate in order to have more passive income at the end of the year. And as I said previously, some companies pay dividend every year, and some companies pay dividends every 3 months, so quarterly. And if you allocate your portfolio in this way, you can have a dividend payment every month. For example, in January, you will have the dividend payment for Procter & Gamble. In February, you will have Southern Company. In March, you will have the dividend payment from McDonald's, April, PepsiCo, etc., etc. There are a few potential cons of investing in dividend stocks, and they are listed here. The dividend payouts reduce the amount of money that is available to be reinvested in the stock and may lead to slower capital gains growth. As we've seen before, companies at the end of the year that don't see reinvestment opportunities are much more likely to pay dividends. So if a company pays big dividends, it's because they don't see investment opportunities for growth. So don't expect big growth in stock prices when a company pays a lot of dividends. If they pay a dividend, it's because they will not grow a lot. Imagine if you bought a company with a lot of growth and a longer runway. You don't want this company to pay dividends. You want to invest in this company because this company can grow 20% per year if they reinvest all their earnings into the business. So you have a high rate of return and high reinvestment opportunities that will grow 20% per year for the next 10 years. You don't want them to pay dividends. Well, for dividends, that's the opposite. That's businesses that don't see many reinvestment opportunities, so they pay big dividends. And the bigger the dividend, the more obvious that these companies don't see reinvestment opportunities. You will not see a huge stock price appreciation over time. Also, dividend payments are often too small to live comfortably on. You can have passive income, but you can have maybe $1,000, $2,000. If you have, let's say, a $1 million portfolio and you have a 5% yield, you can have 50K per year. You have to pay tax on this. So let's say you still have 40K per year. You can live off 40K, but not as comfortably as you wished before. So you need a couple of millions in the stock market so you can have a big portfolio so that 5% will make a difference and 5% will allow you to live very comfortably. So I understand when millionaires only focus on dividend stocks, because if you have a $10 million portfolio, you don't have 50K dividend payments per year. You have 500K dividends payment per year. So even though you pay your taxes, you still have hundreds of thousands of dollars of passive income. So don't expect, if you start investing and you don't have a lot of money, you don't have millions, don't expect to live comfortably off your dividend, off your passive income every month. Income could be reduced in a recession. That's very true. Some companies, some dividend companies, say that they are very stable and they will pay a dividend for years and years. But we've seen time and time again when there is some panic in the stock market, some panic in the economy, like in 2008, like in the pandemic in 2020, where big dividend payers, companies say, for this year, we will stop dividends. We will not use our cash to pay shareholders. We'll just keep the cash in case something bad happens. So, as a shareholder, you expected a dividend, a 5% yield, and you get nothing at the end of the year. So, every company will say that their dividends are stable, but they can cut their dividends really fast. Okay, that's very rare, but that can happen in the stock market. And you can cut your dividend, but you can also reduce your dividend. And that's a shame for dividend companies, because if they reduce their dividend payment by 50% because they are in a bad financial shape, all dividend investors will pay a huge price for this. The stock price will decrease. That means that dividend investors will get less dividend and the stock price will decrease. Dividend payments can be reduced or eliminated if the company experiences financial difficulty. That's exactly what I've talked about. Dividends can be cut or eliminated altogether at any time. That's very rare, but most of the time it's during big crises like 2008 or the pandemic. But the issue can be specific to a company. If, for example, AT&T has some financial distress and they are in a very bad shape and they don't have any cash and they don't generate profits anymore, well, they will cut the dividend and you expected 7% at the end of the year, you will get nothing and the stock will collapse. So you will suffer twice when there is a specific problem with a specific company. And finally, companies may not use only profits to pay dividends, reducing your stock value. If companies want to have a 5% yield and they don't generate enough cash at the end of the year, they can take some debt to pay your dividends. So that lowers the value of the company, that lowers the value of the stock. And if a company takes some debt to pay dividends, most of the time, this is not a good sign. The other negatives are, first, tax inefficiency. For example, for companies that pay dividends, in their income statement, they have their revenue, their cost, operating income, and they have to pay taxes to have their net income. At the end of the year, they have the cash and they want to pay some dividends. They pay the dividends, and as a shareholder, you receive the dividend and you pay a tax on this dividend. So you are taxed twice. Specifically, when we compare dividend stocks versus growth stocks, this is particularly true because growth stocks usually don't pay dividends, and this phenomenon is called double taxation. The second negative that we can also see is the sector concentration. Dividend stocks are clustered in certain industries, and stock market sectors. Thus, dividend investors must pay careful consideration to dividend stock portfolio construction. Most of the companies that pay dividends are in a slow market. They are major, big, profitable businesses that don't see growth opportunities, and these situations happen in specific industries, specific sectors, like communications, for example, with AT&T or Charter. You have the telecoms that have big dividends. So if you want to build a portfolio with the biggest dividends, you will maybe have a lot of stocks in telecom stocks. And if the telecom industry collapses, your portfolio will collapse with that. And that's it for the dividend investing. Let's now talk about investing in growth stocks. Well, a growth stocks is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. You want big growth. You don't want dividends, slow moving. You just want the big growth with the hottest industry, the companies that grow their earnings, their revenue. That's part of growth investing. These stocks generally do not pay dividends. This is because the issuers of growth stocks are usually companies that want to reinvest any earnings they have in order to accelerate growth in the short term. So these big companies reinvest all their profits for more growth. Don't expect dividends from these growth stocks. Growth stocks often look expensive, trading at a high PE price earnings ratio, but such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share price up. So if a company appears to be overvalued with a high PE ratio, say of 30, imagine you have a stock price which is stable and earnings are growing, the value of the PE ratio will decrease, and the high PE ratio will be a reasonable PE ratio if you take into account growth. When investors invest in growth stocks, they anticipate that they will earn money through capital gains when they eventually sell their shares in the future. There is no dividend payment that you expect at the end of the year. You just buy a growth stocks, think that it will grow a lot, and after 10 years you sell it. So you will have some tax on capital gains once you sell the stock. So this strategy is a buy and hold strategy. You do the work before, and once you have analyzed the metrics and the qualitative side of the company, you buy and you sit on your hands for many years. So that's the point of growth investing. You have to be patient, but you will be handsomely rewarded if you're right. Since investors are paying a high price for growth stocks based on expectation, if those expectations aren't realized, growth stocks can see dramatic declines. Take an example, Netflix growing really fast, and when the company disappoints, that numbers are not met, well, the stock can collapse 50%, 70%. It happened in the past several times, in fact, and every time a growth stock disappoints on revenue, earnings, earnings growth, number of customers, when expectations are not met, the stock collapses. But again, this collapse of the share price can create opportunity. If you had a growth stock on your watch list and you waited some months watching it from a distance, you monitor it from distance and you wait for the stock price to drop because for one time they didn't meet expectation, that could be a good opportunity to buy the stock at this moment. Here are some examples of growth stocks. Let's start with Amazon with a 20-year revenue CAGR, compounded annual growth rate of 26%, with 20-year earnings CAGR of 31%, with a 20-year average PE ratio of approximately 170. PE ratio definitely expensive, but a business that is growing fast. Also Netflix with a 20-year revenue CAGR of 27%, earnings at 46%, so huge growth in earnings, and again, a PE ratio quite expensive by a lot, 115 average PE ratio over 20 years. Another example is CoStar with 18% revenue growth over 20 years, 52% growth of earnings over 20 years, and a PE ratio over 200. So expensive by a lot, overvalued by a lot, but definitely growing fast. And finally, Salesforce with the 35% 20-year revenue CAGR, almost 40% revenue CAGR over 20 years, and an average P/E ratio of 163. So these companies are definitely growth stocks that grow a lot, with some revenue and earnings growing double digits, 20%, 30%, 40%, and they deserve a premium that is worth a PE ratio of 100 to 100, so definitely expensive, but definitely growing fast. And the high PE ratio is also the reason why, when there is some disappointment, the stock collapses. Valuation is like a rubber band, and the higher valuation, the bigger the shock if something bad happens. So if you have a PE ratio of 200 and there is a disappointment in numbers, well, you have room to fall when you are at a P ratio of 200. You have room to fall and the stock can collapse 80%. So, yeah, if you invest in growth stocks, you bet on the future and you think that the growth will continue in the future. And these are examples of company that have generated a very good performance in the stock market because they continue to grow years after years. How to find the best growth stocks? Well, you have to identify companies that drive long-term trends. So, for example, e-commerce, digital advertising, digital payments, cloud computing. That's some good ideas, and you definitely don't want to invest in a company in a bad, slowly dying industry. Like, for example, the newspaper industry, which is slowly dying. You won't find any growth opportunity in an industry that is slowly dying with bad margins, with bad economic advantages. You will find growth stocks in trends, in long-term trends, digital trends for the future. That's how you can ride the bigger wave for years and years and years. If you find the good sector, the good industry, and inside the good industry you find the good stock, well, you have better odds of having a good performance. You also want to identify companies that possess competitive advantages like network effects, scale advantages, high switching costs. Again, in the industry, this is very competitive, and if you have found a company in a good industry with a good moat, with a good return on invested capital, you increase your chance of winning. You increase your chance of finding gold. So you want to invest in the best companies that are growing fast in a good trend, in a good industry. And finally, these companies must have large addressable markets. You want the long runway for your stock. If you have some stocks that can reinvest their profits and grow 20%, but they can only do this for 3 years before the market gets saturated, well, you don't have the long runway. Think of Amazon at the beginning that sold books and some hardware, and with the long runway, now they sell everything, and in 2 days you can have anything you order. You have such a long runway to address all the markets, to have so many customers. You need the long runway to benefit the most out of growth, because growth over 2 or 3 years is not important. What is important for growth stocks is to have a long runway of over 10 years. You want to grow 20% per year, 30% per year for 10 years minimum, I would say. And if you see this long runway, this long distance destination, then you can invest in the growth stocks. That has to be met. And this criteria of being in the right industry, in the right competitive edge, competitive advantage, and with large addressable markets with long runway, that's the best formula when you invest in growth stocks. So some strategies about growth stocks: you can diversify across different sectors so that you can hedge your position. And if one industry is slower, well, you have other industries, other stocks in different sectors that will hedge your portfolio so that you can diversify your risk. That works really well. Also, to invest in growth stocks, you need a long-term investment horizon. Don't expect to generate big profits in 1 or 2 years. Investing in growth stocks takes a lot of patience. Well, if you had invested in Amazon in 2000, it would have been better for you to just buy and hold and sit on your hands. You need the long-term investment horizon. You will see some hiccups along the way. You just have to buy and hold. If you believe in the company, if the management team is competent, and if the business is still good, just buy and hold. Another strategy could be some portfolio rebalancing. So when a company gets too big in the company because the stock price increased too much, you just trim, you cut a little bit. And using dollar cost averaging is really nice for long-term horizons. Let's see the advantages and disadvantages of growth investing. The advantages are the potential for high returns. If you had invested in Amazon or Netflix, you would have seen great returns over decades. You also have big capital appreciation. If the business is working well and it is reinvesting all the earnings into the business, the stock is likely going up very fast. And this is a big opportunity to have an early entry into innovative industries. Imagine if you catched Amazon or Netflix in 2000 before they blew up. Well, that's a great opportunity for great returns. But you also have some cons, like higher volatility. As I said before, if there is a disappointment in numbers, things can go bad really fast. Also, you have some valuation risks. As we've seen before, some companies can trade at 100 PE ratio, 200 PE ratio. That's not always the case. You can have some growth stocks at a PE of 25, 30, 40, but most of the time the best growth stocks are overvalued. So any shock can impact the stock very bad. And there is some market sentiment influence. If everybody likes your stock, everybody will buy the stock and it will go up. And if some year nobody likes Amazon and there is some scandal and everybody hates the company, hates the management, everybody will sell the stock and you're here investing with your growth stocks that nobody likes now. You need some emotional strength to be in this position. When there is a 70% drawdown, so when Netflix loses 70%, you need to survive. The market sentiment can really increase the volatility of a growth stock. And market sentiment can change really fast. One year, everybody can love a stock, and next year, everybody will hate the stock. You have to sit tight and hold the stock for years. And finally, interest rates have an impact on valuation. This is especially true for growth stocks that are overvalued. As Warren Buffett says, interest rates are to stock what gravity is to matter. So when interest rates increase, the valuation decreases and vice versa. So if you have a PE ratio of 200 and the interest rates go from 0 to 10%, expect your valuation to go down. And if you had bought a stock at 200, that's a risk that you have to be aware of when you are a growth investor. And that's it for growth investing. Now let's talk about value investing and its different principles. The first one is to identify undervalued stocks and assets. So you want to buy stocks cheap. You don't want to pay an expensive price for your stock. Also in value investing, fundamental analysis is really important and valuation is really important. I think that's the strategy where the accounting work is the most complex, and that's where you have to dig down into the numbers and to analyze everything, income statement, balance sheet, cash flow, in details to see where the value is. And after that, you do the valuation. And when you do the valuation, you want a margin of safety. You don't want to pay a fair price for a business, like a PE ratio that would be reasonable at 15. No, you want to buy things that are cheap. In overall, value investing translates into low PE ratio. That's not always the case. You can have everything in the stock market. But in overall, I would say that compared to other investment styles, value investing is when you want to buy things cheap. So maybe not the best businesses in the world, but you will get the best price for your stock. So you want to acquire shares at a discount to their inherent value, to their interesting value, and you want to avoid risky assets and you want to diversify your portfolio. You want a basket of cheap assets and you don't want to pay full price for them. So you avoid all the growth stocks, you avoid all the hype stocks, all the sexy businesses. You just focus on accounting, focus on price, you do the fundamental analysis, and you buy when things are cheap. Also, one of the principles is to have a long-term perspective and to have patience. It is really important because sometimes a stock can be cheap, but it can remain cheap for 2 years, 3 years, and it's after 3 years that the stock finally recovers to its intrinsic value. Sometimes you will buy something which is cheap at a PE of 7, and you will wait, and 2 years after this the PE will still be 7, and then for some reason the business improves, the PE goes back to 15, and that's where you will have your return. But you need patience because in the short term the market can remain irrational, so you need to have a long-term mindset so that the intrinsic value can emerge over time. And I would say that this kind of investing is more a contrarian investing, and the goal is to avoid a herd mentality. You don't want to invest in the hottest stocks in the stock market right now. When you focus on value investing, you don't want to invest in companies that are trending in the news, that are on TV all day long. No, you want to focus on opportunities that no one is watching. And if everybody is focusing on tech right now, well, you can take a look at something that is not at all related to tech, like the energy sector or like mining companies. These are not sexy businesses, so you want to avoid the herd mentality. That's also why it's hard to do value investing, because the crowd will not be on your side. So you want to invest in companies that are out of favor with the market or undergoing temporary setbacks. Yes, and I would add with that that markets are not efficient, contrary to what is taught in business schools, and the intrinsic value of the company is not the same as the stock price. You see in this chart that you have a growing intrinsic value of a company, consistently growing over time. The business is improving its operations over time, but the stock price drops and then rises again. So when it drops and it gets very cheap and you have a gap between the stock price and the intrinsic value of a company, that's your margin of safety. That's your buy zone. And in value investing, there is a strong focus on margin of safety. You want to only buy stuff when it is very cheap, and you don't want to pay a fair price. You want a big margin of safety. If you think that a company is worth $100, you want to buy at a discount, so you may want to buy at $70 or $60, $50. You want a 20-30% margin of safety. And if you're greedy, you can ask for a 50% margin of safety. So half the intrinsic value of a business. In some countries, in some industries, you have bigger margins of safety. Because in the US, there are a lot of market participants, a lot of investors. But I suspect that if you invest in Zimbabwe, in their stock market, well, the markets will be even less efficient because you have fewer investors, fewer market participants, and you can get some crazy prices from time to time. So I would say that if you invest in developing countries, that's where you will find the biggest margins of safety. And when we talk about value investing, we often do the distinction between value and growth. But Charlie Munger said that all intelligent investing is value investing, acquiring more that you are paying for. You must value the business in order to value the stock. People often do the distinction between the two because it's the most simple way of learning how it works. But whether you are analyzing a growth stock or a value stock, the point is to pay less that you think the business is worth. So for this exercise, we're doing some distinction so that you can see what you like best. But in overall, I would say that the mindset you should have when you invest in the stock market is to do the analysis, do the valuation, and pay a good price for the stock. So let's go back to doing the distinction between growth investing and value investing. And I can tell you that value investing works because of this man, Warren Buffett, the best investor in the world that accumulated most of his wealth thanks to value investing, thanks to investing in cheap businesses that were discounted to their intrinsic value. He saw deals and he bought when it was cheap. And then he does a 2x, a 3x, a 5x on his investment, sold the investment, and then went back to looking for cheap businesses. And over time, his strategy has evolved to buying more quality stuff and not focusing only on cheapness. But I would say that his main strategy and his core investment principles is to do value investing. So you may say that only focusing on cheapness is not enough. Well, for the best investor in the world, it has worked beautifully. And if you only focus on price, you do the analysis of hundreds of stocks, you analyze them and you do evaluation. And if you only focus on price and paying things with a margin of safety, you will do very well. He has had very strong gains that you can see with this graph, for example, which is the comparison between the stock price of Berkshire Hathaway, the company of Warren Buffett, and the S&P 500 since 1990. And if we go back to the 60s, you would have seen an even stronger outperformance compared to the S&P 500. These investment principles, with the margin of safety, with doing good fundamental analysis, with doing good valuation, these works very well. Here are the advantages and disadvantages of value investing. For the pros, you have the margin of safety, which allows you to buy at very cheap price. So you don't have the risk of overpaying for stocks. So you don't have much volatility because you paid an expensive price. When you have a margin of safety, you are in a safer position. Value investing also has lower volatility compared to other strategies like growth investing. And another advantage is the potential for dividend income. Most of the time, value investing stocks pay a dividend, so you can expect a small dividend income. And the cons are that sometimes you have some value traps. We will see later what are value traps. You also have an underperformance during growth-driven markets. For example, when interest rates were very low in the past. Well, in this period, growth stocks surged and had a beautiful performance compared to value stock that had a poor performance. And if you have a value investing strategy over some decades, well, you can expect some underperformance when interest rates are low. And the other con is that patience and discipline are required. This is not for everybody. You need extreme discipline to pay a cheap price. If you're impatient and you want to buy the stock because you like the stock a lot and it starts going up, so you are in a FOMO, a fear of missing out, and the stock keeps going up and up, well, you can buy at the wrong time without a margin of safety. So you need a lot of discipline to do the valuation right and to only buy when there is a margin of safety. What is a value trap? Sometimes you can say that a stock is cheap and it's a wonderful deal, but it can be a value trap, which means a bad investment. Sometimes the stocks are cheap and for a good reason. It's that these companies are terrible. So an example of value trap is that you have a declining market share for a company. So a company can have a big advantage and then there is some competition and the company loses its market advantage, which will decrease in the future its revenue, earnings, margins, etc., etc. So it can appear cheap, but the business will not have a bright future, so it can remain cheap for a long time. Another sign that a cheap stock is a value trap is the business plan, and management can take the wrong decision and make mistake. So if you have outdated products and you don't do enough innovation, where you don't invest in the future, that's a bad business plan and this could break a business. So that could be a value trap. And all these poor business plan decisions are linked to a poor management. A management can destroy value if it does stupid things. It has happened in the past and it will continue to happen. Some management do mistakes, so you want to invest in good management, not poor management. Also, another sign of a value trap can be high debt. That could be a huge problem. Another sign is the underperformance in its sector. If in a specific sector, this specific company is the poorest performer, maybe that's the case for a reason. You have to be cautious. And another sign is poor capital allocation, which is linked also to poor management. If capital allocation is bad, it will destroy a lot of value and it deserves to be a cheap stock because it's not quality at all. Nobody wants to buy the stock and it deserves a low valuation. And what can also deserve a low PE ratio is no growth catalysts. If a business is expected to be stable or in decline, nobody will want to invest in this stock. Nobody will want to buy the stock for its bright future because it doesn't have a bright future. If it doesn't have good products or innovation, well, that's not the pioneer investing mindset that everybody wants. So it will deserve its low valuation for a long time. Another sign, which is really important, and it should be put at the beginning of this document, not at the end, is the over-promising and under-delivering. When management promises to reach 10% margins for next year, and you are next year, and the company doesn't do 10%, but they do 4%, well, there is a lack of trust for this management. So for 1 year, you can say, okay, let's see next year what they do. And again, management for the year after this, they say, okay, we will reach 11% margins. So we will have a strong year. But again, the company underdelivers and the margins are only 4%. Well, 2 years in a row, 3 years in a row, 5 years in a row, that's a very bad sign, and nobody will trust this management again. There is a complete lack of trust that deserves a low valuation. That's the type of qualitative factors that you have to look into when you look at a stock. And if a management lies about its forecast, it's a value trap. And also the over dependence on a product or market cyclicality can be a bad sign. If something bad happens to this product, well, the whole company is in danger. And finally, poor financials and accounting principles. If the business is bad, when you look at its accounting, fundamental analysis, and the business is bad, poor financials, you see stuff that you don't like at all, these are the signs that a cheap stock is here for a reason. It deserves a low valuation because it's a bad stock. It's a bad company with bad financials. And add to that the lack of transparency for some businesses. When you read an official document and you don't see any information that should be in the document, well, that's a lack of trust for management. That's a lack of trust for the business, and that's a very bad sign. So if you think that you have bought a wonderful deal because the PE ratio is 3, maybe it's 3 for a reason. Now, the final strategy that I want to talk about today is investing in quality stocks. Investing in quality stocks is when you focus on moat, high margins, high return on invested capital, and a long runway. The goal is not absolute growth, but growth at a reasonable price with excellent businesses and excellent management. You want to buy the best of the best. Quality stocks are so good that most shocks don't impact them. For example, whether you have a crisis or not, Ferrari has a 2-year list of car orders selling at very high prices. Whether it's 2009, whether you have a pandemic, people will continue to buy expensive cars from Ferrari. Another example is LVMH that will continue to sell its expensive products, whether you have a recession, whether there is a crisis in a specific country, people will continue to buy their products because it's quality, and these kind of markets are in luxury goods. And if there is a recession, there will still be rich people that will want expensive bags. That's it, expensive products for LVMH, expensive cars from Ferrari. These are quality businesses, quality stocks with generally high margins and high return on capital. And when there is very high demand and low supply for their products, they can boost prices again and again and again. And they have an amazing pricing power. So the prices of the Louis Vuitton bag can increase and increase and increase. And you will still find clients, you will still find customers that will want to buy this bag. That's the kind of quality that you don't see often. And if you had invested only in quality stocks since the 90s, you would have outperformed almost everybody. You see in this chart the distinction between low quality stocks, high quality stocks, and the overall market. And you see that you have a higher annualized return for high quality stocks. And in this fact sheet, it's a summary of investing in quality stocks. So what is quality investing? Quality investing is all about investing in the best companies in the world. You try to buy wonderful companies at a fair price rather than fair companies at a wonderful price. What are the three essential steps to identify a quality company? You buy wonderful companies. The company must be led by outstanding managers, great capital allocation. It filters out a lot of businesses. And you want it to be trading at a fair valuation multiple. So it filters out also a lot of businesses. This is why this kind of investing is hard. It's because it's very rare to find a great business selling at a fair price. What are the 6 essential characteristics of quality stocks? A sustainable competitive advantage, a moat. Management has skin in the game, so high insider ownership. Low capital intensity, so they can have high return on capital. Great capital allocation skills, high profitability, and attractive growth. How can I find a quality stock? You can have a return on invested capital above 15% for a sustainable period of time, so many years. And you also want gross margins above 40%. When a company has a consistent and high return on invested capital, as well as gross margins, you know that the company has a sustainable competitive advantage and pricing power. So at this point, you may say that it's the easiest kind of investing and you can be seduced by this kind of investing. The problem with this strategy is that you don't often get the opportunity to buy quality stocks at a fair price and almost never at a cheap price. You often have sustainable PE ratios over 40, which is expensive. The only chance to buy a great quality business at a good price is when there is a temporary problem about the company and the sentiment of the market is bad. So you can have bad earnings for a quarter with bad press or a scandal. That's where the company is bleeding and nobody likes the stock. If there is a big scandal for a quality company like Ferrari, for example, and the stock price drops and the PE ratio drops from 45 to 14, and you think, oh, well, the moat can be impacted. Nobody likes Ferrari anymore. Maybe they don't have a pricing power. The competition is coming for them. Well, paradoxically, that's the best time to buy Ferrari stock. That's the time where the press is very bad, the market sentiment is very bad, and when you can see a lot of negatives coming out of this stock. That's where you can see some red flags. Paradoxically, that's the best time to buy quality stocks. When every stockholders are bleeding and everybody wants to sell their shares, that's the best time to buy quality stocks. That's why it's very hard to build a quality stocks portfolio over the long term, is that you don't often get the opportunity to buy at a very good price. And for some companies, you don't have a moment when the sentiment is bad. You don't have a bad press because the company is so good and so good and so good for 1 decade, 2 decades. That's just that some companies sometimes are superior to the average business. So you never get an opportunity to buy with a PE ratio lower than 20. That's why it's very hard to invest in quality stocks. If it works, it's wonderful, but you want to pay a reasonable price for your stocks. Here are the important things to remember. It's easier to pick one investment style and master it. I've shown you 4 different investment styles, so you can pick the one you prefer and you stick to it. The important thing is to build a portfolio that will make you sleep well at night. You don't want to be stressed. You don't want some euphoria from the market. You want to take good decisions. And when you are stressed, you will not take good decisions. And speaking of bad decisions, here are the investment mistakes you must avoid when you invest in the stock market. The first mistake is not understanding the investment. Sometimes you might be seduced by financials, by the management that speaks very well, so you are seduced by the way management thinks, etc. If you don't understand the business, if you don't understand the investment, that's a big red flag, and that's the sign that you should not own the stock. The best way to generate returns over the long term is to only invest in the companies you know. So if you don't understand the business, just don't invest. The second mistake is to fall in love with the company. You can like a business a lot, understand the company, understand management's vision, etc. But if it reaches a high valuation, maybe it's the time to sell. And if you fall in love with the company, you may accept some bad decisions from management or bad capital allocation. You have to be rational, and maybe you know that you own a specific stock, but this stock doesn't know that you own it. So don't fall in love with the stock, don't fall in love with the company. You need to remain rational. Another mistake is the lack of patience. Obviously, in the investing game, you want to be patient because in the short term, anything can happen. So your strategy must be long term and you need patience. And another mistake is to have too much investment turnover. It's when you buy and sell a lot of stocks during the year. This is a mistake because if you do that, especially if you're a beginner, you will pay a lot of transaction fees, transaction costs every time you buy and sell. So that's a mistake that will drag your performance, and that's very costly. Another mistake is trying to time the market. It's impossible. And even the best investors in the world say that they don't time the market. They don't try to time the market. It's too difficult. Nobody knows the future. And it's impossible to know what will happen in the stock market in the next day, the next week, next month, next year. That's impossible. Waiting to get even is also a mistake. Sir John Templeton, one of the best investors, said that the best investors in the world will have bad investments 1/3 of the time. So you can expect to have some bad investments. It will happen. Not all your positions will be in the green. So you have to expect these bad investment. It will happen. And if you don't cut your losses, well, you will just wait and wait with your red position with big losses. And maybe you will want to wait to get even when the stock will rebound so you can sell the position and look at other opportunities elsewhere with the cash you collected when you sold your position. This is a mistake to wait to get even. You have to recognize it, say, okay, I made a mistake here. The investment is terrible. Let me sell, cut my loss, and go find another business. That's part of the game. You have to recognize your mistakes early so that you don't wait to get even. You don't lose your time. You just cut your position and find other opportunities. And another mistake to avoid is to let your emotions rule. If you let your emotions rule, you can take bad decisions, sell at the wrong time, buy at the wrong time. If you let your emotions rule, you will make a lot of mistakes. And I have here a list of other mistakes that new investors make, like to only buy hype stocks when they have already grown a lot and everybody's talking about them, they are on the news, etc., etc. If you buy hype stocks, you are likely buying an overvalued stocks, but also mistaking trading with investing, copying YouTubers' stock picks without doing proper research, not reading investment book, failing to diversify, trying to time the market, selling on the first drop, so being scared. That's different than the mistake that I mentioned previously. But let me go back to it. When I said waiting to get even, and I said to cut your loss when you've done a mistake, a small stock price drop doesn't mean that you've done a mistake. It's if the business worsen over time, if the quality of the business is poorer and poorer over time, that's when you see that you have done a mistake. If the stock price drops for some reason and it drops 5%, it's a mistake to sell because it's irrational in the short term. Also, another mistake is to invest on margin, so with a lot of leverage. Buying based on dividend yield. Some people just focus on dividend yield. They see 12% dividend yield and they only look this metric. They don't check financial health of the company. That means that, I don't know, 2 years from now, the company can go bankrupt and then doesn't have the cash to pay the dividend yield, and then the investment will go to zero. Another mistake is thinking low PE ratios are always the best. As we've seen before, there are value traps. Not accounting for fees, especially transaction fees, transaction costs. And finally, trusting financial news. On the news, you will see everything, good news, bad news. Their business is to sell papers. Their business is to have the attention from viewers so they can say everything they want. If they have your attention, they will make a lot of money. That doesn't mean that they are right all the time. Sometimes they will say wrong stuff. That's part of their job. And I would say that do your own due diligence and never have an investment opinion just because you saw somebody on TV talk about a stock. Do your own due diligence. The summary is to understand the different investment styles. I think you have understood how it works now. Know yourself and your risk tolerance. If you like to take risk in life, you can go for growth investing. If you don't like risk at all, well, I would advise to not invest in growth stocks and just pick another strategy. Stick with the strategy that works for you. That's very important. If you change your mind too often, well, you will not learn a lot. That's best if you just focus on one strategy and learn how to master this strategy. And finally, prepare to hold through volatility. Anything can happen in the stock market. That's very true. In the short term, the markets are irrational, so you need a proper strategy and hold through volatility. And now let's take action. In the next video, I will show you how to open a brokerage account and how you can buy your first stock and build a strong portfolio. Hi everybody and welcome back. In this video, you will see how to buy your first stock and how to create your stock portfolio. Here is what we're going to cover. First, we will see how to choose your broker. That's important because this will be the platform where you will buy and sell your stocks. That's where you will create your portfolio and you will have my personal recommendation. We will also see how to make your first purchase, how you can buy your first stock, but also how to monitor your stocks. So how to stay updated with your investments over time. As always, you can subscribe to my YouTube channel, Christophe Noor, and follow my Instagram and TikTok account for more exclusive content. And you can share the course if you have some friends or family members that are interested in the stock market and how to invest. Okay, the pro tip as always is to watch the video at 2x speed. And let's start. How to select your stockbroker. How to select the best broker you can find. You have different platforms where you can buy and sell your stocks, and there are dozens of platforms. Right now, you have a lot of choices. So how can you differentiate a good broker from a bad broker? Well, you can first check the fees and charges. Every time you will buy and sell a stock, you will have a transaction fee. For some platforms, the fee is quite cheap. For some platforms, it's quite expensive. So you can compare the numbers, and that could be a good way to select a good broker. Also, you can choose between a discount or full service broker based on needs. What do you want? If you only want a platform to buy and sell your stocks, just go for the most basic one and you will be satisfied. But if you want more help around all your dashboard, around some reports, well, you can go for a premium broker that will charge you more, but you will have more data. See if your broker provides a stock research report. On some platforms, the platform gives you some stock data, stock information, equity research report, some analysis. Well, maybe it will not be useful if you've done the analysis before. I think that's mostly useful for people that don't do the work before and just want to have a quick overview of a stock. So I would not say that this is really important, but for people that are lazy and don't want to do the work, this is quite helpful. Also, make sure that your broker has a robust helpline. That's important if you need any help. You want somebody on the phone, you want to talk to somebody, you want an email address that works. For some platforms, the customer service is horrible. For some platforms, you have a response in 2 days, so that's quite good. So you can check online what users say about the helpline, and if the customer service is good, that's a very good point for the broker. And finally, periodic reports on your portfolio holdings needed to keep track of investments. You need a clear report, a clear dashboard, a broker that will make your life easier. That's how you can pick your broker. There are many brokers like Interactive Broker, DeGiro, or eToro. There are many more. But I would say that these brokers are global. So these brokers adapt to each market, and these brokers are the best. So among all the different brokers that you can find, you can have different assets with each broker, different fees with each broker, and different user interfaces. My favorite one, and the one I use, is eToro for many reasons. First, for its simplicity and clarity. It's very accessible for beginners. They have many assets like stocks, ETFs, commodities, cryptos, indices, currencies. You will find everything that you need on the platform. They have many assets. It is a multi-regulated platform with over 30 million users, and that's very reassuring. 30 million is a big deal. And finally, on eToro, you have no transaction fees for stocks. So it is very cost effective for a stock strategy. We talked before about fees, transaction fees. Well, on eToro, it's 0%. That's why I personally use eToro. In fact, my portfolio is public and people can see my trades in real time. And because I'm a popular investor on the platform, people can clone my portfolio. You have the opportunity on eToro to clone the popular investors' portfolio. Very easy and with no additional cost. This is a screenshot of my eToro account where you can see my performance, my bio, and you can see that more than 130 people copy my investments. And at the moment, I have more than 1,400 followers. So, how to create an account on eToro? You can sign up with the link in the description and get started investing right now. And when you click on the link in the description below, you will find eToro's homepage that can look like this. And if you click on Start Investing, you will find this page to create an account. It's very easy to do, very quick. And once you have created your account, the first step is to deposit funds on the platform. So once you have created your account, you will have this user interface, and at the left you have a button Deposit Funds. When you click on it, you will have this page, Fund Your Account. You put the amount of money you want to put in the stock market that will be added to your eToro account. You can add money thanks to your credit card, but also with a regular bank transfer. You click on Deposit, and in a few seconds or in a few minutes, it will be done, and money will be on eToro. And after that, the second step is to buy your first stock. And to show you how it works, I just created an account called Christophe Test. I am on eToro's dashboard. This is my home screen when people can share interviews. This is a social trading platform, so people can exchange ideas in the newsfeed. You also have a tab Watch List, a tab Portfolio, which is empty because I just created this account. You can click on Discover, and it will show you the trending assets right now. So the trending stocks, trending cryptos, everything that is moving the markets right now. And you can click on Wallet to see the value of your portfolio right now, what you have on the platform. And to buy a stock is very simple. You have a search bar here at the top of the screen. And if I want to buy Apple, for example, let's click on Apple. And you have the stock price of Apple over 1 week, 1 month, 6 months, 1 year, 3 year, and max. The upcoming events from Apple, so the earnings report, the analyst forecast, so people think that it's a moderate buy. You have the market cap, the PE ratio at 28, some of the latest news regarding Apple, an ESG score here. At the top of the screen, you see a green button, Trade. When you click on it, you will find this page. Let me explain how this works. To make a transaction on eToro, you can place a market order or a limit order. For the market order, you buy at the current stock price. And for the limit order, you only buy when the stock price reaches a limit. If, for example, Apple stock right now is trading at $180, you say that you don't want to pay this price, you want to pay $175. Well, with the limit order, you will only buy the stock if it reaches $175. As simple as that. And there are other terms to know when you invest. Let's start with the stop loss. If the stock price drops below this level, the stock will automatically be sold. That means that if you buy right now Apple stock at $180 and you put a stop loss at $150, so if you have a loss, well, when the stock reaches $150, it will automatically be sold. You don't have to do anything. This is the point of the stop loss. You also have the take profit. If the stock price goes higher than this level, the stock will automatically be sold. That's the opposite of the stock loss. When you have a gain, You can also use leverage to increase your gains and losses. So let's go back to eToro. You have this page. The first line is the amount of money you want to invest in the stock. So right now I have put $500. That means 2.76 shares. And on eToro, you can buy fractional shares, and $500 means 2.76 shares of Apple. And below, you have the stop loss. eToro writes, create an instruction to automatically close this position if it loses an amount or drops to a value you specify. At that time, we will attempt to close your position at the closest available number on the market. Note, the number you set is not guaranteed. That means that if there is a panic and the stock drops for some reason, and you had put a stop loss at, say, $175, maybe the position will be closed at $174.9. So it works really well. And you can say that I want my position to be closed if I lose $100. So out of the $500 that I invest in Apple, if I lose $100, so if I lose 20% of my investment, the position will be closed. And I can also set a take profit. eToro writes, create an instruction to automatically close this position if it gains an amount or reaches a value you specify. At that time, we'll attempt to close the position, but it is not guaranteed. But approximately speaking, it works really well. And if I invest $500 in Apple stock, I say to myself, I want my position to quadruple. And if it quadruples, well, I'm out of the investment. So I put a take profit at $2,000, which means that if the stock price quadruples, it will automatically sell my position. Set, and here you can put the leverage you want. You can click on it and you can add a 2x leverage, 5x leverage, which can multiply your gains and losses. I don't recommend it and I never used leverage. Just do a normal leverage of 1, especially if you're a beginner. I don't recommend it. And below, you can place a market order or a limit order. If you click on market order, it will buy the position at the current price. And you can also click on limit order, where you can put your price and say that I want to buy Apple stock at $170. I just put $170 here, and that's it. You just click on buy and the transaction will be done. And when you want to sell a stock, to manually sell a stock, you do the same process with the market order and limit order. And after you're done the transactions, you need to monitor your stocks over time. As you build your watch list and portfolio, you need to keep an eye on your stocks. You want to see how your companies evolve over time. And if a stock on your watch list goes to your target price and your analysis is still valid, this is the time to buy. Use FinChat to monitor the stocks on your watch list and stay updated with the News tab. The easiest way to monitor your stocks is with FinChat because your watch list is on FinChat, but you can use other websites if you want. You can use eToro, you can use Stock Unlock, but if your watch list is on FinChat, it will be very convenient because your stocks are already there. You just click on the News tab and you will have all the news from all the stocks on your watch list. And finally, there are other sources of news to stay updated about the stock market, like the overall stock market. For example, the Wall Street Journal, but also Financial Times and Barron's. So the summary is to start investing in stocks with eToro. I've shown you how it works and how easy it is to buy your first stock. Monitor your portfolio and your watch list over time. It's important. If you added a lot of stocks on your watch list, you want to see how these stocks evolve. And if one of your stock on your watch list drops and it reaches your target price, this may be the opportunity to buy. Also, stick to your plan. Once you have found the investment strategy that works best for you, just stick to the plan and don't do anything stupid. And finally, enjoy the learning experience. Investing in the stock market can teach you a lot of things. And a big part of investing is doing research and learning about how a company works, how an industry works, and you will discover a lot of new stocks, a lot of new companies that you didn't know at all, and you will find some amazing products from some amazing companies, and you never know where the next opportunity will come from. As a reminder, you can sign up to eToro with the link in the description and start investing now. You can sign up to FinChat with the link in the description and get a 25% discount. And you can sign up to Stock Unlock with the link in the description and get 1 month free. And this was the first module from a 5-week course. Everything that we've learned together for more than 7 hours, well, this was only week 1 of a 5-week course. This is the entire course curriculum. So we've done week 1, Introduction to Investing, and in the future, we will also do week 2, 3, 4, and 5. And if you have found the week 1 module interesting, I'm sure that you will love the other modules that will be available only in my school community. So let me remind you to join the community now to get access to other modules. There is a link in the description.